Welcome to the channel JIV and CIV Made Simple. In this particular video, we are going to cover top 200 MCQs as well as case studies for Certified Credit Professional Examination. So these MCQs have been asked in the previous year memory based question, and they will surely help you in the upcoming examination. If you want PDF for them, you can check out the link in the description section. I have added the course link, and also you can WhatsApp me on the number shown on the screen. I request you to try these MCQs as a quizzes. Try the question first and then see the explanation. This will help you grasp the most benefit out of this video. So let's get started with our very first question.
Enough in a financial year. So which of the following is the most appropriate interpretation of it? Yes. So as you can see, credit turnover ratio has increased significantly. So how can you interpret it? Right. So option they have mentioned that the firm is delaying payment to supplier indicating weaker liquidity. The firm is paying supplier faster showing efficient short-term liability management. The firm credit purchase have decreased automatically proving improved liquidity. The firm creditor balance has increased meaning the firm is taking longer credit period. Now, very good question it is. Please pause the video, think about it. So, CTR has increased significantly. So, what is the interpretation? That is what is asking you. So, let me explain. So, imagine that you buy a good. Suppose this is you, right? And you are buying goods from where you are buying goods from supplier. You are buying goods from supplier, right? And you don't pay immediately, right? You don't pay immediately. So the credit turnover ratio CTR, it tells us that how fast the business pay back its supplier, right? So how fast the business pay back the supplier, right? So what is the formula for CTR? The formula is very simple. In the numerator, you write what? In the numerator, you write net credit purchase. In the numerator, you write net credit purchase. And in the denominator, you write net credit purchases, and denominator you write average creditor. Net credit purchase upon average creditor. That is what will give you CTR, or CTR we call it, or credit turnover ratio we call it, CTR, right? Now think logically. If the company start paying supplier quickly, think about it. Suppose this is the company, right? It start paying the supplier. Quickly, right? So the creditor balance goes down. If the company start paying back the supplier quickly, so what will happen? Automatically, creditor balance will go down. And when the denominator, what is the denominator here? Average creditor, right? And when the denominator, which is average creditor, become smaller, the turnover ratio will become bigger. So when the ratio increases significantly, what does it mean? It means that company is clearing supply due more frequently. As you can see, so when the average creditor decreases, CTR increases. So when the CTR increases, it means, company is clearing the dues, right? Company is clearing the dues more frequently. And it also means that, payment are happening faster, right? Payment are happening faster. And it also means that liquidity position is getting comfortable. Liquidity position is getting comfortable. So three things we can interpret. If the CTR is increasing, company is clearing dues, payment is going faster, and liquidity is looks comfortable. Now let's look at the option. Option number A say the firm is delaying payment. This is wrong. If the company delay payment, what will happen? If the company will delay payment, creditor balance will increase. And creditor balance will increase, it means denominator increase. It means the ratio will decrease, not rise. Here we are talking about increase, significantly increase, right? Increases. So this is not the correct answer. What about B? Yes, B is the correct one. What about C? Credit purchase have decreased, proving improved liquidity. That is what it is reading. Credit purchase have decreased, proving improved liquidity. Actually, just because purchase reduced, it does not prove that liquidity improved. Right? Ratio depends on two things. If you look at this particular ratio, there are two parameters: net credit purchase and average creditor. Without knowing creditor balance movement, you cannot conclude liquidity improved. Right? And what about option number D? So C is also wrong. Right? What is the interpretation? C is wrong, A is wrong. What about D? D says that the firm creditor balance has increased, meaning the firm is taking longer credit period. C. So creditor balance has increased. What will happen if the creditor increases? If the creditor increases, our denominator will go up. As you can see in the formula, our denominator will go up. And if the denominator will go up, this ratio or CTR will go down. So this cannot be the interpretation of increasing the ratio. So you can think of it like, I'm giving you a simple way to remember. You can think of it like, a speedometer, right? So if you have higher CTR, if CTR increase, it means payment speed is higher. Payment speed is increasing. Just remember it. More turnover means more money is turning faster into supplier. Right. Faster to the supplier means more money is turning faster to supplier. So turnover is increasing. Think about it. Turnover increasing. It means, payment speed is increasing. Right. So what we learn from this discussion is that, what we learn? We learned that basically creditor turnover ratio is the ratio of net credit purchase upon average creditor. First point, net credit purchase upon average creditor, that's called CTR. And this CTR, if his CTR increases, it means company is paying supplier faster. Company is paying supplier faster. And if the ratio is high, so this high ratio means, good short-term liquidity. Right. Short-term liquidity is very high. So the correct answer is option number B. I hope this is crystal clear now. Friends, this way I have explained in our previous session, and if you want complete description of the entire question which have appeared, you can enroll in our CCP course. The link is provided in the description section, or you can WhatsApp me on this particular number. In this course, you get unit-wise theory PDF, unit-wise concise notes, module-wise quick revision PDF, along with previous year question paper. There are 10 to 12 previous year question paper, and each one containing 30 to 40 questions. Overall, it is almost 400 questions. This will help you gauge the depth of the question, and most probably many of the questions will get repeated from that particular PDF itself, as it has been reported by the aspirant who have given the examination. Now let's see one fill in the blank MCQs, fill in the blank type MCQs, which is based on RBI norms on loan against share. So the question is, as per the RBI norms on advance against the share, bank cannot grant loan against their own share as per section dash of the BRA. Bank may give loan to individual up to dash lakh for physical share and up to dash lakh for demat share. Bank must maintain a minimum margin of dash percentage for loan against the physical share. So three concepts are there. Let me explain one by one. Option they have given. So let me zoom out a little bit. So this is the entire question. Please pause a little bit and think about the answer. Let me explain. So first of all, let's talk about the section 20 subsection number 1. Let's talk about this section. So let me explain this section 20 subsection 1. What does it say? That bank cannot take their own share as security. Imagine there is a bank, right? Imagine there is a bank, and that bank is giving a loan. That bank is giving a loan by keeping it on share as collateral. The bank is keeping on share as collateral, right? So that is risky, right? It's quite risky. It's quite unfair. Very risky and very unfair. So section 20 subsection 1, of the BRA clearly prohibited that bank cannot, bank giving a loan by keeping it on share as collateral, it cannot be done. So bank cannot grant loan against their own share. Very, very important. That is section 20 subsection number 1. Now the second point we have is the loan limit for individual. Loan limit for individual. So RBI has fixed limit to avoid access risk. So what is the limit? 10 lakh loan against the physical share. 10 lakh loan against the physical share, the old paper share certificate, and 20 lakh against the demat share. Please remember this limit, right? So demat share are more secure and transparent, so higher limit. The third point is about the margin requirement for physical share. So how much margin means what? Whenever I say this word margin, it means how much the borrower must bring from their own pocket, right? So margin means, borrower's pocket. How much the borrower must bring from their own pocket. See, if the margin is, suppose margin is 50%. So what does it mean? It means the bank will give only half the value of share. Bank will give the half the value of share, right? So let me give you one example. Suppose value of share is 1 lakh rupees, right? And bank loan allowed is suppose it will be 50,000. Right, so that is 50% margin, right? So I hope this is clear, crystal clear. So what we learned from the discussion is that, correct answer to this question is, right. So first one will be section number 20, subsection 1. Bank cannot grant loan. Loan of individual to 10 lakh and physical share up to 20 lakh for demat share. And minimum margin of 50% for loan against physical share. So I hope the correct answer is option number A, right? So basically you can remember it like this. Let me give you a trick to remember all this data. So this is called 10 20 50 rule, right? For share loan. It's all about share loan. Remember 10 lakh is for what? Physical share. 10 lakh is for physical. This is a limit for the physical share given to an individual. 20 lakh is the limit for demat share. And this 50%, this is the margin. This is the margin on physical share. This is called margin on physical share, right? And when one may remember, there's a section name 20 subsection number 1, right? What does it say? That no loan on share. No loan on share, right? I hope this is crystal clear now. Now friends, let's switch our focus to the next question that we have. Next question is, which of the following correctly describe the fee structure applicable to the cases filed in the Lok Adalat in India? Right. Option they have given: a nominal court fee is charged but it is adjusted against settlement amount. B says no court fee is charged for filing case, and if a court related case settled, the original court fee is refunded. C says a fixed Lok Adalat processing fee, right, is charged by banking cases up to 20 lakh. And D says only advocate fee are mandatory while court fee are charged as per regular civil court rule. What do you think about it? So friends, let's understand Lok Adalat in the simplest way. So if you talk about the Lok Adalat, they are the people courts. First point, Lok Adalat are the people court. Second point, the purpose is, quick and low cost settlement. That's the purpose. Quick and low cost settlement. Therefore, no court fee is charged. No court fee is charged. So it's called people court, quick and low cost settlement, no court fee is charged, right? Now, many cases come to Lok Adalat from regular court, like civil court, DRT. So these cases may have already paid court fee earlier, right? You know what happened? That from civil court, DRT, many court comes to Lok Adalat and they might have paid the fee earlier. So RBI Legal Service Authority rules say that if such a court referred case is settled in Lok Adalat, 100% court fee is refunded. 100 if it is settled there. Suppose if that particular case is settled in the Lok Adalat, 100% court fee is refunded. So Lok Adalat itself does not charge any processing fee, and banking pre-litigation cases up to 20 lakh are also free to file. So let's see the option that we have. Option A says a nominal court fee is charged but it is adjusted against the settlement amount. What do you think? See, nominal court fee is charged, no court fee is charged at all. That side is wrong. Option number B I think is correct, right? Because it says no court fee is charged is absolutely correct. What about C? It says that fixed Lok Adalat processing fee is charged. No. There is no charge. Lok Adalat charge zero processing fee, no special fee for banking matters. And option D says that only advocate fee are mandatory while court fee are charged as per regular civil court. No, that's wrong. So remember, Lok Adalat no fee, only settlement, right? So file for free, settle for free, even old court fee come back to me, right? This remind no new fee, old fee refunded. So what we learn from this discussion is that Lok Adalat do not charge court fee, and court referred case settled, then refund of the original court fee, no processing fee for banking or pre-litigation matter, advocate fee are optional. Therefore option B is the correct one, right? I hope this is crystal clear. So I think this question is repeated twice. Let me skip this question. Yes, let's try this particular question. This was exactly as it is asked in the examination, right? So the question is, as you can see, the following statement is regarding interest subvention for women SHG. Great question. So they have mentioned, loan up to 3 lakh in Kerala, district 7% effective interest rate with an additional 3% subvention. C says SHG loan between 3 to 5 lakh, 6% effective interest rate subvention. D says SHG mentally must upon the limit. So which one do you think is correct? So friends, Day and RLM, what is Day and RLM? Let me explain a little bit. So it gives interest relief, it's called subvention. So it gives interest relief, we call it subvention. So this subvention or interest relief is given by the Day and RLM to whom? To the women SHG, right? So that they can borrow cheaply and do income generating activity. So there is something called category 1, right? There is something called category 1, or we call it category 1 intensive district. There are category 1 intensive district. What is this category 1 intensive district? Let me explain. So basically, in this particular case, SHG loan up to 3 lakh are given at 7% interest rate. And if the SHG pay on time, if they pay on time, what happened? They get extra 3% subvention. and that bring the effective interest rate down to 4%. So up to 3 lakh loan, right? They are given 7% interest, and if they make the payment on time, they get extra 3% subvention, right? So let's look at the option that we have. Option A say all SHG loan up to 5 lakh automatically get no. SHG loan up to 5 lakh automatically get, this is wrong. Actually 7% apply only up to 3 lakh only, and that too only in the category 1 districts. There are some category 1 district where it's applied. What about option number B? Yes, this is the perfect one. This is the perfect one. Option number C, it says that loan between 3 to 5 lakh carry a fixed 4%. This is wrong. Actually, loan between 3 to 5 lakh range do not get fixed 4% interest. Rather, bank are reimbursed to bring the rate down to 1 year MCLR. Bank are reimbursed to bring the rate down to 1 year MCLR or 10%, whichever is lower. What about option D? Option D is again wrong. It says subvention is available only when SHG maintain lean mark saving account with the lending bank. Absolutely false. Under day NRLM, SHG saving account cannot be lean mark. Subvention has no link with lean or blocking of saving. So remember what we learned from this discussion. There is a simple rule. You can remember it. 3 lakh, 7% pay on time. 3 lakh, 7% pay on time minus 3%. Right, so you can remember it. There is a way you can remember it. 373 rule, right? 373 rule, right? So 3 lakh loan, 7% interest, 3% bonus for good repayment. So category 1 intensive district give 7% interest for SHG loan up to 3 lakh. Prompt payer get 3% subvention. Effectively, it is 4%. Loan from 3 to 5 lakh follow MCLR or 10% rule, not 4%. Right. So if the loan size is more than 3 lakh, so it follow 1 year MCLR rule or 10%. Right. I hope this is crystal clear now. Now friends, have a look at the next question. The next question, if you think that this video is adding value to your preparation, don't forget to hit the like button. Please hit the like button. Now friends, have a look at the next question. This question is based on co-acceptance of the bill. Question is, which of the following is a mandatory RBI safeguard before a bank co-accept a trade bill? Option A, co-acceptance may be issued for accommodation bill between sister or group concerned, provided both maintain good credit history. B, bank must ensure that bill represent a genuine trade transaction and verify the underlying goods in the borrower stock. C, bill drawn under bank on LC or buyer line of credit can be freely be co-accepted to the facilitate trade. D, co-acceptance is allowed for any usance period up to 360 days without a stock verification if the borrower has an existing credit limit. Very good question. So let me explain a little bit about this co-acceptance. See, this is not just a question answer session. This is basically concept making session, concept building session. I explain each and every concept. So first of all, we should know what is the meaning of this term, so-called co-acceptance. You can think of it like this. Whenever a bank, suppose this is the bank, and this bank is co-accepting. Whenever a bank is co-accepting what? Co-accepting a trade bill. It is basically saying that, if the buyer does not pay, I will pay. If the buyer does not pay, I will pay. Bank is saying to the customer that if the buyer is not paying to the seller, basically, if the buyer did not pay, I will pay. That's called co-accept. Because this creates a direct liability on the bank. Yes, it creates a direct liability on bank. And RBI want bank to be extremely careful. Right. So before giving this guarantee, bank must make sure that, the bill is based on real sale. The bill is based on real sale or real purchase. So real word is super important. Second thing, bank must ensure that goods actually exist. Right. It is not fake invoice. Third thing is that goods are physically present in the borrower stock. Goods should be physically present. This is what bank has to ensure. And the fourth thing is that valuation that is done is genuine, not inflating the price. Fifth point is that transaction is not between related party. Transaction is not between the related party just to create, fake papers. So this condition must be exist. A real sale, goods must exist, physically goods should be present, valuation must be genuine, and there should not be related party, right? So now let's look at the option that we have. So option number A, if you look at, it says that, it must be issued for accommodation bill. See, accommodation bill between sister group and concern are allowed. So RBI strictly prohibits co-acceptance of house or accommodation bill. Why? Because they are often used for fraudulent discounting. So RBI prohibit this. This is not accepted. Option B, yes, this is the correct one. Right. Option C, bill drawn under bank on LC or buyer line of credit can freely be co-accepted to facilitate trade. Totally prohibited. Bank cannot co-accept bill where it is already the issuing bank. That would be double liability, right? So bank is already the issuing bank and it cannot, it cannot co-accept the bill where is already the issuing bank. Option D, co-acceptance is allowed for any usance period up to 360 days without stock verification. No, this is wrong. Actually, if the trade, typically trade usance is how much, 120 to 180 days. This is the typical trade usance. And stock verification is quite mandatory. This is mandatory step. And any borrower has a limit. So credit limit is not automatic permission for co-acceptance. So what we learned from this discussion is that, just one word if we want to summarize, you can say that, whenever I say co-acceptance, in the case of co-acceptance, we should check the good first. We should check the good first, right? No good, no co-acceptance. If the bank cannot see, if the bank cannot verify, if the bank cannot value the goods, co-acceptance must not be done, right? So what we learned from this question is that, co-acceptance is a serious bank commitment treated like a guarantee. RBI mandate verification of goods, stocks, valuation and genuine trade. No co-acceptance for, house, accommodation bill, group company routing, bill under letter of credit or buyer line of credit. And usually usance period normally 120 to 180 days, not 360 days, right? I hope this is crystal clear now, right now. Now friends, if you are looking for content for the last moment revision of CCP so that you can revise the entire content in very less time, check out our course on CCP in the description section below. Now friends, have a look at the next question. The next question says that which of the following type of advance will not be treated as NPA even if interest remain overdue beyond 90 days, provide adequate margin is available. Option A, advance against gold ornament. Option B, advance against NSC. Option C, advance against government security. Option D, advance against marketable share. See, try to understand what this question is all about. Let me explain a little bit. So you are familiar with, RBI IRAC, income recognition and asset classification norm, right? Please understand. Under the RBI IRAC, some loan are treated as fully secured. Some loan are treated like fully secured loan because the bank hold 100% safe, easily incashable security. Incashable security, that is the bank is holding. So even if interest is overdue for more than 90 days, this loan will never become NPA, right? So interest is overdue for more than 90 days. That means, overdue period is more than 90 days. This loan, they will not become NPA as long as the margin exists. As long as the margin exists, this loan will not become NPA. So these special fully secured include what, it includes term deposit, or we call it FDs. It includes NSC, National Savings Certificate, except for surrender. It includes IVPs, that is called Indra Vikas Patra. It includes KVP, Kisan Vikas Patra. It includes LIC. So let's look at the option that they have given you. Advance against gold ornament, right? So what do you think? Actually, loan against gold follow the normal 90-day NPA rule. If the interest overdue is more than 90 days, this is NPA. This is not the correct one. Advance against NSC, correct one. This is the correct one. Advance against government security. This is not included in the RBI exempted list. These loans become NPA after 90 days like normal advance. Advance against marketable share. Again, shares are volatile and they are not considered fully secured liquid asset. So first thing is that whatever asset we are talking about, it should be fully secured. But can you tell that shares are fully secured? No way, you cannot tell that, right? So the correct answer is NSC. Option number B is the correct answer, right? So remember, there is a way to remember this. Let me explain. So if they ask you FD, NSC, IVP, KVP, LIC, in this case, no NPA even after 90 days. So a small saving, these things are a small saving plus LIC plus FD, right? Safe, so no NPA. If collateral is government bank, small saving or FD insurance, a special exemptions apply. So in all these cases, you can see that either it is collateral is government bank or there are some special insurance case, small savings. So in this particular case, that rule is applied. Special exemptions apply. So what we learned that RBI exempts certain fully secured advance from becoming NPA even after 90 day overdue. This security must have fixed guaranteed surrender value. Example I have given you FD, term deposit, NSC, in the Vikas Patra, Kisan Vikas Patra, life insurance policy, etc. Now friends, let's have a look at the next question. I think this is the repeated one. So the next question is, a bank guarantee is considered discharge under which of the following circumstance? This is a very good question. When a bank guarantee is considered discharge. So option A, they are saying when its validity period expire and no claim or invocation is received by the bank. When the beneficiary verbally inform the bank that no further action is required. Only when the bank unilaterally decide to close the guarantee before expiry. When the principal later completes partial repayment under the main credit facility. These are the four options that they have mentioned you. So let's have a look at the correct option. So basically, if we talk about the bank guarantee, let me explain. If we talk about the bank guarantee, it is like a promise from the bank, isn't it? It is like a promise from the bank that, if the customer fail, then in that case, bank will pay. If the customer fail, bank will pay. That is a promise, right? But this promise is not forever. Every guarantee has a validity period. Every guarantee has a validity period. Every guarantee has a claim period. Every guarantee has an expiry date. If the beneficiary, that means the person in whose favor the guarantee is issued, does not make a claim on before expiry, the guarantee is automatically finished. See, try to understand what I am telling you. If the beneficiary, right, that is the person in whose favor the guarantee is issued, if the beneficiary does not make a claim on or before the expiry, if the beneficiary does not make claim on or before the expiry, what happened? Guarantee is finished. Guarantee is finished. The bank has no more liability. The bank has no more liability, right? And the guarantee is said to be discharged. So this follows the Indian Contract Act rule about the discharge of surety and banking practice under RBI guidance. So what you have discussed that, that if the bank guarantee is like a promise from the bank that if the customer fail, I will pay, but this promise is not forever. Every guarantee has a validity period, claim period, expiry date. If the beneficiary does not make a claim on or before the expiry, then the guarantee is automatically finished. The bank has no more liability. Guarantee is said to be discharged. Now let's look at the option. Option A says when its validity period expire and no claim or invocation is received. Exactly correct. Option B, when the beneficiary verbally inform the bank that no further action is required. Actually, verbal statement have no legal value. A guarantee can end only by expiry or written release from the beneficiary. Option C, bank unilaterally closes the guarantee before expiry. The bank has no right to cancel a guarantee early on its own. Only the beneficiary can release the bank in writing. Option number D, when the principal later complete partial repayment. Actually, a bank guarantee cover performance or payment obligation. Partial repayment does not end the guarantee unless the beneficiary issue a formal release. So what we learned from this discussion is that, two conditions are there. First thing is expiry. Second thing is no claim. Right? These two things ensure that goodbye guarantee. Goodbye guarantee. Right? So no claim. Just remember, no claim, no liability. Right? This instantly tell you that expiry plus silence from the beneficiary means discharge. So what we learn from this discussion is that, bank guarantee end automatically on expiry if no claim is received. Beneficiary must claim before, on or off the expiry date. Bank cannot cancel a guarantee on its own. Verbal communication is useless. Only written release work. Partial loan repayment does not discharge a guarantee. So option A is perfectly correct. Now, the next question that we have is based on LLP, Limited Liability Partnership. Right? Which of the following statement is not correct? So the option A, they have given that, certificate, ROC registration apply only to company. It apply only to company or only to LLP. Right? It does not apply to, sole proprietorship. So sole proprietorship is simply an individual doing business under his own name or chosen trade name. So there is no separate legal entity. So no ROC is involved in the sole proprietor. Now let's break down each and every option. So basically question is which is not correct. Let's have a look. Yes, not correct. So if you look at the option number A, so it says that LLP must register with ROC under the LLP Act. Yes, this is the correct one. LLP get legal status only after filing with the ROC, who then issue the certificate of incorporation, or we call COI. Yes, A is correct. What about B? Companies like private, public and OPC section 8 require ROC registration. Yes, every company must file MOA, AOA and get certificate of incorporation from the ROC before starting business. Option C, sole proprietorship must obtain ROC registration. See, this is wrong. Option C is wrong. A proprietorship does not get registered with the Ministry of Corporate Affairs. That is MCA. Right. There is no incorporation process, no MOA, no AOA. So business run using the owner's pen Only optional registration apply, like GST, Udyam, shop and establishment license. So what is the correct answer? What about option D? ROC issue the certificate of incorporation. Yes, correct. ROC check the MOA, AOA related filing. Right, DIR, KYC documents. Right, once everything is valid, ROC issues the ODI. So remember, ROC is only for companies as well as the LLP, not for proprietorship. Even MC does not register people, only entities. Please remember, Ministry of Corporate Affairs, it does not register people. What it registered only entities. So what we learned, ROC registration mandatory for LLP plus company, sole proprietorship, no ROC, run on honor pen, ROC verify MOA, AOA, etc. Now friends, let's do one numerical based question. Right. A company reports COGS. How much is the COGS reported by the company? 4,80,000. Now friends, question is as per the RBI 2017-2018 guideline, which of the following cannot be accepted as a collateral? Option A, gold jewelry like bangles, chain or ornament. B, gold coin up to 50 gram per borrower. C, primary gold in the form of bullion or gold bar. D, silver ornament within permitted weight limit. So basically, RBI has issued a clear guideline through circular. It states that, bank cannot accept primary gold. Right, please remember. It clearly says that bank cannot accept primary gold. What's the meaning? It means, like gold bullion. Bank cannot accept. Like, gold bars. Like, raw gold. Okay. Unworked metal. Why? Because primary gold is easy to misuse. Traceability is quite weak. And it is linked to money laundering risk. That's why RBI prohibits it as a collateral. So what bank can accept? Yes, bank can accept, gold jewelry and ornament. Right. So bangles, chain, necklace, ring, any ornamental or worked gold. Bank can accept gold coin. Coin can be accepted. Right. Jewelry can be accepted. And silver ornament and silver coin can be accepted. Right. So this can be accepted, this can be accepted, this can be accepted, this cannot be accepted. Right. So jewel yes, bars no. Just remember, jewel yes, bars no. If the gold is worked, like jewelry allow. If the gold is raw, if the gold is the form of raw, like bar. Or if the gold is form of bullion, then big no. And if the gold is the form of worked like jewelry, then they can do. Right? Please remember it. Now friends, have a look at the next one. The next question is based on MISS, or we call it Modified Interest Subvention Scheme. Which of the following statement about MISS is not correct? Very good question. Right. So options they have given: MISS provide interest subvention on short-term KCC crop loan up to 33 lakh with an additional 3% benefit for prompt repayment. KCC loan for animal husbandry and fisheries are eligible for interest subvention for only up to 2 lakh. MISS offers subvention benefit even on overdue loan as long as they are linked to KCC account. Prompt repayment within 12 months reduces the effective interest rate from 7% to 4% for eligible farmer. So these are the 4 options they have mentioned. So let me explain what is this MISS scheme is all about in the layman terms. So MISS scheme is the government scheme that reduce interest on KCC short-term agriculture loan. Right? On the short-term agriculture loan, it reduce interest. Now the core rule is very simple. This particular subvention is only available only when loan account is regular. If the loan account is regular and the loan account is standard, then only subvention will apply. And if the loan become overdue, what will happen? If the loan become overdue, the farmer loses the subvention benefit. No subvention. No subvention if the loan become overdue. Right? Now, the question is asking you, which of the following is not correct. Right? So let's look at the option number A. It says that MISS provide interest subvention on short-term KCC crop up to 3 lakh with additional 3% rate. Yes, bank get 1.5% subvention and farmer who repay on time get 3% extra benefit, bringing the rate effectively to 4%. And the government has raised the limit to 5 lakh in the recent budget. Please note it down. In the recent budget, government has raised the limit to 5%. Right? To 5 lakh. Okay. In the recent budget. But the question uses the 3 lakh rule, so option number A is correct. Now, what about B? KCC loan for animal husbandry and fishery are eligible for interest subvention. Yes, this is also correct. These activities have a separate subvention ceiling of 2 lakh. C. MISS offers subvention benefit even on overdue loan. No. This is wrong. Actually, option C is wrong. Because subvention is available even for overdue KCC account. This is completely wrong, right? What about D? Prompt repayment within 12 months reduces the effective interest rate. Correct. If the farmer repay the KCC loan within 12 months, they get 3% prompt repayment. That is correct. So total C is totally wrong because subvention available even on overdue loan. No. MISS clearly states that subvention apply only to a standard regular non-overdue account. Once the loan become overdue, no 1.5% subvention, no 3% prompt repayment. See, basically what kind of benefit it is giving you? 1.5% subvention it is giving you. 3% prompt repayment benefit it is giving you. And interest revert to normal bank rate. Right. So MISS care only for regular account. Overdue means over. Pay on time, pay only 4%. Delay, pay full rate. So MISS apply to short-term KCC crop loan. First thing, please note it down. It apply to short-term KCC crop loan only. Crop loan limit for subvention is 3 lakh and it has been raised to 5 lakh. And if it is fisheries and animal husbandry, this is 2 lakh limit. Prompt repayment within 12 months, 3% extra benefit. Effective interest rate will get down to 4%. Overdue loan loses all the benefits. So friends, we have some more question. If you want to get explanation for the questions, you can enroll in our CCP course. For more detail, you can WhatsApp me on this particular number or check out the description section for the course. Please like the video. Question is, Apex Manufacturing is evaluating its production efficiency for the upcoming fiscal year. Right. So production efficiency for the upcoming fiscal year, they want to evaluate. So what they have given that it is selling one unit at rupees 20 rupees per unit. So let me write down. So the first data that they have provided is the selling price per unit, right? So SP selling price per unit is rupees 20. Next point. Next they have given that to maintain the operation they incur 11 rupees in the manufacturing variable cost. So also they provided you that manufacturing variable cost is how much? Manufacturing variable cost is 11 rupees per unit and selling is 1 unit, selling per unit is rupees 20. Now also they have given that rupees 3 in selling the variable cost. So selling variable cost, how much in rupees incurred? So in rupees 3 in selling variable cost per unit, right? So let me write down. Selling variable cost per unit is rupees 3 per unit, right? Also they have fixed cost every year, right? In addition to that, they have fixed cost every year. So what is the fixed cost? Right. So fixed cost include two parts. First one is the factory fixed overhead. What is factory fixed overhead? As you can see, factory fixed overhead is 5,40,000. And in addition to that, there is administration, right? Administrative selling cost, which is 2,52,000. Which is how much? 2,52,000. Okay. So now these are the data that they have provided: selling price per unit, manufacturing variable cost, selling variable cost, fixed cost, right? Administration and admin and selling fixed cost, right? So these are the things that they have given. Now fixed cost means what? No matter how much you produce or how much you sell, the cost do not change. So that is the meaning of this term. That is the meaning of this term, fixed cost. However production, how much production you do, no matter how much production you do, how much selling you do, the cost will not change. Now the twist in the question, twist is that because there is a competition, right? Because of the competition, the selling price fall by 10%, right? As you can see, if the market become competitive and the selling price fall by 10%, selling price fall by 10%, and all the remaining costs remain the same, right? Fixed costs remain the same, right? So we have been asked to compute the new break-even point in units. What will be the new break-even points, right? So let's calculate let's see how to compute the break-even points. So one thing that fixed costs are always added together, right? Fixed costs are always added together. So first of all, let's compute the total fixed cost. So what is the total fixed cost? Total fixed cost, if you add all of them, whatever fixed cost you incur. So two kind of fixed costs you incur. One is the factory overhead cost, which is 5,40,000. And in addition to that, there is administration and selling fixed cost,
which is 2,52,000, right? If you add both of them, so which is 5,40,000 plus 2,52,000, so that will become 7,92,000. That is the total fixed cost. Now we have to find the new selling price, right? So what is the original price? So original price they have mentioned is 20 rupees per unit, and price reduction is 10%. Please see, they have mentioned that selling price has decreased by 10%. So let's compute the new selling price. How to compute the new selling price? Because every task we have to calculate based on the refined version. So what they have given the original price. So original price is rupees 20, and they have also mentioned that selling price decreased by 10%. So how much is the reduction in the price? So price reduction will be 10% of 20, which is 2 rupees. So the new selling price will be how much? New SP will be 20 minus 2, which is 18 rupees, right? So now we know the new selling price. We also know the total fixed cost, which remain always constant. Now let's compute the contribution. Right? How to compute the contribution? Contribution is very simple to compute. Selling price minus variable cost, right? So variable cost remains rupees 14, as they have mentioned. So variable cost, which is I think 11 plus 3. So these two are variable cost, manufacturing variable cost and selling variable cost. If you add 11 plus 3, which is 14, which remains same, right? So variable cost is 14 rupees per unit, and selling price they have given. How much is the selling price they have given? So selling price, I think they have given 18 rupees. Let me show you. Just wait a minute. So as you can see, yes. So we have to take the new selling price, right? After reduction. So it is 18 rupees. So 18 minus 4 is 4 rupees per unit. That is the contribution. So something, you note something important. Earlier, contribution was high. When we take selling price as 20 rupees, contribution was high, but price reduction directly reduces the contribution. Now what the question is asking you to compute? You have to start, the question is asking you to find a new break-even point. So see, first of all, you should know how to compute the break-even point, right? What is the formula for computing the break-even point? Let me write down. So this is the formula that we use to compute the break-even point, which is equal to fixed cost divided by contribution per unit. Fixed cost divided by contribution per unit. So what is the fixed cost here? So as you can see, fixed cost is 7,92,000. This is the fixed cost, 7,92,000. And what is the contribution per unit? 4 rupees is the contribution per unit. So if you divide, this become 1,98,000. So that is our break-even point. So this is called, break-even point. 1,98,000 units is the break-even point, right? So what is the correct answer to this question? If you look at the question is asking you to compute what is the new break-even point. So this 1,98,000 is the new break-even point, right? So this is the correct explanation of the entire question, right? So what we get to learn is that break-even point is always fixed cost divided by contribution. And in this case, what happened? Selling price got decreased. Since selling price got decreased, your contribution got decreased because say contribution is selling price minus variable cost. It remained the same. Since it decreased, contribution decreased, and since contribution decreased, so your break-even point will increase sharply. Break-even point, because formula for break-even point is very simple. Fixed cost upon contribution. So contribution is what is happening to contribution decreasing. So BP will increase, right? So as you can see, a small drop in price, big increase in volume is required. So what we learned from this question, what is the key learning from this question is that, the break-even point is a function of contribution. Break-even point depends on contribution. And the second point is that, as we have seen, the price got reduced. So price reduction is more dangerous than cost increase. So if you compare increasing the cost or decreasing the price, then price reduction is more dangerous. Fixed costs remain unchanged even after price cut, and contribution is the only cushion against the fixed cost. In exam, recalculate contribution whenever percentage price changes. So what are the common exam mistake to avoid? First thing is that a student forget to recompute the contribution after the price change. Most of the student, they forget to recompute the computation after the price change. and some divide fixed cost by sales value instead of contribution. But plus please remember, whenever we want to compute BEP, so what we need to do? We need to divide the fixed cost by contribution. Most of the people do mistake here. They divide the fixed cost by the sales value. Right? Please don't do this mistake. Right? Friends, before moving to the next question, let me show you our CCP courses. So if you are looking for one-stop solution for the entire CCP revision for the last moment, you can check out our course. In our course, you will get separate folder for exam content and a Telegram group. As you can see, in the exam content, you will see 4 type of folder: quizzes, mock test, quick revision PDF, previous year question. There are 10 previous year question PDF. As you can see, every examination the collected question I have provided, and this will help you gauge the level of the examination and the important topics. And then there is a folder for covering the topics, right? So unit wise folder, as you can see, unit wise theory and MCQ. It has been divided into 5 modules, A, B, C, D, E. Inside each module you will see unit wise bifurcation of the syllabus. Inside each unit wise folder you will see a separate theory PDF and a separate MCQ PDF. And now this is a new version. So many aspirants have cracked the paper using our material. If you are looking for cracking the paper in the very first attempt, please WhatsApp me. You can WhatsApp me on this particular number for more detail regarding the CCP courses. Now friends, let's move forward and let's see the next question that we have. So the question number 2 is on your screen. Management want to achieve, right, the target profit of rupees 6 lakh, right? So management want to achieve the target profit of rupees 6 lakh, but discover that variable manufacturing costs have risen to 12 rupees per unit. How many additional units must be sold over the original estimate to reach the same profit goal? Very good question it is. Option they have given 33,000, 46,400, 1,32,000, 2,78,400. How many additional units the question is asking you, right? So basically this question is the second part of the previous one. So Apex management wants a profit of 6 lakh. So let me write down the keyword here that we will be using in every step. Let's write the keyword here. So profit that they are expecting is how much? They want a profit of 6 lakh. Okay, and now but the variable manufacturing cost increases from, so variable manufacturing cost, so earlier it was 11 rupees, now it become 12 rupees per unit, right? So variable manufacturing cost increases from 11 rupees to 12 rupees. Earlier it was 11 rupees, now it is 12 rupees. Clearly they have mentioned. And the total variable cost includes 2 parts. One is the variable manufacturing cost, other is the selling cost. Selling cost remain the same. What was the selling cost? Let me show you. So the selling cost was, I think this was 11 rupees. Yes, here you can see it was 3 rupees per unit, right? Selling cost variable. So total variable cost per unit, total variable, just wait a minute, total VC per unit is now 12 rupees plus 3 rupees, which is equal to 15 rupees, right? Which is equal to 15 rupees. Now what about the selling price? Does the selling price changes? Tell me, does the selling price changes? So selling price, no, selling price does not change. Target profit is just 6 lakh, right? So selling price is remaining to, selling price is rupees 20, right? So question is asking you how many additional unit, right? How many additional unit must be sold over the original estimate to reach the same profit goal? Option they have given. How do you compute? See what happened to the fixed cost? Does the fixed cost change? Tell me, is the fixed cost changing? No, fixed cost remain unchanged. What is the fixed cost? So let me show you, see what we have taken in the first case. Yes, that is total fixed cost was 5,40,000 and admin, so it is 7,92,000. Yes, just now we have computed, so no need to compute it again. Total fixed cost is 7,92,000. Okay, now new variable cost per unit is 15 rupees. So tell me, what is the contribution per unit? Yes, because variable cost has changed, so contribution per unit has automatically changed. So contribution per unit is selling price minus variable cost per unit. So 20 rupees minus 15 rupees, right? 20 minus 15, which is 5 rupees per unit. That is your contribution per unit. Now you have to earn a target. Target is 6 lakh profit, right? So how many units are required to earn the target profit? So target profit desired is 6 lakh. So the required unit is equal to, think about it, required unit is equal to your fixed cost plus desired profit, fixed cost plus desired profit divided by contribution per unit, right? fixed cost plus desired profit divided by contribution per unit, because in this case profit is also desirable, right? So just do the computation. So 7,92,000 plus, I think it is 6 lakh, right? 6 lakh divided by contribution per unit is how much? 5 rupees per unit, right? So if you add both of them, 7,92,000 plus 6 lakh, I think this will be 13,92,000 upon 5, right? So that would be how much? That would be, I think it will be 2,78,000. 2,78,000 will be the number of units, right? So this gives you the number of required units, right? Please understand, this gives you the number of required units, right? So earlier original estimate with earlier cost was 2,32,000, right? So you can see in the original estimate they have given 2,32,000. So additional unit is how much? So it's very simple. So if you have to compute the extra unit needed, right? Extra unit needed. So how to compute the extra unit? Just subtract both of them. 2,78,400 minus 2,32,000. So just subtract. That will give you 46,400 units. So this is the extra unit that is required, right? So the formula is very simple. What you need to do? Profit units is equal to fixed cost plus profit divided by cost divided by contribution per unit, right? How to compute contribution per unit? Contribution per unit is selling price minus variable cost, right? This is how you compute the contribution per unit, selling price minus variable cost. So the rule is very simple. Rise in variable cost. See, if the variable cost increases, what happens? Contribution decreases. Variable cost increases, contribution decreases. So you need more units. You need more units, right? So just remember, if BC increases, contribution decreases, units increases. So that is the point. So when the variable cost increases, contribution drop rupee for rupee, right? So remember, this is the very important learning from this particular question. Now let's see the question number 3. Under the RBI master direction of on lending to the MSME sector and as associated circular for NBFC, which of the following scenario would be considered a violation of the regulatory compliance? Four options they have given, right? Accepting a primary gold bar as a collateral for personal loan, provided the LTV value is below 75%. Extending a 7 lakh working capital loan to a micro enterprise without requiring any land or third party guarantee. Accepting listed equity share as collateral for a corporate loan to a manufacturing firm, and refusing to accept share as collateral for a loan is specifically requested by NBFC. So this is a very good question. The question is about violation versus compliance under RBI master direction and NBFC circular. This question check whether you understand what RBI allow as a collateral, what RBI strictly prohibit, and there is a special rule for MSME and NBFC. So these are the things that is checked in this particular question. So let's go through each and every option. So first of all, option number A, it is saying that accepting a primary gold bar as a collateral for personal loan. So please understand that RBI draw a clear red line. So there is a clear red line between, on one side we have gold jewelry. There is a clear red line between gold jewelry, or you call it ornament, and between gold bullion or primary gold. Gold bullion or primary gold or bars. There is a clear red line. So RBI and NBFC regulation prohibit lending against primary gold. Why? Why RBI and NBFC regulation prohibit bank to lend against this gold jewelry and ornament? The reason is bullion is linked to a speculation, right? Please understand, this bullion is linked to a speculation. Either you call it a speculation or you call it hoarding. So bullion is linked to a speculation and hoarding, and it can destabilize gold market and forex dynamic. That's why gold bullion, gold jewelry and ornament cannot be used as cannot collateral, right? It can destabilize the gold market and forex dynamic. So RBI allow lending only against the gold jewelry, ornament, specifically issued gold coin, right? Primary gold is not allowed. Gold bullion is not allowed. Only gold jewelry is allowed. So lending against, see, understand the difference. So because bullion is for speculation and hoarding, right? It can destabilize the gold and forex market. That's why RBI allow lending against gold jewelry only. right? And also ornament, it allowed against ornament, or also it allow against gold coin, right? Important point for examination, please remember, even if loan to value ratio is below 75, suppose LTV is below 75, even if LTV is below 75, primary gold is not allowed. Please understand, primary gold is not allowed, right? So option number A is clearly violation. What about option number B? Extending a 7 lakh working capital loan to micro enterprise without requiring any land or third party guarantee. See, if you look at the RBI MSME direction mandate, it that, collateral free loan up to 10 lakh to MSME. I think you know it very well. Collateral free loan to MSME, right, up to how much? Less than 10 lakh, right? So it is covered under CGT MSE framework and financial inclusion and ease of access. So in this case, the loan is 7 lakh, as you can see. So borrower is micro enterprise. You can see the condition. Please first of all see the condition. 7 lakh loan, borrower is micro enterprise. So obviously no collateral is required, right? So obviously no collateral required, right? So it is full compliant with RBI. So if you look at the option number B, right, it says that extending a 7 lakh working capital loan to micro enterprise without requiring any land or third party guarantee. So what do you think? Yes, it is correct. What about C? Accepting listed equity share as collateral for corporate loan to manufacturing firm. See, RBI allow bank or not NBFC. See, please understand, RBI allow bank, right? Let me write it down. RBI, it allow bank, it does not allow NBFC, right, to accept listed share as collateral. It allow bank to accept listed share. So listed share can be accepted like a collateral, for collateral, right? Subject to margin requirement, subject to exposure ceiling and risk management norm. So subject to margin, exposure and risk management norms, right? So this restriction apply only when lending to NBFC, right, not to manufacturing company, corporate borrower. So option number C, if you look at, yes, it is allowed. So question is violation. It is allowed, right? Accepting listed equity share as collateral for corporate loan to manufacturing firm, right? So RBI allow bank to accept listed share as collateral, subject to margin requirement, exposure ceiling. So this restriction apply only when lending to NBFC, not to manufacturing company or corporate borrower. What about option D? Refusing to accept share as a collateral for loan specifically requested by NBFC. See, RBI circular clearly says that bank must not accept share or debenture as collateral when lending to NBFC. See, what I'm telling you, that suppose this is the bank and bank is lending to NBFC. So in return, bank cannot accept what? Share. Bank can never accept share. Bank can never expect debenture as collateral while lending to NBFC. So therefore, refusing such collateral is means following RBI instruction. This is a regulatory compliance, not a violation. So option number D is the correct. So the question is actually which is violation. Obviously, the correct answer is option A. Option A is the violation. Rest are not violation, right? So super smart way, super smart memory trick to remember here. Just remember it, right? Gold bar. Let me write down. Gold bar, no loan. Just remember it. Gold bar, no loan. So what about jewelry? Yes, jewelry it is allowed. What about ornament? Ornament it is allowed. What about bullion? It is not allowed. One more thing I want to tell you, that MSME less than 10 lakh loan, no collateral is required. And the third point is share plus NBFC is not allowed. Please understand this word. I'm just reiterating down. Repeat in mind, no bullion, right? MSME yes, NBFC share no. So RBI prohibit lending against primary gold bullion, first point. MSME get collateral free loan up to 10 lakh, second point. See, I am repeating again and again. Why? So that these concepts become crystal clear to you. And obviously there is a high chance that this concept will repeat in the examination, in the upcoming examination, so that you can clearly answer them confidently. Many aspirants have cracked the paper, and if you have not seen our previous memory based question, you can check out the entire playlist. I have provided the link in the description section of the video. So bank can accept share from corporate, not from NBFC. From bank and share bank can accept from corporate, but bank cannot accept share from NBFC. And RBI rule are stricter for NBFC, right? Exposure. One more thing, refusal can also mean compliance, not the violation. So these are the points that is clear using this question. Now let's see the question number 4 of today's session. So question number 4 is regarding the Zenith Electronic Private Limited, right? So what does it say? Let's have a look. So basically Zenith Electronic Private Limited, which is the corporate debtor. So this question pertains to, IBC, Insolvency Bankruptcy Code. So this is the corporate debtor, right? Has failed to pay a debt of 50 lakh to Copper Wire Corporation. So basically, Copper Wire Corporation supplied raw material to the Zenith Electronic and did not receive the payment. So Copper Wire had supplied the material but did not receive the payment. So this Copper Wire, they want to start the legal proceeding under IBC 2016 because they have sent multiple reminder, but Zenith has not responded. Now, say simultaneously, Zenith Electronic out 2 crore to the National Trust Bank, which was a loan provided by the construction of provided for the construction of a new factory. So the loan is also due of the National Trust Bank, right? Following the admission of the insolvency application by the IRP is appointed. However, the COC is unhappy with the IRP initial conduct and wishes to replace him, right? So eventually the tribunal passes an order that Zenith Electronic disagree with and they wish to challenge in the highest court. So this is the situation. There are 3 questions. Let's go through the first question. The first question that has been asked, that before approaching NCLT, what mandatory step must operational creditor take? So option A, before Copper Wire, who is an operational creditor. See, Zenith is a corporate debtor and Copper Wire is an operational creditor. Before operational creditor, right, approaches the LC, can file application for CIRP before the NCLT. What is the mandatory preliminary step that they must take according to the text? Option A, seek permission for the Supreme Court, give a demand notice of 10 days to the Zenith Electronic, wait for 180 days from the date of default, obtain an NOC from the National Trust Bank. Very good question. Now, basically in this, to the context of this particular case, let's talk to the part of copper. Copper wire. So basically Copper Wire supplied raw material. So it is an operational creditor. This is called, operational creditor, right? Which means supplier of goods, services, utilities. That's called operational creditor in the terms of IBC. Now, what does IBC 2016 say? IBC 2016 says that, especially section number 8 of the IBC, it says that, an operational creditor must first send a demand notice. He must first send a demand notice to the corporate debtor. He must send demand notice to the corporate debtor, right? So that is section number 8 of the IBC. Section number 8 of the IBC 2016 says that demand notice must be sent to the corporate debtor. And second thing is that give 10 days time. Give 10 days time to pay the debt. Give 10 days time to pay the debt or to raise genuine debt. Right. So without this notice, NCLT will reject the application. If they don't send this notice, what will happen? NCLT will reject the application. Now, why this rule exists? So this is the rule. Demand notice has to be sent and 10-day time to pay the debt. So why this rule exists? Because IBC want to prevent unnecessary insolvency cases. Give the company one last chance to settle. Allow dispute resolution before litigation. Now, if you look at the option number A, it says that seek permission from the Supreme Court. No. Actually, insolvency case begin from the NCLT, right? Not the Supreme Court. Now, just wait a minute. What about option number B? Option number B says give a demand notice. Yes, exactly. This is the point. Wait for 180 days. No. Actually, this 180 days is the CIRP duration. Please note it down. Right. This is not a pre-filing requirement. Option number D, obtain an NOC from the National Trust Bank. See, operational creditor is independent of financial creditor. So option number D is wrong. So what we learn from the discussion is that, operational creditor, right, 10-day demand notice, 10-day demand notice. And if it is a financial creditor, then no notice is required. So in exam, operational creditor, one who supplied goods and services, always knock before entering NCLT. Like in this case, this particular bank is a financial creditor, but this Copper Wire Corporation is an operational creditor and he will always knock. He will always knock before entering LCLT. So operational creditor is the supplier of goods and service. Demand notice under section number 8 is mandatory. Time period is 10 days. This thing we have made clear. Time period 10 days. Demand notice under section 8. If notice is not served, application will get rejected. No permission or NOC required for the bank from the bank. Right. Now the second part of the same question is, if the NCLT passes an order that Zenith Electronic wishes to appeal, what is the correct hierarchy and the timeline for the first appeal? So NCLT has passed an order against the Zenith Electronic, and the company is not satisfied with the decision. They want to appeal against the NCLT order. what is the correct appellate authority and time limit for the first appeal? So the option they have given that appeal to the DRT within 45 days, appeal to Supreme Court, appeal to NCLAT, appeal to the Civil Court. So obviously this is a very simple question. I think you know it very well. The correct answer is none but option number C. Why? Because IBC follow a fixed appeal hierarchy. So there is a fixed appeal hierarchy, right, that IBC follow. How it will look like? NCLT to NCLAT and then to Supreme Court, right? You cannot jump the level. So which body passed the original order? It is NCLT, which is the adjudicating authority. So NCLT is called adjudicating authority, right? AA you can call it. Okay. Therefore the first appeal must go to NCLAT. So appeal must be filed within 30 days. This is also very important. So within 30 days of decision, an NCLAT may allow 15-day extension, right, if sufficient cause is provided. So the maximum 45 days is given, right, is the standard examination time. Now why not Supreme Court directly? Because Supreme Court appeal only against the NCLAT order, and that too on the question of law within 45 days from NCLAT order, right? So the correct answer to this question is option they have given. It says that apply to DRT within 45 days. No, that's wrong. DRT handle bank recovery matter. You know it very well that DRT handle bank recovery matter, right? And it has no role in IBC. It has no role in IBC corporate insolvency appeal. What about B? Appeal to Supreme Court within 60 days. Actually, Supreme Court is a second appeal, not the first. Supreme Court is not the answer. Why? Because it is the second appeal. Option number B is wrong. What about C? Appeal to NCLAT within 30 days. Yes. Please understand. If you look at the option number C, this is the correct one. Right? 30 first and 45 last. That's the rule. 30 C. Option number C, this is the correct one. Appeal to Civil Court. No. Civil Court has nothing to do. Because Civil Court have no jurisdiction under IBC. IBC is a complete code in itself. So the memory trick, let me tell you a super memory trick to remember. Right? CLAT system look like this. NCLT, then NCLAT, and then Supreme Court. 31st, right? 31st and 45 last. This is where you can remember. So 30-day NCLAT, 45-day Supreme Court, right? So NCLT is the adjudicating authority for corporate. First appeal always goes to NCLAT. Time limit is 30 days plus 15-day extension. Supreme Court comes only after NCLAT. Civil Court and DRT have no role in IBC appeal. That's the point. Now the third question of the same case study is regarding the appointment of the insolvency professional. Which of the following is true based on process described in the image? Right. So this is regarding the appointment of the, So once the insolvency application of the Zenith Electronic is admitted, the interim resolution professional, which is called IRP, right, is to be appointed. So which statement correctly matches the legal process under IBC? Option they have given that IRP hold office for entire 180 days duration of the CIRP automatically. Option B, the NCLT appoint the IRP within 14 days of acceptance of the application. Option number C, the committee of creditor has no power to disapprove the IRP. Option number D, civil court have the jurisdiction to grant an injunction against the IRP appointment. Very good question. So basically let's first understand the basic concept. The basic concept is what is the role of NCLT in IRP appointment. What is the role of NCLT in IRP appointment? This is the first thing. So under IBC 2016, once the insolvency application is admitted, the NCLT become active immediately. Right? This NCLT, it become active immediately. As per the code, this NCLT has to appoint an IRP within 14 days. He has to appoint an IRP within 14 days. And this ensures that company does not run without supervision. It ensures that this particular company does not run without supervision. So NCLT has to appoint the IRP within 14 days. So if you look at the option that they have provided, I think B is the correct one. Yes. They are also talking about 14 days. What about A? A says that IRP hold office for the entire 180 days. So this is a very common exam trap. The reality is that IRP initially hold office for 30 days. Within this period, the committee of creditor is formed and COC must approve or COC must replace the IRP. That's the power of COC. 30 days, they can hold the office for 30 days. And within this period, COC must approve and or they can, replace the IRP. Only after COC approval does the IRP continue as RP. If the COC approve that, okay, this person is IRP, okay, I want him to RP also. So if the COC approve that, committee of creditor approve that, IRP should be RP, then only he can continue for the remaining CIRP period. Option number C says that the committee of creditor has no power to disapprove the IRP. Completely wrong. Actually, COC hold the maximum power. COC hold the maximum power. COC can confirm the IRP, replace the IRP with other IRP. Decision requires 66% voting share. What about D? Civil court can grant injunction against IRP appointment. See, IBC bar civil court jurisdiction. Please remember section number 231 of the IBC, which says that civil court cannot interfere. No injunction can be issued action against IBC. Option number D is wrong. So there is a rule. I will tell you a trick to remember the rule. The rule is, just let me write it down. It is called 14, 30, 180 rule. 14 means NCLT appoint IRP 14 days. 30 means initial IRP tenure. Initial IRP tenure is 30 days. And 180 days means total CIRP period. So total CIRP period is 180 days. So that is called 14, 30 and 180 days rule. 14 means NCLT appoint IRP, 30 is the initial IRP tenure, and 180 days is the total CIRP period. So IRP is temporary and COC is powerful. Say in the mind, IRP come first, stay short, COC decide the future. So remember, NCLT appoint IRP within 40 days of admission, and IRP initial term is 30 days only. COC can approve or replace the IRP, and COC total duration is 180 days. Now let's see the next question. Question number next case study, which is related to Sparkle Manufacturing Limited. So the next case study is related to Sparkle Manufacturing Limited, which is an MSc unit. As you can see, they have mentioned that Sparkle Manufacturing Limited is an MSc, and they follow a Nayak committee guideline, right? So Sparkle Manufacturing Limited is an MSc unit, and seeking working capital finance from commercial bank. Company has PAT of 400 lakh, projected annual turnover of 400 lakh for the upcoming financial year, and the unit operate with a standard business cycle of 3 months. Bank follow the Nayak committee method. They have mentioned it. So the question is based on the Nayak committee method, right? What is the maximum bank finance that a Sparkle manufacturer is eligible for? First part of the question, minimum bank finance, minimum bank finance eligibility, and what is the minimum margin the borrower must contribute? Option, they have given 4 options, right? So that's the question. First question is, it is an MSc unit, micro and small enterprise unit. How much minimum working capital finance the bank will give? How much the minimum margin, which is the net working capital the borrower must bring? So the 4 options they are given. So let's first recall the rule, right? Recall the Nayak committee rule. So what does the Nayak committee rule says? It says that, total working capital required is 25% of annual turnover. Please understand. It says that total working capital required is 25% of annual turnover. And one more thing is that out of this 25%, it is bifurcated like this. 20% of the turnover is financed by bank, and remaining 5% of the turnover is the NWC or borrower's margin. So total working capital is 25% of annual turnover. This is further bifurcated into 20% and 5%. 20% will be borne by the bank, and 5% is the NWC, net working capital. So remember the breakup. 25% is equal to 20%, which is the bank contribution, and plus 5% is the borrower contribution. Now in this particular case, as you can see, what is the turnover they have mentioned? So yes, they have mentioned the turnover of 400 lakh, as you can see, right? So turnover is 400 lakh. Now first of all, let's compute the total working capital requirement. TWC, total working capital, which is 400 multiplied by 25%. That will be how much? That will be 100 lakh. So this is only for conceptual clarity, right? Now let's compute the bank finance. So how much bank will finance? So out of the total turnover, 20% bank will finance. So 20% of 400 lakh, which is 80 lakh. That is the minimum bank finance. And what is the borrower's margin? So if you compute the margin, that is 5%. 5% of 400 lakh, which is equal to 20 lakhs, right? That is the minimum margin, right? So if you look at the option 80 lakh and 20 lakh, right? So what is the correct answer? Bank finance is 80 lakh, margin is 20 lakh. So option number B is the correct one. right? So PAT, please understand the formula. This was the simplest question possible. Please understand the formula. PAT method, projected annual turnover method, say 25% of turnover. Bank give 20%. Borrower bring 5%. That's it. Now the second part of the same question is, right, a Sparkle Manufacturing Limited is a MSC unit. Now more than 25% of its turnover is routed through digital modes. Right, they have given that more than 25% of its turnover are routed through the digital mode. We are asked, as per the post demonetization relaxation, right, what will be the revised working capital requirement and the bank credit limit? These two questions are asked. See, option they have given, 4 options they have given. So after the post demonetization relaxation, the limits have been asked. So very important. See what happened after demonetization. RBI allow higher working capital limit, right? After demonetization, what happened? RBI increases the working capital limit under the PAT method. So RBI says that you can route more than 25% of turnover digitally. So what is the enhanced limit? So what RBI say that for MSME with more than 25% digital turnover, right? With more than 25% digital turnover, working capital requirement was made 37.5% of the turnover, right? So those MSME with 25% digital turnover, working capital requirement was 37.5% of turnover. And what was the bank credit? So bank credit was 30% of turnover, right? This is higher than the normal 25 and 20%. I think we have discussed it. Now in this again, turnover remain the same. Turnover is nothing but 400 lakh, which is the same as in the previous case. So 400 lakh, and just compute the working capital required, which is 37.5% of 400 lakh, which is equal to 150 lakh. So that is the total working capital required. Now what about the bank credit? So bank credit is 30%. So bank credit is 30% of 400 lakh, which is equal to 120 lakh. So what is the correct answer? 150 lakh and 120 lakh. So I think option number C is the correct one. So that is our correct answer, right? So what we have learned from this question is that digital bonus mila to limit बढ़ जाती है, right? Normally limit is normal limit. As let's get started with our very first question. As you can see, so they have given that there is a Sparkle electronic manufacturer. Now this particular Spark Gear Electronic, they manufactured a Bluetooth speaker, and the company rely on the team of independent sales agent. So and obviously the sales agent work on the commission. Now their management is considering a structural change to their compensation model. So you can see now selling price per unit have given, actually it is $200 per unit, right? Now variable cost per unit, it's obviously $130, out of which $20 is commission. So then we have the proposed variable cost this much. Original fixed cost is so proposed variable cost means what? No commission, fixed salary increase. Original fixed cost was $450,000. Proposed fixed cost was $6 lakh. Now the question they are asking you, if the Spark Gear Electronic expect to sell 8,000 units next year, which compensation structure will yield a high operating profit and by how much? So they have given the original plan, the proposed plan. Original plan is a commission based, proposed plan is a salary based. They have given original variable cost, proposed variable cost, original fixed cost, proposed variable, proposed fixed cost. So originally they work on the commission. Now they want to change it to the salary model, that is a salary based, or compensation model, that both are the same thing, right? So basically there is a transition in the model that is happening here, right? So you have to tell me that which compensation structure will hold a higher operating profit, whether it is commission based or salary based, and by how much, right? The 4 options have been given. Now let's go through the given selling price per unit, which is $200, right? And also variable cost per unit they have given $130, right? And the fixed cost they have given is how much? $450,000. Fine. Now can you tell me what is the profit per unit? What is the profit per unit? So profit per unit is 200 minus 130, which is equal to $70. Fine. $70 per unit. This is the profit per unit. Now we need to multiply this $70 with 8,000. right? We need to multiply it with 8,000 because they are selling 8,000 unit next year, right? So profit per unit we have got 70 rupees per dollar because selling price minus variable cost is the same as the profit. No, actually, this is not complete profit. To be more precise, I will say contribution per unit, not profit. Profit is a wrong word to say here. Contribution per unit is 70 rupees per dollar. Now, so that is per unit. So if multiply it by 8,000 unit, so how much it will give us? It will give us 5,60,000. So this is the entire compensation. And you know, in the compensation part, there are some part of the fixed cost also. So what we need to do? Out of 5,60,000, which is our contribution, we need to subtract the fixed cost portion. What is the fixed cost they have given? So I think let me show you the fixed cost they have given is you can see, yes. So we are taking original only right now, 4,50,000. So just subtract 4,50,000. So this will give you the actual profit, total profit, right? So total profit is how much? I think it is $1,10,000. So this is the profit under the original condition. Now let's switch our focus to the proposed plan, right? Proposed plan. So in the case of proposed plan, you know, no commission is there. In earlier there was commission, $20 commission was there. Now in the proposed, commission has been removed. Fixed salary has been increased. Earlier fixed cost was how much? $4,50,000. Now it is $6 lakh. Now let's compute. So what about the variable cost? See, variable cost is new. Variable cost is 110. So first of all, selling price in the proposed plan is how much? Selling price is $200 only. Selling price remain unchanged. What is the new variable cost? Earlier it was 130. Now it is just 110 because commission has been removed. Right. Now what is the new fixed cost? So the new fixed cost they have given is $6 lakh. Now first of all, we have to compute. We have to compute the profit, right? So to get the profit, first of all, let's calculate the contribution per unit. So what is the contribution per unit? This is selling price per unit minus variable cost per unit, right? So that is how much? Very simple. See, the contribution per unit is now how much? 90 rupees or $90 per unit, right? So what is the profit? So overall profit is same, just multiplied by 8,000. So 90 multiplied by 8,000. This is your total contribution. Subtract the fixed cost, which is 6 lakh. So that will give us how much? 7,20,000 minus 6 lakh. So that is how much? $1,20,000. That is our profit. Okay. So now proposed plan profit is 1,20,000. Original plan profit was 1,10,000. So obviously you can see proposed plan has increased by $10,000. So proposed plan win by $10,000. So what is the correct answer to this question? The correct answer is proposed plan by $10,000. Option number B is the correct. Right. So just you have to remember this formula and that's it. What is the formula? Right. So let me just write down the formula for you. So just remember that operating profit is equal to contribution per unit multiplied by number of unit subtract fixed cost. And how to compute contribution per unit? So to compute contribution per unit, you have to subtract the selling price minus variable cost. So these two things you have to remember and you can solve any question easily, right? I hope it is clear. Friends, if you are looking for compilation PDF of all such kind that I am explaining, you can check out our CCP comprehensive course, which include PDF, videos, mock tests. As you can see, I have separately created folder. So there are 11 previous year question PDF. You can check out. All these things are available in the form of PDF, covering all the questions which have appeared in the 2025 examination. Then is a separate folder of quizzes and mock tests where you can practice quizzes, time-based quizzes. Like here you can see module-wise quizzes I have created, A, B, C, and D, so on. Right. Inside it, and then further we have created a folder for PDF. In the PDF folder you get PDF module wise arrange A, B, C, D. Inside each module you get unit wise, like unit 1, unit 2 similarly. Inside each unit you get separate theory PDF, separate MCQ PDF, and then further we have videos also. So you can check out the entire course. In the video similarly I have created module wise list and I have uploaded videos covering entire the explanation of the theory content. So you can check out the course in the description section. For those who will enroll early, there is a certain discount, and as the course progresses the price will increase. So you can check out the link in the description section, which is telling you what is the margin, what is the new contribution margin ratio if the company move forward with the salary based plan and remove the 10% commission. So let's rewrite the number after removing the commission, because they want to get rid of the 10% commission. Selling price is $200, right? New variable cost is $110, earlier it was 130, right? So what is the contribution per unit? Contribution per unit is 200 minus 110, which is $90, right? Now what is the CM ratio? The question is about, contribution margin ratio. You know what it means? CM ratio simply means, in the numerator you write the contribution, in the denominator you write the selling price. That's it, right? So let's put in the value. So contribution they have given 90, selling price they have given 200, multiplied by 100, that will be 45% is the correct answer. So the new CM ratio after removing commission is 45%. I hope it was the easiest one to solve, 45%. So you can think of the formula as, C by S, right? CS, contribution over selling price. That means profit per unit from each rupee of the sale, right? So that simply means, profit, right? Profit per unit from each rupee of the sale. So this CM ratio tells us what percentage of the sale become contribution. That is what this ratio tells us. In the numerator we write the contribution, in the denominator we write the sale. What percentage of sale become contribution? And contribution, you know it very well. Contribution formula is selling price minus variable cost. So lower variable cost increases contribution, and obviously it increases the VC decreases, C increases, CM ratio increases. Very important. Now the third part of the question is, at what sales volume would the management be indifferent between the two plan, right? So this is called indifference point. Sometimes the question may be asked, calculate the indifference point. So think of it like this: proposed plan has a higher fixed cost. How much higher? $1,50,000 higher fixed cost, right? And proposed plan has a lower variable cost. Fixed cost higher and variable cost decreases by how much? 20 rupees per unit, or $20 per unit, not rupees. So the question is, how many unit must we sell so that the extra fixed cost is recovered through the saving of $20 per unit? So it is very simple, very important thing. Let me tell you how to find out the indifference point. So indifference unit is equal to, in the numerator you write increase in fixed cost, in the denominator you write saving in variable cost per unit. Put in the value. So increase in fixed cost is how much? $1,50,000. And saving in variable cost is how much? $20. So the ratio become how much? 7,500 units. That is called indifference unit. So at 7,500 unit, both plans give the same profit, right? So at 7,500 unit, right? 7,500 unit is the indifference point. Yes, C is the correct answer. So whenever the question asks you indifference point, just remember the formula. What is the formula? Extra fixed cost upon variable cost saved. This is the formula, right? So indifference point is the point where both plans give the same profit. Formula is delta of fixed cost upon delta of variable cost. Always use absolute difference, right? Very important. Now the third question of the same case study is, if the company switches to the proposed plan and expect to sell 10,000 units, what is the margin of safety? Expressed as a percentage. So again, this question is about, margin of safety. In this question, the company has switches to the proposed plan, and now they expect to sell, budgetary sale is 10,000 unit. What is the break-even point? Break-even point is 6,667 unit. First of all, what is the meaning of margin of safety? Let me just explain. So what is this margin of safety? Basically, it tells us how much actual sale can fall before the company start making loss. How much actual sale can fall before company start loss. That is what, margin of safety. So in simple word, it is a safety buffer between the actual sale and the break-even sale. How to compute the margin of sale? Margin of sale is, budgeted sale minus break-even sale divided by budgeted sale. So now let's put in the value. What is the budgeted sale here? Budgeted sale here is a 10,000. What is the break-even sale here? 6,667 upon 10,000 into 100. that become how much? 33.3%, right? That become 33.3%. So margin of safety is 33.3%. Yes, A is correct. See, budgeted sale minus a break-even sale. So break-even sale is this much, budgeted sale is this much. Just subtract both of them, divide by budgeted sale. That become 33.333%. Now, let's have a look at the next question. So actual minus BEP divided by actual, right? Please remember it. So margin of safety tells us how safe the business is from the loss. And remember, high margin of safety, right? Obviously, it indicate lower risk. And the formula is very simple: actual sale minus break-even sale upon actual sale. Now, next, let's have a look at the next question. So this is again a case study based question. This will help you understand the basic concept here. Let me explain. Let me explain what this question is all about. So they are saying that, Jodak Textile is a gold card holder with an existing Samsung packing credit, that is pre-shipment limit. Last time, lot many questions were asked from pre-shipment. So have a look. So basically, Jodak Textile is a gold card holder exporter and already has EPC. How much EPC? 500 lakh. Now due to sudden export order, they need extra fund urgently. So they want to use the standby limit facility under the RBI gold scheme. Because they have extra order, right, that require immediate funding. So they want to utilize the standby credit limit provision. Now the question is, according to the RBI guideline for the gold card scheme, what is the maximum total credit, regular plus standby, that Jodak Textile can access for this urgent order? And what is the maximum time the bank should ideally take to process this specific request? Very good question. It will check your understanding of the gold card scheme very clearly. So please remember, as per the RBI guideline, what does it say? That bank can allow a standby limit. Bank can allow a standby limit of how much? 20% of the sanction export credit limit. So that means 20% of the sanction export credit limit. Now let's compute the same in this case. So as you can see, what is the assets limit? Assets limit is 500 lakh. This is the assets limit. Right. Now, what is the standby limit? A standby limit is just 20% of this 500 lakh, which is how much? 100 lakh. That is standby limit. So what is the total credit available? Total credit is 500 plus 100, which is equal to 600 lakh. So the maximum total credit that Jodak Textile can access is 600 lakh. Very simple. Access limit is 500 lakh. Standby limit is 20% of that, which is 100 lakh. Just add both of them. This will give you 600 lakh. So the maximum total credit is 600 lakh. What about the time for processing? Yes, very good. See, how much time should the bank ideally take to process this request? So let me tell you the rule. As per the RBI guideline, right, gold card scheme holder, right, basically fast track norm is the fresh sanction. Renewal, enhancement for gold card holder, and it should be processed within 25 days. Even though you know it very well that a standby limit are meant to be quicker, the official RBI benchmark mentioned in is 25 days. What is the answer? 25 days. 600 lakh and 25 days. Right. So maximum total credit is 600 lakh. Maximum processing time is 25 days. That's it. So please remember, a standby credit, a standby limit credit. What is the gold card? For gold card, extra 20% buffer. Now friends, have a look at the next question. So Mrs. Anjali, right, he get a 40 lakh collateral free loan under CGT MSE. Right. Now her business failed and the account turned into default. Right. Due to severe market downturn, the business failed and account turned into default. So we need to find out how much CGT MSE will be paid to the lender and what AGF. So under the enhanced coverage guideline, what is the maximum amount the trust that CGT MSE will settle for the lender, and what is the maximum annual guarantee fee? Right. So that Anjali would be likely be charged compared to general mail entrepreneur. So option they have given 30 lakh AGF of 1.35%, 36 lakh AGF at reduced price, 34 lakh and 40 lakh. Very good question. So let's understand the special rule for the women under CGT MSE, because this question is most frequently asked. So have a look. See, CGT MSE give higher protection to women borrower. Normally, one lender, they may get 75% to 85% guarantee cover. But for women entrepreneur, the scheme give 90% guarantee cover. So obviously, how to find the settlement amount? Very simple. The guarantee settlement is equal to loan amount multiplied by guarantee percentage. So what is the loan amount? Loan amount is 40 lakh multiplied by 90%, which is equal to 36 lakh. So that means in the case of default, CGTMSE pay the lender how much? 36 lakh. Now what about AGF? AGF is called annual guarantee fee. Yeah, if you talk about the AGF, so AGF, you know what is AGF? So AGF is charged by CGTMSE, right, for providing the guarantee. AGF is charged by CGTMSE for providing the guarantee. For women-led unit, you know, AGF is reduced compared to other. That is means, you know, that AGF is a charge, annual guarantee fee charged by the CGTMSE for providing the guarantee. And for women-led unit, AGF, what happened to AGF? It is reduced compared to other, right? So typical range for women entrepreneurs start from 0.37% depending on the loan slab. Whereas for male borrower, it can go up to 1.35%. See, it start with 0.37%, and for male borrower, it can go up to 1.35%. Please remember it. So what is the correct answer to this question? So if you look at the correct answer, see, option number B is the correct one. 36 lakh, 90% cover of 40 lakh, and AGF at a reduced rate. Yes, B is the correct one. So please remember, there is a memory trick, you can just recall it regarding women, regarding CGTMSE scheme. Women, right, 90% till 50. 90% till 50. Just remember the line. Women entrepreneur get 90% cover up to 50 lakh. They get enhanced coverage under the CGTMSE. For loan up to 50 lakh, the coverage is 90%, right? And women borrower pay low AGF starting near 0.37%. Now have a look at the next question. A very good question it is. So for 4 women business-led entrepreneur, right? 4 women business-led entrepreneur. They have applied for 1 crore loan under CGTMSE. Right. They have applied for loan under the CGTMSE. So applicant, they have given that first applicant, we must identify which applicant are not eligible. See, first applicant is a micro unit manufacturing specialized surgical marks. The applicant number 2 is a small scale startup. Applicant number 3 is a retail trade shop, and 4 number is a small scale unit. Right. And obviously it is focused on the vocational and training and education. So basically, based on the CGTMSE eligibility criteria, which of these women-led entrepreneur would not qualify for credit guarantee cover? Option they have given 1 and 2, 2 and 3, 3 and 4, only 4. Very good question. See, basically, CGTMSE cover mainly 2 sectors. So did it give you fully fledged answer, understanding of the CGTMSE? So CGTMSE, it cover primarily for manufacturing sector and the services sector, right? Suppose if a business So let me tell you that suppose there is a business fall in either of these category, either manufacturing or services, right? So eligible. So CGTMSE clearly excludes some category. What are the categories that are not included in CGTMSE? Like retail trade, just not real trade, it is retail trade. Retail trade not included. Education institution not included, right? SHG not included, and agriculture is not included, right? So now let's check each and every applicant. So if you look at the applicant number 1, which is a manufacturing, yes, they are eligible. If you look at the applicant number 2, startup. So this is a service-based business, so they are eligible. Applicant number 3, retail trade. No. Retail trade is specifically excluded. What about vocational training? No. This is also not. Right. So what is the correct answer? Correct answer is option number 1 and 2. That is A. Right. A is the correct answer. See, manufacturing and services in. M and S in. Right. And R and E out. So manufacturing and services in, retail and education out, right? So CGTMSE cover manufacturing and services sector. It exclude retail, trade and education or training business. Please understand it. Now have a look at the next question. Very good conceptual question based on the priority sector lending. See, basically what is happening here, a scheduled commercial bank is there in Mumbai and population is more than 1 crore, and basically they are processing 3 home loan. Right, they are processing 3 home loan. in the recent examination, such type of case study are being asked. So make sure that you practice this question. And if you want a study material for practice purpose, you can check out our course in the description section, or you can WhatsApp me on this particular number. Now friends, let's come back to the question. So applicant number A want a loan of 48 lakh for flat costing 60 lakh. B want a loan of 55 lakh for flat costing 62 lakh. C want a loan of 12 lakh for repairing the old ancestral home. So our question they have given, according to the latest RBI PSL guideline for center with a population of over 50 lakh, which of this loan can the bank classify under PSL? Under the private sector. Applicant A and C, A and B, all of them. Very good question. See, first of all, let me explain you the rule. What does the rule say? So you know that RBI give PSL status to housing loan if suppose home purchase, right, or construction, loan amount is less than 50 lakh and total cost of dwelling unit cost should be less than equal to 65 lakh. So earlier limit was 63 lakh. Now many bank still refers to 65 lakh. What about repair and renovation? So for home purchase, I have just told you, loan should be less than 50 lakh, dwelling unit should be less than 65 lakh. And what about the repair and renovation? So in that case, loan amount should go to maximum 15 lakh. And in this case, they are referring to Mumbai. Mumbai is a city with population more than 50 lakh, right? So if you look at the applicant number A, who is the applicant number A? As you can see, want a loan of 48 lakh for a flat costing 60 lakh. So I think loan is 48 lakh, which is within the 50 lakh limit. And the flat cost is also 63 lakh. This one is also within the 65 lakh limit. So yes, both conditions are satisfied. So yes, A is eligible for PSL. What about B? Want a loan of 55 lakh for a flat costing 65 lakh. But you know, loan cost is more. So obviously, PSL criteria fail. What about applicant C? 12 lakh. So it is within the 15 lakh repair limit. So it is perfectly eligible. So we can see that final answer is option number B. Applicant A and applicant number C, both of them classify under PSL. Right. So remember the memory trick. Let me give you a memory trick to remember this rule. Just remember 50, 65, 15. Right. This is the rule for the big city. Right. 50, 65, 15. For population more than 50 lakh. Suppose the population exceeds 50 lakh. Right. 50 is the maximum loan. 50 lakh is the maximum loan for purchase. 65 is the maximum dwelling cost. And this 15 is the maximum loan for repair. Right, just remember it. I hope till now everything is crystal clear. Now let's switch our focus to the next question that we have. So you can see next question we have here, that Global Trader Limited open an LC. So this question pertains to LC, right? They open a letter of credit for $5 lakh. So you can see first question was BEP, second question was the gold card exporter. So different varieties of question we are doing, right? So Global Trader Limited open an LC for $5 lakh. The terms are CIF and the LC allow for parcel shipment. You can see free on board value they have given 1,80,000. Freight is 15,000. Insurance is 5,000. Similarly, FOB is 2 lakh. Freight is 20,000. Insurance is 6,000. Right? They have given. So what is the closing balance or unutilized limit of the LC after these two negotiations? So basically, two parcel shipment are negotiated. Right? That is what is happening here. These are the two parcel shipment. They are negotiated. We must calculate the closing balance, or either you call it closing balance or you call it the unutilized limit. Both are the same thing. So we have been asked to compute the closing balance or unutilized limit of the LC after these two negotiations. So you can see this LC is CIF. They have given the term are CIF. CIF means CIF means the value to be considered are three: cost, insurance, and freight. Right? Cost, insurance, and freight, three value. One is the FOB value, other is the freight value, and third one is the insurance value. Right? All these things are under CIF. You know it very well. Right? So whenever a LC is opened with CIF term, the bank must consider the total landed cost, not just FOB cost. So for each shipment we compute it. Let's compute it for shipment number 1. If you see the shipment number 1, we have FOB 1,80,000, freight 15,000, insurance 5,000. So 1,80,000 plus 15,000 plus 5,000. How much we get? We get 2 lakh. Right? Now shipment number 2. If you compute the same for shipment number 2, so just add all of them. 2 lakh plus 20,000, 2 lakh 20,000 plus 6,000. 2 lakh 26,000. Right? So total LC utilization is how much? Add both of them. See, first utilize how much? First utilize is 2 lakh. And second utilize is 2,26,000. So overall it become 4,26,000. So opening LC was how much? Think about it. So opening LC was, I think, 5 lakh. Just see, yes, they open an LC for $5 lakh. They have mentioned opening LC is $5 lakh, right? And used, how much they have used? So they have used $4,26,000. So obviously, how much is unutilized? That is what the question is asking you. See, this is the method that we are using to compute it. Unutilized limit is how much? 5 lakh minus 4,26,000, which is equal to how much? 74,000. Zenith Manufacturing, right? So the question is, Zenith Manufacturing is reviewing its year-end financial to apply for a new expansion loan. Some data have been given here, like balance sheet highlight they have given. Cash and bank balance 15 lakh, sundry debtor 25 lakh, inventory 40 lakh, prepaid expense 10 lakh, sundry creditor 30 lakh, short-term overdraft 10 lakh, provision for tax is 10 lakh. So I request you to please take a screenshot of it, because these data will be used to solve the question. And so these are balance sheet highlights. Now capital and long-term debt they have given. Equity share capital 100 lakh, reserve and surplus 50 lakh, 10% long-term debenture, 12% long-term debenture. Now what is the current ratio? First question is current ratio they have asked, right? So how to compute the current? First of all, see, for current ratio we need to identify the current asset. So which one is current asset, right? Then only we can say that this is the current asset. So current ratio. So see, cash and bank balance, current asset. Okay, sundry debtor, current asset. Inventory, current asset. Prepaid expense, current asset. Rest one are not. So just add all of them. 15, 25, 40 and 10. Just let me add it. I'm adding it here. Okay. So 15, 25 plus 40 plus 10. That is equal to 90 lakh. Right? So 90 lakh. Now identify the current liability. What are the CL? See, this sundry creditor, current liability. Short-term balance overdraft, current liability. Provision for tax, current liability. Right? So these are the current liability. So add all of them. 30 plus 10 plus 10. Right? So current liability is how much? 30 plus 10 plus 10, which is equal to 50 lakh. Fine, that is current liability. Now it's very simple. Current ratio is current asset upon current liability. Current asset is 90 lakh. So the question is, under Tandon Committee norms for working capital finance, which of the following statement about the current ratio? Statement about the current ratio in different methods of lending is correct. Option A say the second method of lending generally result in a current ratio of at least 1.33:1. Option B say that the first method of lending can result in a current ratio less than 1.33:1. Option C say the third method of lending is likely to result in a current ratio higher than 1.33:1. Option D say all methods of lending mandate the same amount of current ratio requirement. Friends, these are the four options. Which option do you think is correct? So let's start with option number A. So second method, what does second method say? That borrower, see, let me explain the second method. Second method of Tandon Committee says that borrower must bring in 25% of current asset from the own fund. So suppose if you have 100 rupees as the current asset, right? So you must bring how much? 25 rupees. 25 rupees you must bring yourself, right? So bank give the rest. So this ensure that what is the current ratio in this case, which is current asset upon current liability. So this ensure that your current ratio, like suppose your current asset is 133, right? Let's suppose your current asset is 133. Okay, and current liability is 100. So what is the ratio? That is 1.33:1. So this second method ensure that your current ratio is at least 1.33:1. So current ratio should be greater than or equal to 1.33. This is what is ensured by the second method, right? So that is what option number A is telling you. The second method of lending will result in a current ratio of at least 1.33:1. What about option B? Option B say the first method also, these are the options A and B, A and C, A, B and C, A, B, C and D. So this way you have to answer the correct one. 1, 2, 3 and 4. Which one is correct? Right. Let me again show you the question in one frame. Right. So this is the entire question. You have to find the correct answer. Now let's come to option number B. 75% of the working capital gap. Right. It is not funded on the basis on current asset. Current asset has nothing to do with that. So your ratio can be less than 1.33:1. Right. So your CR can be less than 1.33:1. For example, let's say current asset 120. Current liability is 100. So your CR can be,
1.2 is to 1. As you can see, it is less than 1.33. So option B is correct. Right. Option A is also correct. Option B is also correct. Right. So first method can result in CR of less than 1.33 is to 1. What does option C say? The third method is likely to result in a current ratio higher than 1.33 is to 1. What do you think about this? So let's look at the third method. So if you talk about the Tandon committee third method, what bank does, bank deduct the core capital, core current asset, right? Core current asset, like minimum stock. So before funding, bank deduct this core current asset. This means that you need more own fund, right? You need more own fund. So as you need more own fund in this particular case, and what is current ratio? Current asset upon current liability, right? So since you need more own fund, that's why this current ratio is greater than 1.33, right? Because this current asset is obviously that how much you need for your daily working capital requirement. So that is why, since you need more fund, right? That's why CR is more than 1.33 is to 1. And option number C is also correct. And D say all methods mandate the same current ratio. This is wrong. So what we learn from this discussion is that, if we see that if this is the current ratio, 1.33 is, this is our current ratio. So first method less than this, third method more than this, and second method exactly 1.33 or near about like at least 1.33, right? So first is flexible. So what we can infer is that the correct answer is A, B and C. So which one is correct? Option number 3. So the first method of lending is quite flexible, right? Second method you can say standard, which say current ratio should be 1.33, and third ratio is a little bit tougher, which is the third method, right? So I hope this is clear. This question is clear. Friends, if you are looking for more previous year question starting from this February till now, there are 7 to 8 CCP examination has happened throughout the year. If you want PDF of those previous year question so that you can gauge which topic are important, which kind of question are being asked, so you can look out in our CCP course. For more detail, you can WhatsApp me on this particular number, or in the description section of the video, you can get link to the CCP course. And there are 5 to 6 separate PDF available of previous year questions. You can practice those questions. Now, let's look at one match the following type question that we have. So on one side we have nature of document, other side we have limitation period, and you have to match the following. So options are demand promissory note, that is called DPN. It is written 12 years from the money secured by the mortgage become due. Bill of exchange payable at site 3 years from the date of DP note. Huijans bill of exchange 30 years when the mortgage takes possession, mortgagee take possession. Mortgage foreclosure 3 years when the bill is presented. Mortgage possession 3 years from the due date. So these are the 5 options they have given. These are 2 columns, right? And you have to match both of them. So let's start with DPN. Let's start with the demand promissory note. So as you know, DP note means you promise to pay on demand, right? So whenever I say this DP note means, you promise to pay, right? DP means you promise to pay on demand, right? So limitation starts from the date you sign it, because payment can be asked anytime, right? Payment can be asked anytime. Limitation starts from the date you sign it. So let's suppose that you signed on 1st Jan 2020, right? So limitation end on 1st Jan 2023. So that is 3 years. So please remember, for DP note limitation period is 3 years. So now let's look at the option. So A will be linked to what? Yes, 3 years from the date of the DP note. B. This is the, 1. 1 will be linked to B. Right, let me erase it. Yes, correct. So what we get to know that 1 will be linked to B. Now let's look at 2. 2 say bill of exchange payable at site. So now think about, this is the keyword they have mentioned, payable at site. So it means, pay when shown. That is called payable at site. So, limitation period start when the bill is presented, not when it is drawn. 2 words are there, upon presentation, upon drawing. So limitation period in this case start when the bill is presented. For example, let me give you one example. Suppose you present the bill on 10 February. Suppose you present the bill on 10 February 21. This is the date when you presented the bill, right? So limitation end on 10 February 24. So that means limitation start when the bill is presented, not when it is drawn. So option number 2 will be linked to what? Option number 2 will be linked to 3 years. Again 3 years. 3 years when the bill is presented. Option number D. Yes, 2 will be linked to D. Right. So 2 will be linked to D. Most of the time people confuse whether it is drawn or whether it is presented. So our correct answer is presented. Third, we have Eugen's bill of exchange. So what is the meaning of Eugen's? Eugen's means, bill has a credit period, right? So whenever I say Eugen's, so Eugen's means, bill has a credit period. Credit period, let's say 90 days is there, let's say. So limitation start after that period end. For example, suppose bill date is 1 March 2021, right? 90 day Eugen's is there, right? So it become due on 30 May 21, right? So that is the point. So again, 30 May 2021, it become due. So limitation end on 30 May 24, 3 year again 3 year, because the bill is dated 1 March 21. 90 days is the Eugen's period. So you add 90 days, it comes to 30 May 21, and 3 year limitation is there. So on 30 May 24, it will become due. So what is the 3 will be linked to what? 3 year from what? From the due date. Yes, option number E. 3 will be linked to E. 4 number, mortgage foreclosure. So what is the meaning of foreclosure? Foreclosure means what? That lender want to close borrower right to redeem property. The lender want to close the borrower right to redeem the property, and that is 12 year. 12 year from where mortgage become due, right? So 12 year from the mortgage become due. So 4 will be linked to A, and 5 number is saying that mortgage possession. So see, if the lender take possession of the property, limitation period is 30 year. So longer period because property rights are involved, right? So possession 30 years. So 5C. So 1B, 2D, BD, EAC, yes, option A is correct, right? So please remember, these are the key points. DPN, 3 year from date of DP note. I have explained using example each and every cases. That is the peculiarity of the video. You will not only get to learn the concept, I will explain examples. Using example, you can easily comprehend this thing, right? So please remember it. DPN, 3 year from date of note. Side bill, remember 3 year from presentation. Eugen's bill, 3 year from due date. Mortgage foreclosure, 12 year from money due. Mortgage possession, 30 year when the mortgage is in possession. So demand means, date. Side means so. Eugen's due, foreclosure 12, possession 30. This way you can remember it. Now friends, let's see the next question. For which type of mortgage is registration with registrar of company compulsory under the Companies Act? This is a very good question. It checks your conceptual understanding, whether you know these kinds of mortgage clearly or not. So you have been asked to find out which mortgage, to figure out which mortgage registration is mandatory with ROC. Right. Options are simple mortgage, equitable mortgage, English mortgage, all types of mortgage. And the options are given A and B, B and C, D, A, B and C. Now, this kind of question are being asked in the examination. So friends, now let's start with option number A. What is option number A? Option number A says simple mortgage. Let me explain. What is so peculiarity about simple mortgage? It means the borrower gives the lender the right to sell the property. So this is borrower, this is lender. So borrower is giving right to the lender to sell the property, right? If they don't repay. So is the ROC registration compulsory? Yes. If the mortgage is created by a company, it must be registered. But this option alone is incomplete because the law applies to all types, not just simple mortgage. So what is option number B? Just wait a minute. Yes, option number B say equitable mortgage. So what is the meaning of equitable mortgage? In the case of equitable mortgage, what happened? You deposit the title deed. Suppose you are the borrower and this is the bank which is the lender. You deposit the title deed in right. Title deed has been deposited with the lender instead of registering the mortgage with the sub-registrar. You did not register the mortgage with the sub-registrar. Again, if the company creates this mortgage, ROC registration is compulsory. See, we are talking to the context of company, right? Under the Companies Act. So ROC registration is compulsory, right? But the law does not stop at equitable mortgage. It covers all the time. What about English mortgage? Here, what happened in English mortgage? The borrower transfer ownership to the lender with a promise to repay and get the property back. Same rule. If company register this mortgage, ROC is mandatory. All types of mortgage treated by a company. This is correct. Under section 77 of the Companies Act 2013, every charge or mortgage created by a company on its asset must be registered with ROC. So the correct answer is D. Right? Everything has to be registered. Now the question is, next question, as you can see, which of the following is considered a liquidity ratio? There are different kind of ratio: liquidity ratio, solvency ratio, profitability ratio. They're asking about the liquidity ratio, current ratio, quick ratio, leverage ratio, DSCR. So what is the current ratio? You know it very well. That is current asset upon current liability. So it shows if the company can pay its short-term bill using the short-term asset or not. Right. So do you know the physical significance of this CA? Let me explain. Whether the company is capable of paying the short-term bill that is liability using the short-term asset or not. Whether asset is sufficient to pay the CL or not. That's it. Suppose you have 150 rupees in current asset. Okay. And suppose 100 rupees in current liability. So this shows your current ratio is 1.5:1. Right. So this is a liquidity ratio because it measures short-term payment ability. Yes, option A is correct. What about quick ratio? If you talk about the quick ratio, you know it very well. Quick asset upon current liability. What is quick asset? Current asset minus inventory minus receivable. Right. And remove the inventory, which take time to sell. Again, it is a liquidity ratio. What is the third option they have given? Leverage ratio. See, leverage ratio measures the long-term financial risk. That is, debt versus equity. Right. It is a solvency ratio. To be more precise, we can call it a solvency ratio. It is not a liquidity ratio. What about DSCR? This is not a liquidity ratio because this is DSCR means operating income upon a debt obligation. It shows if you can repay the loan from profit or not. So again, it is a solvency ratio. Right, not liquidity. So the correct answer is A and B. Yani ki option number A, 1 is correct. Right. So a liquidity just means quick cash. That is related to the quick cash. That's it. Now friend, the third question is on your screen. Very good question it is. Can a Hindu undivided family become a partner in a partnership firm under Indian law? And who must execute the partnership document? Exactly same question was asked. Option A, yes, HUF as an entity can directly enter into partnership agreement. B, yes, but only the Karta of the HUF can become a partner on behalf of HUF and execute the document. C, no, HUF cannot be a partner because it is not a legal person under the Partnership Act. D, yes, any co-partner of the HUF can sign the partnership deed without restriction. Very good question. Let's start with option number A. So, HUF as an entity, right? Please try to understand. Very good question it is. So, HUF as an entity can directly enter into partnership. That is what option A is talking about. What do you think about it? Is it correct? No. Why? It sounds logical, but again wrong. Why? Because Indian Partnership Act 1932, it says that only a person can be a partner. Only a person can be a partner. HUF is not a separate legal person for this purpose, right? So HUF itself cannot sign the agreement. Only person can be a partner as per Indian Partnership Act 1932. But if we talk about the HUF, they are not treated like a separate legal entity. They are not treated like a separate legal entity, right? Legal person for this purpose. So that's why option number A is wrong. It says that HUF as an entity can directly enter into partnership agreement. No. Option number B. It says that only the Karta can become a partner on behalf of the HUF. Yes, this is the correct. You know who is the Karta? Karta is the head of the family. He represents the HUF in the business matter. Now, so the Karta signed the partnership deed in a representative capacity. See, the key word here is, you will almost all time see this word written whenever you talk about HUF. Representative capacity. What does it mean? It means suppose Mr. Raj, let me give you one example. Suppose Mr. Raj is the Karta. Suppose Mr. Raj is the Karta of an HUF, right? He signed Raj as Karta of XYZ HUF. He signed like this. So Karta is signing, basically sign the partnership in a representative capacity. That's why B is correct. What about C? C is no, HUF cannot be a partner because it is not a legal person under the Partnership Act. C, partly true but misleading. HUF cannot directly be a partner, but its Karta can represent it. It says that it cannot be a partner. This is completely wrong. Why? Because HUF cannot be a partner, right? Cannot directly be a partner, but its Karta can represent it. So this option is not fully correct. What about D? Yes, any co-partner of the HUF can sign the partnership deed without restriction. This is wrong. Only Karta can sign, has authority. Only Karta has the authority to bind it. See, this is an application-based question. What Karta can do? Only Karta has the authority to bind the HUF. Co-partner cannot sign unless authorized by the Karta. If Karta authorizes the co-partner to sign, then they can. But if Karta did not announce, they cannot sign on the behalf of the firm. That's why option number D is also wrong. What is the correct answer? B is only correct. The question is asking you, Yes, option number B is correct. 2 is correct. Right. So what we learned from this discussion is that, please remember, HUF itself cannot be a partner. Right. Karta, Karta, he is the head of an HUF. Karta can sign partnership deed. Right. That is the point. So Karta is the key point. If the Karta authorize a co-partner to be the partner of the firm, then he can. That's the point. Now friends, let's see the next question. This question is regarding insolvency and bankruptcy code. Very good question it is. Let's try to understand. So the question is, under the IBC, which forum has jurisdiction over insolvency proceeding for a corporate person? Very easy question. NCLT, NCLT, Debt Recovery Tribunal, DRT. Option A only, A and B only, C and D only, all the. Now you might have thought the answer in your mind. What do you think? A, B, C or D? So let's see option number A. NCLT, National Company Law Tribunal. So it is a main authority for corporate insolvency. So the question is asking you about, corporate person. Yes, this is the main authority for corporate insolvency cases. So corporate person, like, companies. Can you give me some example of corporate person? Like, company, like, LLP. These are corporate person. So if a company cannot pay debt, the case goes to NCLT for resolution or liquidation. So this is the correct one. Option A is correct one. What about NCLT? So, NCLT is the appeal authority. So, if you talk about the NCLT, this is the appeal authority. Right. If you are unhappy with the NCLT decision, you can go to NCLT. This one is also correct. What about DRT? See, DRT is for, it handles the insolvency case for individual. That's the difference. It handles insolvency case for individual only. Right. Individual and partnership firm. But not companies. So, this is wrong. What about DRT? DRT is the appellate tribunal for DRT. So basically DRT hear the appeal from DRT. Again apply to individual, not company. So this is also wrong. So correct answer are A and B only. That is the correct answer. So please remember, what we learned from this discussion is that if we talk about the corporate person, so corporate person, basically NCLT is the main and NCLT is the appellate authority. And for individual, it is DRT and DRT. That's the difference. Now friends, very good question we have, and this question is most frequently asked in the examination. Which of the following statement about the credit linked subsidy scheme under the PMAU, Pradhan Mantri Awas Yojana, urban is correct? Right. Which scheme, which option is correct? They have asked you. Option A says that, EWS and LIG beneficiary get a 6.5% interest subsidy on loan up to 6 lakh with a maximum subsidy of 2.67 lakh. B, MIG1 category get a 4% subsidy on the loan up to 9 lakh with a maximum subsidy around 2.35 lakh. Option C, MIG2 category get a 3% subsidy up to 12 lakh, and category 2. Option number D is saying that the maximum eligible carpet area is 330 square meter for AWS, 60 square meter for LIG, 160 square meter for MIG1, and 200 square meter for MIG2. Option E is saying, subsidy is credited upfront to the loan account through nodal agency like NHB, SBI, and UCO. And option F says that CLSS cover only new construction and exclude enhancement of existing dwelling. So options are A, B, C, D, A, B, C, F, A, B, C, A, B, A, C, D, A, B, C, D. Which option do you think is correct? So let's start with option number A. So option number A, it is talking about EWS and LIG beneficiary. Let me explain the rule. So suppose if your income is up to 6 lakh, right, and you are EWS or you are LIG, so you can get 6.5% subsidy, right, on a loan up to 6 lakh. If the loan is up to 6 lakh, you can get 6.5% subsidy, right? And the maximum benefit is about how much? 2.67 lakh. So option number A is correct. See, there are some restrictions here. First of all, first restriction is that, you will get 6.5% subsidy. Income is how much? Up to 6 lakh, 6.5% subsidy. What about option B is saying MIG1? So MIG1, it is, if it is income between 6 to 12 lakh, that is MIG1, right? Then you get 4% subsidy, right, on loan up to 9 lakh. And maximum subsidy is 2.35 lakh. Yes, this is also correct. What about MIG2? So MIG2 is 12 to 18 lakh. Again, we have 3% subsidy on the loan up to 12 lakh. See, the loan limit is also increasing. Here it was 6 lakh, here it is 9 lakh, here it is 12 lakh, right? So LIG gets 6%, 6.5%. MIG1 get 4%, and MIG2 get 3%. So yes, this is correct. What about option D? Option D says about carpet area. So EWS means carpet area is 30 square meter, 60 square meter for LIG. MIG it is 160, and MIG2 it is 200. Yeah, this is also correct. What about option E? Subsidy is credited upfront to the loan account to the nodal agency. What do you think about subsidy? See, subsidy is credited upfront to your loan account by nodal agency. Yes, this is correct. What about F? CLSS cover only new construction and exclude enhancement of existing dwelling. See, this is wrong. CLSS also cover enhancement of existing houses like a room. So F is wrong. What is the correct answer? A, B, C, D, E. Right. Option A. Option 1. So please remember the limits. The limit has been written here. Right. These are the important limits. So EWS, remember. Let me write it down. Please remember the limits. So if it is EWS, right, economically bigger section, or if it is LIG, both, remember they get 6% interest subsidy. Sorry, 6.5%, not 6%, 6.5% on rupees 6 lakh. That is a lower limit. Right. And if it is MIG1, how much interest subsidy they get? They get 4% only on 9 lakh. If it is MIG2, they get 3% only on 12 lakh. And carpet area is how much? 30, 60, 160 and 200 square meter. 30 for LIG, MIG 160, MIG2 160. I hope this question is clear now. Now let's look at the next question. Which of the following statement about MSME application disposal timeline is correct? Very good question. They are asking you to tell me that MSME application disposal timeline. Very good. Option A, Udyam registration via the portal takes 15 to 30 minutes to apply, and the certificate is usually issued instantly or within 2 to 5 days. Option B say that MSME loan application up to 25 lakh are disposed of within 14 working days, while loan between 2 lakh and 50 lakh take 2 to 4 weeks. Option C say larger loan proposal beyond delegated authority may take 8 to 9 weeks for disposal. Option D say MSME Samadhan dispute resolution is always completed within 7 days due to full automation. What do you think is correct? Very good question. So friends, we start with option number A. You apply on the Udyam portal, it takes how much? Only 15 to 30 minutes. And certificate is usually instantly or within 2 to 5 days. So option number A is correct. What about option B? Option B is talking about MSME loan application, loan timeline. So if it is up to 25 lakh, right? So 14 working days. And if it is between 2 lakh and 50 lakh days. Friends, option C is talking about, larger loan proposal beyond delegated authority may take 8 to 9 weeks for disposal. See, the rule is that the loan timeline is like this. If it is less than 25 lakh, then 14 working day, right? And if it is 2 to 50 lakh, then 2 to 4 weeks, right? And if the loan amount is beyond delegated authority, obviously it takes more time, right? Obviously it takes more time. So yes, this is correct. Option C is correct. What about option D? MSME Samadhan, right? Dispute resolution is always completed within 7 days. This is wrong. It is not always completed in 7 days. Manual process and hearing causes delay despite automation effort. No. That's why it is within 7 days wrong. And option E is saying, government effort aim to speed up dispute resolution through technology integration. Yes, this is correct. Right. So what are the correct option? A is correct. B, what about B? B is taking, B is telling you loan up to 25 lakh, 14 working day. Yes, this is also correct. A, B. What about C? C is correct. A, B, C and D, right? Option number 1 is correct. A, B, C and D. Okay. So remember, Udyam registration portal is quick. 15 to 30 minutes it takes only. And you will get certificate in 2 to 5 days. And if it is small loan, 14 days. If it is medium loan, 2 to 4 weeks. If it is large loan, 8 to 9 weeks. Right. That is the timeline it takes. Okay. D is only wrong because, MSME Samadhan 7-day resolution is not guaranteed. So registration fast, loan gradual, dispute slow. That's the point. Now friends, the question is, which of the following correctly represent the revised MSME classification effective from 1st April 2025? Very good question. Now they are asking question on this. Revised MSME, revised MSME classification. So options are, is micro enterprise investment limit is 2.5 crore, turnover limit is 10 crore. Small enterprise investment limit is 20 crore, turnover limit is 80 crore. Medium they are saying 125 crore, turnover is 500 crore. Investment limit have been increased by 2.5 times and turnover have doubled across all the categories. So what do you think? Which option do you think is correct? Let me explain. So if you look at the option number A, it's saying micro enterprise. What is the new limit? So it is 2.5 crore. Yes, correct. So earlier it was 1 crore. Just multiply 1 by 2.5. So that is what changes has been done in the investment. See, whatever limit you have remember, right? Just multiply it by 2.5 in the investment side. And in the turnover side, multiply it by 2 twice. So 10 crore. Earlier it was 5 multiplied by 2 is equal to 10. Now what about the small? So it was 5 earlier, right? It was 5 earlier. So it was 10 earlier, 1, 10, 50. So 10 multiplied by 2.5 will be 25 crore. They have written 20 crore. That's why it is wrong. What about turnover? So turnover is also wrong, right? 50. It was 50 crore in the turnover. Multiplied by 2, it will become 100 crore. They have written 80 crore. This is also wrong. What about medium? So it was 110, 50, right? 50. So 50 multiplied by 2.5. This will become how much? I think it will become, 125. Yes, correct. Investment is 125 and turnover is 110, 50. And here just we have to multiply it by 10. 250, right? So 250 multiplied by 2, 500. Correct. Option C is also correct. What about D? Investment limit have been increased by 2.5 times and turnover have doubled. Yes, this is the perfect thing. C, you need not remember anything new. You remember the old limit. What was the old limit? 110, 50 multiplied by 5, 5 multiplied by 5 multiplied by 5. So this was the old limit, earlier limit. Okay. So this was in the case of investment and this was in the case of turnover. This was a micro, a small and medium. Now what changes has been done, You just multiply each one of these by 2.5. So it become 2.5. It become 25. It become, 2.5 multiplied just become 125. And multiplied by 2, it become 10, it become 100 and it become 500. That's it. So no need to remember anything. Just multiply each of the limits in the investment side by 2.5 and each of the limits in the turnover side by twice. Just take twice. That's it. Now friends, let's see the next question that we have. I hope this concept is clear. Now let's see the next question. The question is, which of the following statement about MSME delayed payment? I think we have discussed this. Okay, no. So question is, which of the following statement about the MSME delayed payment? Yes, this is the beauty of the question. About asking about MSME delayed payment under MSMED Act and related provision is correct. Right. So options they have given. Option A, buyer must pay MSME within 60 days from acceptance of the goods and service or 30 days if no written agreement exists. B say delay beyond 45 days attract compound interest at least 3 times the bank rate. C says MSME Samadhan portal allow MSME to file complaint which are handled by the MSEFC, that is the Micro and Small Enterprise Facilitation Council. And D say under the Finance Act 2023 and Section 43BH, payment delayed beyond 45 days are disallowed as tax deduction for buyer from April 2014. E say company must disclose unpaid MSME due and reason in the form MSME1 under the Company Act rule. F say MSME need Udyam registration or Udyog Aadhar memorandum to avail this benefit. Options are B, C, D, E, F, A, B, C and D. Must pay within 45 days, not 60 days, right? Or 15 days. If no written agreement is there, then 15 days, right? Not 60 days or 30 days, right? So if no written agreement exists, then 15 days, otherwise 45 days. What about option B? So it says that interest on delay. Option B talks about interest on delay. See, every aspect has been taken care of in this particular question. Every aspect about, delayed payment. So what is the interest on delay? So if the payment is delayed beyond 45 days, buyer pay compound at the 3 times the RBI bank rate. Yes, this is the correct one. What about option C? So MSME can file complaint under the MSME Samadhan portal, and case are handled by the MSEFC, that is Micro and Small Enterprise Facilitation Council. This is correct. What about D? D says that, tax disallowance. So option number D is about, tax disallowance. So, from April 1st, 2024, under section 43BH, right? So delayed payment beyond 45 days are not allowed as tax deduction for the buyer. This is correct. What about option E? Option E is about disclosure. That company must file the form MSME 1 showing unpaid MSME dues and reason under Companies Act rule. What about F? F is also correct. It is all about registration. So MSME need Udyam registration or Udyog Aadhar memorandum. Correct. So what are the correct? A is wrong. B, C, D, E, F is correct. Option number 1 is correct. So remember, let me just summarize the key points. These are the key points you must keep in the mind. First of all, the payment timeline is 45 days. Under MS, we are talking about, MSME delayed payment. The correct timeline is 45 days on 15 days without agreement. Interest is 3 times the bank rate. Right. Let me highlight it. 45 days and 15 days. First point. Second point is 3 times the bank rate, interest rate. Third point is MSME Samadhan and MSEFC portal. Fourth point is section 43BH. Fifth point is disclosure. Disclosure, I told you, MSME 1 form. Then the next point is registration. Registration is mandatory. So 45-day rule, 3 into RBI bank, 3 into interest, Samadhan, tax disallowance, MSME 1 and Udyam. Just remember this point. Now you can solve it easily. Now the next question is, in the formula for, they are asking you that in the formula for inventory turnover ratio, what come as numerator and what come as denominator? So this is the question. So this question is testing you whether you know the turnover ratio correctly or not. Option A, average inventory. Option B, and denominator is cost of goods sold. Option A, cost of goods sold, average inventory, sales, closing inventory, opening inventory, purchases. So which option do you think is correct? So let's start with option number A. Option number A is wrong. Why it is wrong? Because it's saying average inventory divided by COGS. This is wrong because the ratio should show how much time the inventory is sold, because this is about how much time inventory is sold, how much time inventory you have sold. That is what inventory turnover ratio is all about. But here it is average inventory. This is incorrect. What about B? Yes, this is correct. COGS means the cost of goods actually sold during the period, and average inventory means that is smooth out fluctuation between opening and closing stock. Right, whatever the fluctuation between opening and closing stock is there, that get smoothened out by taking the average. So the correct formula for inventory turnover ratio is, let me write down the formula. The correct formula is COGS divided by average inventory. Let me explain. Suppose COGS is 5 lakh. Right, and suppose average inventory is 1 lakh. Right, so what is the ratio? This ratio is 5. So this means, inventory is sold and replaced 5 times in a period, right? That means how many times inventory get replaced, inventory gets sold. That is what inventory turnover ratio shows us. It shows that, 5 times inventory gets sold and replaced. What about option C? Sales upon closing inventory. This is again wrong because sales value include the profit margin, not just the cost. We need COGS. What about opening and purchase? This is also wrong. The correct answer is, COGS upon average inventory. Okay, and how to find the average inventory? Take the opening stock, take the closing stock, divided by 2, add both of them and divided by 2. Okay, now friends, the question is, which of the following statement is correct about court fee in the Lok Adalat? Option A, a fixed court fee is charged for filing case in Lok Adalat. Option B, no court fee is payable, and if any pending case is settled there, original court fee is refunded. Option C, court fee paid in regular court is never refunded, even if case is settled in Lok Adalat. Option D, parties must pay additional lawyer fee to settle case in Lok Adalat. What do you think? Fees in Lok Adalat. This question is all about. What about option number A? Option number A is wrong. Why? Because Lok Adalat is designed to be cost effective. Right? It is designed to be cost effective and accessible. So no court fee is charged. Yes, B is correct. No court fee. Remember, no court fee plus refund. So if a case from regular court is referred and settled in the Lok Adalat, the original court fee is refunded. This encourages settlement and reduce litigation cost. What about C? C is wrong. Refund is given when a pending case is settled in the Lok Adalat. And what about D? D is again wrong. Party don't need to hire a lawyer for Lok Adalat. It is simple and economical. So no court fee in Lok Adalat. Refund of original fee if case settled there. No extra lawyer fee required. Just remember, Lok Adalat means, low charges, low fee. That's it. Now friends, the question is, which of the following about PSLC is correct? Priority sector lending certificates. Right. What the option they have given you? Option A, PSLC can be issued for any limited period, such as 1 quarter and expire after that the quarter end. IGST is applicable on PSLC traded over the e-Kuber portal, and no transaction fee charged by RBI for using the PSLC module. PSLC include category like PSLC General, PSLC Export Credit, and Export Credit cannot form the part of PSLC General. So which is correct? The question is asking you. So option number A. Option number A is wrong. You know why? Because PSLC are valid till the end of the financial year. Right? It is valid till the end of the financial year, like March 31st. Not just for a quarter. It is telling only 1 quarter. No. It is valid for the entire financial year. Priority sector lending certificate, that is what we call it. Right? And they expire on April 1st, regardless of when issued. What about option B? Taxes. Yes, this is correct. IGST apply on PSLC trade over e-Kuber platform. RBI does not charge any transaction fee for using the PSLC. Option C is again wrong, because actual categories are PSLC General, PSLC Agriculture, PSLC Small and Marginal Farmer, PSLC Micro Enterprise. They have written micro, they have written agriculture, they have written export credit is not there. There is no separate PSLC export credit. Right? Small and Marginal Farmer PSLC is there. Now, what about option D? Export credit cannot form part of the PSLC General Research Plan. Yeah, this is also correct. See, export credit can form part of PSLC General. Under PSLC General, export credit can come. But there is no separate category of export to PSLC. Right? So, the correct answer is option number B. Right? So, remember, these are the other points. So, first point is valid till 31st March every year. Second point is IGST on trade. No RBI fee. Categories I told you, these are the categories: General, Small and Marginal Farmer, Agriculture, Micro, and Export Credit just now I told you. Now friends, this is a question on DCCO. Under the RBI guideline, deferment of date of commencement of operation will not be treated as restructuring if the revised DCCO fall within 3 years for infrastructure project and 2 years for non-infrastructure project. Option number B, they are saying the revised DCCO fall within 2 years for infrastructure project and 1 year for non-infrastructure project. Option C, that the revised DCCO fall within 1 year for infrastructure project and 2 years for non-infrastructure project, and repayment schedule is extended beyond original tenure. Option D, revised DCCO fall within 2 years for infrastructure project and 1 year for non-infrastructure project, and even if other loan terms are modified. Very good question. So DCCO is asked every year in the CCP examination. Please understand the logic. So DCCO mark the start of the commercial operation. That is the full form, right? Deferment of commencement of date of commencement of commercial operation. So what is DCCO basically? It marks the start of the commercial operation. Means from this particular date, our commercial operation is getting started. And if we talk about the deferment, so it means after this interest cannot be capitalized. After this date, interest cannot be capitalized. Right. So deferment means non-deferment of DCCO normally count as restructuring. Right. And it leads to, asset downgrade. It leads to what? It leads to asset downgrade. Right. So basically what it is all about, the day your project officially start earning money. So before DCCO, suppose this is our DCCO. Before DCCO, you can add interest cost to the project cost. That is called capitalization. After DCCO, you cannot add interest to the project cost. Any expense after this date goes straight to your profit and loss account. You cannot capitalize that. Before DCCO, you can add interest cost to the project cost. So now the question is, what happens if you delay DCCO? Right. So DCCO means when you start the operation, your project officially start earning money. That is called DCCO. So if you delay DCCO, normally if you push the DCCO date forward, the bank treat it like restructuring. If you push the DCCO date forward, banks treat it like, restructuring. What is the meaning of restructuring? Restructuring means, your loan account get downgraded, right? Suppose it is standard, right? It becomes substandard. That's it. Negative mark for the credit quality. That's called downgraded, right? Now there is an exception. Exception is that, that if you delay DCCO within limit, your account stays standard. What is the limit? So the limit is, infrastructure project delay allowed up to 2 years from the original DCCO. And if it is non-infra, delay allowed up to 1 year. And the condition is that no other loan term change, same interest rate, same condition. So smart delay are okay if they are within the allowed time and nothing else changes. But big delays or changes, restructuring and downgrading. So see the limit. So how much they are sanctioning, you can see. They are sanctioning housing loan of 60 lakh. Margin requirement they have given 20%, right? This is the margin applicable, right? And RBI has prescribed L2 LTV cap. What is LTV? Loan to value caps. You know it. So considering both margin requirement and RBI LTV stipulation, which of the following is correct? So option number A says that, bank can lend 48 lakh since margin of 20% applies on 60 lakh. Now, let's check this. So friends, what is given here? Let me explain. So margin 20%, right? They have written clearly that margin is 20%. What does it mean? It means the borrower must contribute 20% from their own pocket, right? Borrower must contribute 20% from their own pocket. That is the meaning of saying margin is 20%. So the bank can finance the remaining, right? So bank will finance the remaining 80%, right? Now you think about it. Total is 60 lakh, right? Total, total loan, housing loan is 60 lakh, right? So what is the 80% of 60 lakh? That will be financed by the bank. That would be 48 lakh. So this 48 lakh is, the bank finance. Now let's look at the option. So the bank can lend 48 lakhs since margin of 20% apply on 60 lakh. So this look correct from the margin side. But wait, we also have to check the RBI LTV. We also have to check the loan to value ratio. So option A is half correct, only margin side, but RBI rule has not been mentioned. That's why it is incorrect. What about option B? It says that bank can lend 54 lakh as RBI allow maximum 90% LTV up to 30 lakh and margin take care of the rest. This sound tempting, but let's check carefully. What RBI says, RBI says that 90% LTV, right? RBI stipulate that, 90% LTV, it apply, right? Only for loan up to 30 lakh. So loan if up to 30 lakh, only then, 90% LTV will apply. But here, what is our loan amount? Our loan amount is 60 lakh. Clearly you can see. Let me show you. You have seen, right? Our loan amount is 60 lakh. So RBI says that if the loan amount is minimum less than 30 lakh, then 90% LTV will apply. But in this case, our loan amount is 60 lakh. So this fall in the slab of, there's a slab. It fall in the slab of 30 to 75 lakh. This slab it will fall. And for this slab, what is the LTV? Remember, let me write it down. So if it fall in 30 to 75 lakh slab, in that case, our LTV is how much? It is 80%, maximum 80%. This is the maximum that RBI can permit. So now 54 lakh. So here what is written 54 lakh? How much is the 54 lakh? It is the 90% of 60 lakh. So this is wrong. This is not allowed. That's why option number B is also wrong. Now option number C, have a look. Option number C is that bank can lend 48 lakh, but the sanction must also comply with RBI maximum 80% LTV norm applicable for this slab. Let's check this. So margin say 20% borrower contribution, right? What margin is saying? Margin is saying that 20% borrower contribution. That is what margin means, right? Margin means borrower contribution, which is 20%. If you find 20% of how much? 20% of, 60 lakh, that would give 48 lakh. So this 48 lakh is the bank finance. 48 lakh is the bank finance, right? So RBI say for 30 to 75 lakh loan, RBI says that for this range loan, right? What about the maximum LTV? Maximum LTV is also 80%, which is again 48 lakh. So now you see both the margin rule as well as the RBI LTV rule are both satisfied in the same value. That's why this is our correct option. Option number, let me show you. Yes, C is the correct answer. Right. Because this both satisfy. Margin rule also satisfy. And LTV rule also satisfy. This is the perfectly correct answer. What about option D? Option D says that the bank can lend 45 lakh because above 75 lakh loan can attract 75% margin LTV and banks should follow them stricter norm. Careful here. Our loan amount is 60 lakh. That fall in the range of 30 to 75 lakh. This slab it fall. Not above 75 lakh. Right. So 75% rule does not apply here. Hence option number D is wrong. So final answer is option number C. So what is the learning from this question? Must see. First of all, we learned is that margin is the borrower contribution. Remember it. Margin is the borrower contribution. Right. So here 20% is the margin, which means bank can give maximum 48 lakh. Now you must know the RBI LTV rule. What is RBI LTV rule? It says that if loan amount is less than or equal to 30 lakh, right, in that case LTV will be 90%. If it lie between 30 to 75 lakh, then LTV maximum will be 80%. If it is above 75 lakh, then maximum LTV will be 75%. Just remember this LTV rule, super important. Maximum chance of repeating it in the upcoming examination. If you really think that this video is really helpful for your understanding, please hit that like button. So friends, remember, whenever you calculate housing loan limit, always check both margin requirement as well as RBI LTV cap. That way you will never get confused. Friends, if you are looking for study material for CCP, sure sort of study material which will helpful in the upcoming examination, you can clearly look out for our courses. In the description section of the video, you can check our CCP course. You can WhatsApp me on this particular number to get more detail regarding availing the course. 8292857381. Now friends, let's look at the question number 2. So now in this slide, we will talk about important MCQs on priority sector lending certificate. In short, we also call it, PSLC. Right. We call it PSLC. Priority lending lender certificate. Right. So the question is, which of the following statements are correct regarding the PSLC and bank loan to MFI? Option number A says that PSLC remain valid till 31st March and expire on April 1st. Option number B say that, bank can classify PSLC only if the underlying loan are eligible under the RBI priority sector norms. Option C say that bank can lend to registered NBFC MFI societies trust for on lending to individual SHG and JLG. Option number D say that PSLC may be issued for multiple quarter but expiry is still end of the financial year. Answer choices are A, B and C, B and D, A, B, C and D and A and C only. Very good question. Let's answer it. Let's look at option number A. Option number A is true. No matter when you buy the certificate, April, September, February, it will expire on 31st March. It will always expire on 31st March. No matter when you buy it. Right. Suppose a bank buy PSLC in January. They can use them only till March 31st. On April 1st, they are gone. Just like a movie ticket that expired after the show. What about option number B? Option number B, it says that bank classify PSLC under respective priority sector lending category. Right. Yes, this is also true. What we have seen, option number A is true. Question is asking which is not true. Not correct. Oh, okay, it's not correct. Option number B is also true. Because, PSLC are like, right to count. You can call them right to count. What does it mean, Basically, these are like, right to count another bank loan as your own priority loan. But if the underlying loan is not genuinely priority sector as per RBI, then buying a certificate will not help. Let me give you one example to make it more clear. Let's suppose that, if a PSLC is issued against a car loan, suppose again car loan, we have issued a PSLC certificate, right, for a luxury car. That won't qualify. Only loan eligible under PSL norms will count. This is called the count rule, right? Right to count. Now, option number C. Bank are permitted to lend to registered NBFC MFI society trust that are member of the RBI recognized SRO for on lending to individual and JLG SHG. This is true. This is correct. Why? Because RBI allow bank to support MFI. You know what is the meaning of MFI? Microfinance institution, right? Because lending to a small borrower, self-help group and joint liability. right? Because they lend to these kinds of category, right? So for example, suppose a bank give money to an MFI. Let me give you one example. This is the bank, and what it give? It give money to MFI, right? And MFI uses it to give 20,000 loan to women SHG, right, in the village. So this indirectly fulfill the bank in the PSL target. Yes, that's why option number C is also correct. What about D? D says that PSL can be issued for multiple quarter, but their expiry will still be the end of the financial year. Again true. You may have PSLC transaction in quarter 1, quarter 2, quarter 3, quarter 4, but expiry does not depend on quarter. It is fixed on 31st March. Right. So friends, what we have seen that all options are correct. Right. So third number is the correct one. So what we have learned from this discussion is that, let me summarize. I told you, first point is regarding the PSLC validity. So remember, it is always ending on March 31st. Remember it. Second point I told you is regarding the, a classification. So, classification only if underlying loan are PSL eligible. Right. Then we talk about loan to MFI or on lending to MFI. So always on lending is allowed if NBFC, MFI, society, trust or RBI recognized through SRO. So if this NBFC, MFI, society, trust, they are RBI recognized through the SRO. SRO means self-regulatory organization. Then they are eligible. And multiple quarter. Yes, this is another point. This is called multiple quarter. Multiple quarter means possible, but expiry is fixed at the financial year. So friends, the key takeaway is that PSLC are valid only till the end of the financial year, and bank must always ensure that PSL eligibility of underlying loan. Also, lending to MFI is encouraged to meet the PSL target. I hope this answered your question. Now friends, let's look at one more important topic. Which of the following statement regarding the creditor turnover ratio is or are correct? Very good question. So friends, options are: a high ratio indicate that the company is prompt in paying supplier, reflecting a strong credit worthiness. Option B, a low ratio may indicate delayed payment, but can also occur if the company enjoyed longer credit period allowed by the supplier. For calculating the ratio, only credit purchase are considered as numerator. If credit purchase is missing, total net purchase can be used. Option D, average account payable is calculated as the average of opening and closing balance of the account payable. If opening balance is unavailable, then closing balance can be used. Very good question. Question is, which of the following is or are correct? Let's look at option number A. Option number A, yes, it is correct. Because this ratio tells us how many times in a year a company clear its dues to the supplier. That is what creditor turnover ratio means. What is the meaning of it? Let's try to understand. Suppose you have a company, you have a firm, and you have taken you have availed some goods, you have availed some kind of services on credit. You have not paid yet. So basically you have to clear your dues. So how many times a year you are able to clear your dues? That is what this creditor turnover ratio is all about. If the ratio is higher, it means company pay quickly and multiple times in a year. Right, simply you can think. So question may be asked in the form of numerical, but if you know the logic, you can easily answer it. Right. So if the creditor turnover ratio is higher, what does it mean? Company pays its dues very quickly, and since it pays its dues very quickly, multiple time in a year. So let me give you one example to learn it. Suppose there is a shop, and that pays its supplier every month. Right. So that is the 12 time in a year. Right. 12 time in a year. So it is a high ratio. So supplier trusts this shop. So yes, option number A is correct, reflecting the stronger credit worthiness. What about B? It says that a lower ratio may indicate delayed payment. Yes, this is also true. When the creditor turnover ratio is lower, it looks like a negative sign because it suggests slow payment. Yes, it is a negative sign because it suggests the slow payment. Right. But sometimes, it simply means supplier have given the company longer time to pay, say 90 days instead of 30 days. So a big retail chain might negotiate longer payment term with supplier. So ratio look low, but it's not a problem. It's not always a problem. It indicates delayed payment, but it can also occur if the company enjoy longer credit period. Yes, supplier has given longer credit period, then it can also occur. What about C? For calculating the ratio, only credit purchase are taken in denominator. See, this is also true. If you talk about the formula of the account turnover ratio, creditor turnover ratio or account payable turnover. So what is the formula? Very simple. right? You write the net credit purchase in the numerator, right? In the denominator, you write the average account payable, right? Now the question is, why only credit purchase? Because payable means money owed to the supplier, and the cash purchase don't create payable, right? That's why only credit purchase. But if the company does not give a credit breakup, then we have to use total purchase as a substitute. Now what about option D? Option number D says that average of the opening balance and sorry, yes, A, B, C, D all are correct. So what we learned regarding the credit turnover ratio or account, or you also call it, account payable turnover. So remember, if this ratio is higher, so high ratio, what it means? Fast payment. High ratio means fast payment, which indicates good credit image. It gives you good credit image. And if the ratio is low, low ratio means delayed payment. Low ratio means delayed payment or long supplier credit, right? Then I told you the formula for account payable turnover. In the numerator, you write the credit purchase. In the numerator, you write the credit purchase. In the denominator, you write the average account payable, right? Average account payable. The credit purchase upon average account payable, that gives you account payable turnover or credit turnover ratio. And sometimes account payable, if you want to find it, so you write the opening balance plus closing balance divided by 2. Means at the beginning of the year, how much was your balance? At the end of the year, how much is the balance? Divided by 2. That will give you average account payable. Therefore, all the 4 statements are correct. So friends, remember, this ratio basically shows that how disciplined a company is in paying its supplier, right? How disciplined a company is paying supplier. High ratio means quick payment. Low ratio could mean delayed or simply longer credit term. I hope you like this explanation. Now friends, let's look at the next question. So question number 3 of today's session is on your screen. As you can see. Yes, the question is regarding the CRILC. Very, very important question. It asks you that which of the following statement about CRILC and SMA categorization is or are correct. Option number A, that bank must report to CRILC all credit information of borrower with aggregate fund limit and non-fund based exposure of 5 crore and above. Means reporting of borrower 5 crore and above. Option number B talk about crop loan exemption. So says that crop loan are exempted from CRILC reporting, but other agriculture loan must still be reported. Option C says that interbank loan are not reported, right? Like NABARD, SIDBI, Exim Bank, NHB, they are not required to be reported. And option number D says that SMA 0, right? SMA 0, 1, 2 classification, right? SMA 0 refers to account not overdue beyond 30 days. SMA 1, 31 to 60 days. SMA 2, 60 to 90 days. And option number E says that failure to report SMA status or concealment of actual account stress may lead RBI to impose accelerated provisioning or other supervisory action. Very good question. Let's look at option by option. First of all, option number A. Right, let's have a look. So basically, this option number A is true. Why? Because, if you talk about the CRILC, it's like a database. It's like a database at RBI where banks share details of large borrower. Right. If one borrower take loan from multiple banks, so CRILC, this act like a database. You can think of it like a database. Okay. And suppose this is a one borrower, right? Suppose this one borrower has taken loan from multiple banks. This is bank number 1, this is bank number 2, this is bank number 3. In that case, what will happen? This CRILC will help RBI, right? And bank see the total exposure. Bank always see the total exposure. Just remember it. Let me give you some example. Suppose a company has 6 crore loan, right? It is spread across 3 banks. Suppose 2 crore here, 1 crore here, and 3 crore here, right? So what the rule says that all bank must report it to CRILC. Every bank has to report to the CRILC, right? That's why option A is correct. What it says that bank must report to CRILC all credit information of borrower with aggregate fund base of 5 crore and above. Option number B says that crop loan are exempted from CRILC reporting. Yes, this is also correct. Why? Because crop loans are seasonal and short term. RBI keep them out to avoid unnecessary reporting load. So, the reason behind it. The reason is very simple. The crop loan are, seasonal. Crop loans are, seasonal. and also they are short term. Right. So RBI keep them out to avoid unnecessary reporting load. But if it is another type of agriculture loan, like tractor loan, warehouse loan, it must be reported. Suppose it is agriculture loan, like tractor loan or warehouse loan, it must be reported. But crop loan need not to be reported under the CRILC, whatever be the amount. Now option C, that exposure like interbank loan, right, including to NABARD, SIDBI, Exim, right, SIDBI, Exim, bank, they are not reported to CRILC. That is option number C. This is also correct, right? Because these are called interbank loan. Interbank loan are more of institutional arrangement. Remember, these interbank loan, they are more of institutional arrangement. These interbank loan, they are more of institutional arrangement, right? Not customer level risk. They are not customer level risk. So if a bank A lend to NABARD, that does not go to CRILC. Very, very important part I'm telling you. That suppose there is a bank A, and this bank A, it lend to NABARD. Bank A lend to NABARD. It will not go to the CRILC. So C is correct. C is also correct. What about D? D says that SMA 0. So SMA categorization. Yes, this is exactly how it works. Let's have a look. So if we talk about the SMA categorization, yes, you can see it here. So SMA 0 means account not yet overdue but showing stress, like check bounce, stock statement delays, right? Then SMA 1 means overdue for 31 to 60 days. SMA 2 overdue for 61 to 90 days, right? For example, let's take one example. Suppose there is a borrower, right, who misses payment by 45 days. He misses payment by 45 days. So as per the rule, it will be covered under SMA 1, right? And if the delay is 75 days, which lie in 60 to 90 days, then it will be under SMA 2. So D is correct. If you look at the option number D, yes, it is correct. What about E? E says that failure to report SMA status or concealment of actual account stress may lead to RBI to impose accelerated provisioning. Yes, that is also true. You see the condition for imposing the accelerated provisioning. RBI is very strict. If a bank try to hide a stress account or to make it book look goods, RBI can force higher provisioning or other penalty. So we can see that all the options are correct. A, B, C, D and E, all are correct. So what we learned from this discussion is that, first of all, I told you about CRILC reporting. Exposure above 5 crore and above. Just remember this point. Exposure above 5 crore and above or 50 million and above. Right. Then I have to talk about crop loan. Crop loan are exempted, but other agri loan must be reported. Then I told you about, basically, I told you about interbank exposure. Remember it, interbank exposure? So they are not required. Interbank exposure, they are not required to be reporting to CRILC. And SMA 0, no overdue. But not overdue, means overdue less than 30 days. SMA 1, 31 to 60 days. SMA 2, overdue between 61 to 90 days. And I told you that, supervising action, that RBI can impose penalty and accelerated provisioning. So friends, remember, CRILC is RBI watchdog for big borrower. And SMA tagging is an early warning system for NPA. I hope you understood this background. Don't forget to hit the like button. This will motivate me to make more such content. Now friends, have a look at the next question that we have. So now we will discuss a very important MCQs on adjudicating authority under the Insolvency and Bankruptcy Code, commonly called IBC. We will check each option one by one, understand in simple word, and then pick the correct answer. So the question is, which of the following statement regarding the AA? You know what is AA? Adjudicating authority under the IBC are correct. Option number A, NCLT act like a AA for insolvency and bankruptcy procedure of the corporate and LLP. Option B, DRT act like a AA for insolvency, resolution and bankruptcy of individual. Option C, appeal against DRT order, that is the part 3 of the IBC. It goes to the DRT. Option D, appeal from NCLT order, go directly to the DRT. Very good question. These are the 4 options that we have. Let's look at option number A. So option number A, it is true. Yes, option number A is quite true. Why it is true? Let me give you the reason. Because NCLT, it handle insolvency for companies and LLP. Yes, right. Like suppose a big company like ABC Limited default, then insolvency case goes to the NCLT. So yes, it is the correct one. What about option B? If you look at the option B, this is also correct. Because DRT or Debt Recovery Tribunal, they look after small entities like individual or partnership, right? So suppose if a small partnership or business or an individual default, then the case go to DRT, not NCLT. Option C, appeal against the order of DRT will be filed before the DRT. Yeah, this is also true. DRT stands for Debt Recovery Appellate Tribunal. It is the highest authority of DRT. So if someone is unhappy with DRT decision under IBC, they can appeal to DRT. What about option D? Option D is wrong. Because here we are talking about the corporate case, right? Here we are talking about the corporate case. So just remember, if you talk about the corporate case, NCLT is the first stage. What is the first stage? First stage is the NCLT. First stage is the NCLT. Appeal goes to NCLT, not DRT. Appeal goes to the NCLT, that is the National Company Law Appellate Tribunal, not DRT. For example, if NCLT passes an order against a company, the appeal cannot go to DRT. It must go to NCLT. So option D is incorrect. Right. So what is the correct answer? A, B and C. Yes, this is the correct one. A, B and C is the correct one. So let's quickly summarize the key point which we have just covered here. So we started with NCLT. I told you that NCLT, the key takeaway is that, corporate goes to NCLT, individual goes to DRT, and also appeal from NCLT goes to NCLT, while the appeal from DRT goes to DRT. You can think of it like this. Suppose this is the corporate and this is the individual. So corporate goes to NCLT, individual goes to DRT, appeal goes to NCLT, and appeal from here goes to the DRT. Right? I hope you like this clear explanation. Now let's do one numerical based question based on it. Let's do one numerical based question. Now very good question it is, and this question was recently appeared in the examination. Let's have a look. So the question says that the borrower has an outstanding loan of 50 lakh, right? And a security worth 20 lakh. The loan is partially covered under CGTMSE for 75% of the unsecured portion. And they are also saying that, account has slipped under the D1 category. You know what is the meaning of D1? D1 means, doubtful one, right? Account has slipped under the D1 category or doubtful one category. So question is, as per the provisioning norm, how much provision should the bank create? So very good question it is. So options are 10 lakh, 12.5 lakh, 15 lakh and 20 lakh. So now let's see the step-by-step explanation here, right? I request you to please pause the video first and first try it yourself. Very, very important thing I'm telling you. If you don't try, then you will not able to understand the key concept. If you do mistake, then you can easily remember it, right? So outstanding loan 50 lakh, collateral is 20 lakh, CGTMSE covers 75%, D1 category. This data have been given. Now, first of all, let me show you the data. What they have given? They have given outstanding loan. How much? 50 lakh. Okay. So this is the total amount that borrower owes. Then we have the secured portion. How much is the secured portion? 20 lakh. Because collateral worth 20 lakh is available. Now, D1 category. So for D1 category, RBI says that for secured portion, provisioning to be done is 25% of the secured. That is what RBI say. That is the provisioning. 25% of secured. Now, can you tell me what is the unsecured portion? What is the unsecured portion? Very simple. 50 minus 20. Right? 50 minus 20. So how much? 75% of unsecured. 75% of unsecured means 75% of 30 lakh. What would that be? 75% of 30 lakh is how much? So it will be, I think 22.5 lakh. Right? So that means government guarantee cover 22.5 lakh. Now, what is the bank net unsecured exposure? So net unsecured exposure is how much? Very simple. 30 minus 22.5, which is equal to 7.5 lakh. Right. So now the question is, how much is the provisioning? How much is the provisioning or unsecured? So unsecured, we have 100% provisioning. 100% of 7.5 lakh. That would be 7.5 lakh. Right. So if we talk about the total provisioning, if you look at the total provisioning, it is how much? Secured is 5 lakh. Unsecured is 7.5 lakh. So total become 12.5 lakh. That is why 12.5 lakh is the correct answer. Yes, let's look at the correct answer here. The correct answer is 12.5 lakh. So we have to separately calculate, right, for secured and unsecured. So what we learned from this discussion is that, remember, For secured portion, right? For secured portion in D1, provisioning is 25%. For unsecured portion, provisioning is 100%. If a guarantee like CGT-MSE is available, reduce the exposure accordingly, right? And total provisioning is sum of all of them. So that is how, because of this CGT-MSE coverage, right? Earlier one secured was 30 lakh. Now it reduced to just 7.5 lakh. That's why it is zero. So friends, the key takeaway is that always split the loan into secured and unsecured. Apply RBI provisioning percentage and don't forget to adjust for guarantee schemes like CGT-MSE. I hope this is a clear explanation to this particular question. Now, let's look at the next question. Question is asking you, which of the following statement about the leverage ratio is or are correct? Option number A, the commonly accepted leverage ratio is calculated as total outside liability by tangible net worth, where TNW is net worth minus intangible asset. Option B, it says that a conservative approach to leverage considered adjusted TNW, which exclude loan, advances and investment in group associate subsidiary company. Option C, the term debt equity ratio can indicate the ratio between debt and margin in a project financing or long-term debt divided by net worth in an existing company. And option D, in financial or media analysis, solvency is tested like or total outside liability divided by net worth expressed as a plain ratio. Now let's start with option number A. So if you talk about the option number A, it says that, let me give you one example to give you a clear picture of it, how it works like, right? So here, let me give you one example. Let's suppose that a company has 100 crore liability, 100 crore liability of a company, and the net worth they have is 50 crore. Fine. But out of this 10 crore, right, out of this 10 crore is goodwill. And you know goodwill is a kind of intangible asset, right? So what is the tangible net worth? Tangible net worth is how much? Very simple, 50 minus 10, which is equal to 40 crore. That is our tangible net worth. Simple. Out of net worth, you subtract the intangible, you will get tangible. 40 crore is the tangible net worth. So leverage ratio is what you know. This 100 divided by 40, liability divided by 40, which is equal to 2.5 times. So it means that for every 1 rupees of the real money owner puts in, company has borrowed 2.5 from outside. So this denominator shows what? 40 crore. 40 crore means what? 40 crore is your tangible net worth. Tangible net worth means for every 1 rupee of the real money puts in, company has borrowed 2.5 from outsider. That is the liability, right? That is what leverage ratio tells you. How much leverage you have taken, how much you have borrowed. Leverage means borrowing power. So in the numerator, we always write how much we have borrowed versus how much net worth. Now, what is option number B says? Option A we have just discussed. Option B says that a conservative approach to leverage considered adjusted TNW, which exclude loan, advances, investment in group, associate subsidiary company. So why? This is correct. Why this is correct? Because if you have invested money in your own group company, that money is not freely available to pay the creditor. So bank cut it off. So let me illustrate it with using an example. Let's say that TNW is 40 crore. Tangible net worth is suppose 40 crore, right? But you have rupees 5 crore. So 5 crore invested in your sister company. So 5 crore has been invested in the sister company. So what would be the adjusted TNW? So adjusted tangible net worth would be how much? Very simple. 40 minus 5, which is equal to the 35 crore, right? So it gives a strict picture, right? It gives you a strict picture. Now what about option number C? Option number C says that, it says that the term debt equity ratio can indicate the ratio between debt and margin in a project financing or long-term debt versus net worth in an existing company. So you see, if you have a new project, try to understand. If you have a new project, that suppose project cost is 100 crore, right? So let's take one example to illustrate it. Suppose we have a new project and the cost of project is suppose 100 crore, and suppose the debt which we have taken is suppose 670 crore, and the promoter margin, or we call it equity, is 30 crore obviously. So what is the debt equity ratio? This is 70 upon 30, which is equal to 2.33. This is for new project. Suppose we have an existing company. If it is an existing company, suppose long-term loan is 60 crore, net worth is 40 crore. In this case, debt equity ratio is how much? And it is nothing but 60 upon 40, which is equal to 1.5. Right. So it has two meaning. That is the correct one. Right. D can indicate the ratio between the debt and margin or long-term debt versus net worth. Yes. This is also correct. What about D? In financial or media analysis, solvency is tested like total outside liability divided by net worth. So you will often read the headline like company X has solvency ratio of 2.8. So what does it mean when I say company X has solvency ratio of 2.8? It means that for every 1 rupees of its money, company owes 2.8 to the outsider. So what we learn from this discussion is that, all the four options A, B and C, G and are correct. Yes, all the four options are correct. So for correct answer is 4. So what we have learned, let me summarize. First we talked about the leverage ratio for housing loan. Which of the following correctly matches the population of the center with the maximum loan amount and the dwelling unit cost? So 4 options have been given. Option number A, population over 5 million, loan limit is 50 lakh, dwelling unit cost 63 lakh. Option B, population more than 1 million up to 5 million, loan limit 45 lakh, dwelling unit cost 57 lakh. Option C, population less than 10 lakh, loan limit 35 lakh and dwelling unit cost 44 lakh. Options they have given A and B, B and C, A, B and C and A and C. So now tell me which option do you think is correct? So it is a very good question. First of all, let's see the core idea. Bank have a special rule for giving housing loan under priority sector lending. And the loan limit and the house cost depends on the population of the city as well as the town. So there are 3 categories to remember. The first category we have is the big cities, right? So big city with population more than 5 million. So in the case of big cities, having population more than 5 million, loan limit is how much? Loan limit is 50 lakh. House cost is how much? House cost is 63 lakh. If it is a medium city means population lying between 1 million to 5 million, right? So if it is a medium city, then the loan limit under priority sector lending is how much? This has been revised. Earlier it was different. Loan limit is 45 lakh and house cost is 57 lakh. And if it is a small city means population less than 10 lakh, right? So in that case, loan limit is 35 lakh and house cost is 44 lakh, right? So all these, now let's look at this option number A. Option number A is correct. Population more than 5 lakh, right? That 5 million, that is big cities. Loan limit is 50 lakh, dwelling unit is 63 lakh, correct. This is the correct answer. Option number B, yes, population more than 1 million up to 5 million. So lying between 1 to 5 million, right? So loan is 45 lakh and dwelling unit is 57 lakh. This is also correct, right? Option C, less than 10 lakh. So it is a small, loan limit 35 lakh and dwelling cost 44 lakh. So I can see that all the 3 options are correct. A, B and C are correct. So the correct answer is all A and B, A, B and C. So please note it down. I will update in the CCP study material also. I've just updated it. So this is the new lending limit as per the RBI. RBI has revised it on from the 1st April 2025. So please note down this limit. This will help you in the upcoming examination. Friends, if you are looking for 8 to 9 previous year such kind of PDF, you can enroll in our CCP courses, certification course, detail regarding which you can WhatsApp me on this particular number to get more detail. And in this course you will get unit wise theory, unit wise MCQs along with previous year question paper as well as capsule course content. Many aspirants have cracked the paper in their very first attempt using the material, and it is completely updated one as per the revised guidelines, revised updation provided by the RBI. Now have a look at the next question. Question number 2. So just remember, okay, one way to remember, let me give you a trick to remember it. So whenever you think of big, just remember 50, right? Just remember what big means 50. Whenever you think of medium, just think of 45. And whenever you think of small, just think of 35, right? And just add 13. 50 plus 13, 63. 45 plus 12, 57, right? And 35 plus 9, 44. This way you can remember. So 13, 12 and 9, right? 13 to the loan amount, 13, 12 and roughly 10 to 13 for the house cost. So 15, 45 and 35. Big 15, medium 45, small 35. This way you can remember. And 10 to the big 50, you just add 13. To the medium you add 12. To the small you add 9. And you will get the what? You will get lakh house cost, right? I hope this will help you. Please hit the like button if you really think that this trick was really helpful. Now let's look at the question number 2. Question number 2 asks you, that it's all about, stamp duty under the Indian Stamp Act. So what is the big picture, basically under the Indian Stamp Act, which of the following statement is correct regarding non-judicial stamp and adhesive stamp in the context of credit and security documentation? Which of the following is correct? So it is asking you, we have to find the correct one, right? Clearly written. Now let's look at the option. So options they have given: non-judicial stamp are used to pay stamp duty on document like loan agreement, hypothecation deeds, and mortgage deeds executed outside the courts. Option number B says, that adhesive stamp are affixed on central instrument such as bill of exchange, promissory note, and receipt to denote payment of stamp duty. Option number C, they say that a negotiable instrument bearing adhesive stamp of the proper amount duly cancelled is considered duly stamped under the Act. Option they have given A and B, B and C, A, B and C, A and C. Which option do you think is correct? So this is a very good question. Let's try to answer this one. So what is the big picture here? Whenever you create document like, loan agreement, mortgage deed, promissory note, you need to pay stamp duty, right? So whenever you need to create loan agreement and mortgage deed or promissory note, what you need to pay? You need to pay what? You need to pay stamp duty. Okay. So this is a proof that document is valid, legally valid. So there are two main kind of stamp that you should know. The first is called, adhesive stamp. Second is called non-judicial stamp. So what is the non-judicial stamp? Non-judicial stamp, these are, which includes, e-stamping also. E-stamp is also a type of non-judicial stamp. So they are used for document executed outside the court. Yes, it is correct. They are for document executed outside the court, like, loan agreement, like, hypothecation deeds or, mortgage deeds. But if you don't use them properly, your document may become invalid or inadmissible until you pay penalty. Right? You have to pay penalty then if you don't execute them properly. So that we are talking to the context of, non-judicial stamp. Second kind of stamp we have is called adhesive stamp. What is adhesive stamp? These are gummed stamp stuck on the instrument like bill of exchange, promissory note, receipt, share transfer. They show that stamp duty is paid for this specific instrument. And negotiable instrument to the context of adhesive stamp. If the adhesive stamp is of the correct amount and cancelled properly, the instrument is considered duly stamped under the Act. So two things are there. First of all, it should be adhesive stamp. It should be of the correct amount. Correct amount should be written. And in addition to the correct amount, it should be properly cancelled. Cancelled properly. If these two things are there, then they are considered, duly stamped under the Act. Now let's look at this particular question. What do you think about option number A? So option number A is perfectly correct. What about option number B? It says that they are affixed on, yes, correct. Option number C, a negotiable instrument bearing adhesive stamp of the proper amount is considered duly stamped. This is also correct. So we can see both, all the A, B and C are correct. So option number 3 is correct. So one way to remember it, let me tell you that whenever you see this word quote out, think of non-judicial stamp. Quote out, you can think of non-judicial stamp, right? Non-judicial stamp paper. And if you talk about the small instrument, you can think of the adhesive stamp. A small instrument, you can think of adhesive stamp, right? Right. And big document need big paper. A small document means a small sticker. This way you can remember. Okay. So big document like, loan agreement, they need a stamp paper. And a small instrument like bill, they need adhesive stamp. So remember, non-judicial stamp paper, loan agreement, mortgages and guarantee. And adhesive stamp, they are affixed on bill of exchange, promissory note and receipt. I hope this makes the sense. Now have a look at the next question. The next question is on your screen. It says that, as per the RBI Prudential Norm on Income Recognition and Asset Classification, which of the following is true regarding a stock audit requirement? Yes, this question pertains to, a stock audit. It's all about, stock audit requirement. Very good question. So, basically options they have given that non-performing advance account with outstanding exposure of 5 crore and above. So you have to tell which is true. So non-performing advance NPA account with outstanding exposure of 5 crore and above must undergo a stock audit at least once a year by external agency. B says many banks extend this requirement through internal policy to all the large working capital account, often starting from 1 to 5 crore upward. Option C say a stock audit is primarily used to verify the value and availability of the primary security such as a stock and receivable. Now tell me which option is correct. Option they have given A and B, B and C, A, B and C, A and C. Account turns into NPA, right? Non-performing asset. And exposure is 5 crore or more. So RBI says that you should do a stock audit. RBI says that you should do a stock audit at least once a year. You have to do a stock audit at least once a year. right, by an external agency approved by the board. So what do you think about option A? Perfectly correct. Yes, this is exactly what option number A is saying. You have to do external audit by an external agency approved by the board. Now, what about the bank internal policy? Yes, many banks go beyond the RBI rule. They apply stock audit to large working capital account, often starting from 1 to 5 crore. Yes, this is also correct. Why? The main reason is, the main reason behind point B is the risk management, right? Risk management. Now, what is the purpose of the stock audit? So basically, to check the value, to check the availability of the primary security like stock and receivable, right? So B is correct. What about C? Primarily used to verify the value and availability of the primary stock. Correct. So we can see that, all the three statements A, B, and C are correct. So the correct answer will be option number 3. Right. So you can think of this. You can think of it like this. So if it is a 5 crore, if it is a 5 exposure is 5 crore, RBI say do audit. RBI say you should do audit. If it is 1 crore, then bank say better safe. Bank say better safe. And remember, a stock audit, what we check? We check stock and we also check receivable. We check stock and we check the receivable, right? So just remember, RBI mandate annual stock audit for NPA more than equal to 5 crore, and bank often extend it to big account like 1 to 5 crore for risk management purpose. Now friends, have a look at the next question. Very good question related to ECB. So this question is about, external commercial borrowing and the famous 7:1, liability equity ratio. So the question is, under, RBI ECB framework, what does the liability equity ratio of 7:1 signify for borrowing under the automatic route? Yes, there is a liability equity ratio that corresponds to 7:1. What does it signify? Option A says that, it is calculated as total outstanding ECB from the concerned foreign equity holder divided by the equity contributed by that holder. Option B say the ratio apply only when. Option C say that if a foreign shareholder has an equity of $10 million, the maximum permissible ECB under automatic route is normally up to $70 million outstanding from that shareholder. So you have to answer which of the option is correct, right? Obviously it is regarding correct one, right? So of option they have given A and B, B and C, A, B and C, A and C. Means all kinds of permutation and combination they have done. Now, what is the big picture here? Indian company can borrow money from foreign lender. I think you know it very well. That's the role of ECB. Suppose this is a foreign lender. This is a foreign lender and this is an Indian company. So Indian company, this particular company, they can borrow from foreign lender under the RBI ECB rule. So when the lender is a foreign shareholder, RBI say that keep a balance between the loan and equity, right? So loan is a kind of liability. So that should be kept. There should be balance should be kept between loan and equity. And what that balance should be 7:1. If you have taken 7 crore loan, then 1 crore should be equity. Now what is this ratio? It is calculated, total ECB outstanding from that foreign shareholder divided by equity, right? Contributed by that shareholder. Very, very important. See, equity, basically, what is the numerator? It says how much ECB, external commercial borrowing, outstanding from that foreign shareholder. Okay. And in the denominator, you write, equity contributed by that shareholder. How much equity they have contributed? Obviously, if there is a shareholder, obviously they have contributed some equity. Now, equity includes paid up capital, eligible reserve, share premium in foreign currency. Now, when does it apply? It only apply if the total ECB outstanding from a shareholder is more than 5 million. Please remember it. Very, very important limit I'm telling you. If it is exceed 5 million, right, then only it apply. Below 5 million, no ratio cap is there. Suppose, let me give you one example. Suppose a foreign shareholder has $10 million equity. Suppose a foreign shareholder, he has $10 million equity. Maximum ECB external commercial borrowing allowed is how much? That is nothing but $70 million. How come $70 million? 10 multiplied by 7, that is 70. If you borrow more than this, you need approval route. Right. So the under automatic route, it is more than, it is only 7:1. Right. So if you 10 million equity they have for a foreign shareholder, so they can borrow maximum $70 million. That's it. So you can think of 7 soldier guard 1/4. You can think of it like this. 7 soldiers are there and they are guarding 1/4. Right. So that is means, 7 part loan for 1 part equity. For 1 part equity, you have 7 part loan. And remember, cap apply only after crossing the $5 million. This is a very important thing. If it is below $5 million, no cap will apply. Right. So remember, ratio is how to remember the ratio? So what is ratio? Ratio means how much external commercial borrowing done upon equity, right? And apply only if this ratio will apply only if ECB is more than $5 million. So what is the correct answer to this question? Let's come back. So option number is total outstanding ECB from the concerned foreign equity holder divided by equity contributed by that holder. Correct. B, ratio apply only when total ECB outstanding from a foreign shareholder exceed 5 million. Correct. If a foreign shareholder has equity of 10 million, the maximum permissible ECB under automatic route is normally up to 17 million outstanding. Correct. So we can see A, B. Friends, now let's see the next question that we have. The question is about the negative lien, right? So which of the following statement is about a negative lien is context for the bank rate is correct? Option A, negative lien is a borrower written undertaking that a specified asset will not be sold or charged to any other lender without the bank prior consent. B, it does not create a pledge, mortgage or hypothecation and the bank has no automatic right to sell the asset. C, negative lien is treated like a contractual negative covenant offering weaker security comfort than a registered charge and is usually considered additional comfort rather than primary collateral. So options they have given A and B, B and C, A, B and C and A and C. Which option do you think is correct about negative lien? So what is the big picture here? Whenever a bank give loan, let me explain. Suppose this is the bank, right, and it give loan to an individual. Okay, so whenever a bank give loan, they want some security, right? They want what? They want some security. So sometimes what happens, instead of taking a formal charge like mortgage, sometimes bank don't take formal charge. Or suppose bank instead of taking mortgage formal charge like pledge, they take a negative lien. What bank take? They take negative lien as security. So what is negative lien? It is basically a promise by the borrower. Remember, this negative lien, this negative lien is a promise by the borrower. This is a promise by the borrower, right? So now let's look at the statement. So basically, negative lien is a written undertaking by the borrower, and borrower says that I will not sell or give this asset to any other lender without your consent. So the bank get a moral and contractual assurance. So borrower promised that I will not send this particular asset without your consent, right? So what it is not, it does not create a pledge, it does not create a mortgage, it does not create a hypothecation, right? Bank has no automatic right to sell the asset. If the borrower break the promise, the bank can go to the court. What about the secure? So let's look at the option. Option A say negative lien is a borrower written undertaking that is specified asset will not be sold or charged. Correct. It does not create a pledge, mortgage or hypothecation. Yes, correct. It is treated like a contractual negative covenant offering weaker section comfort than a registered charge. So it is a negative covenant, right? Yes, it is a negative covenant, not a strong security. So it is treated like an additional comfort, not primarily collateral. It never treated like a primary collateral. So basically option number D is talking about negative covenant. This is also correct. So we can see that all the options are correct. Correct answer is option number 3. A, B and C all are correct. So how we can remember it? Let me explain. So you can think of negative lien like no lien. Negative means no lien, just a promise. There is a no lien, rather just a promise, right? Or you can also remember it like this: promise, not possession. Just promise, no possession, right? So borrower promise not to sell, not to charge the asset without consent, no pledge, no mortgage or automatic sale right. It is extra comfort, not the main security, right? That is called the negative lien. Now have a look at the next one. This question is pertains to invoice factoring. Which of the following statement about invoice factoring is correct? So you have to identify the correct one. Options they have given: factoring involves sale of trade receivable by a business to a factor at a discount with the factor taking over the collection from the buyer. B says Factory Regulation Act 2011 defined factoring as an acquisition of receivable by assignment for collection or financing. C says assignment of receivable in favor of factor must be filed with central registry under SARFAESI. Options they have given A and B, B and C, A, B and C, A and C. Which option do you think is correct? So you know it very well that business often sell goods on credit, right? So business often sell goods on credit. So that means they wait for customer to pay. But what if they need cash flow? Yes, obviously business they sell goods for credit. But suppose they need the cash flow right now. So then comes factoring into consideration. They take factoring into consideration. It is a smart way to convert invoice into instant money. You have invoice. If you want to convert this invoice into instant money, you can take the help of factoring. So factoring, you know what happened? The business sell its trade receivable or invoice to a factor, which can be bank, which can be NBFC, which can be monitoring company. So that is all about, you know, factoring. So who can be factor? Factor can be bank, factor can be NBFC, or, you know, factor can be factoring company, right? And the factor then collect money from the buyer, right? When the due date comes, and the seller get quick cash, and the factor take the collection risk. If you look at the legal framework, so legal framework is the Factoring Regulation Act 2011. So factoring means acquiring receivable by assignment for collection or financing. Only bank and NBFC registered at factor with RBI can do this as a principal business. And you know, this TRDS platform you might have heard about. This TRDS platform also operate under this framework. And compliance, if you talk about the compliance, so whenever receivable are assigned to a factor, it must be registered with central registry under the SARFAC. So option number A says that it involves the sale of trade receivable by a business to a factor at a discount while the factor take over the collection from the buyer. Correct. The Factoring Regulation Act 2011 defined factoring as an acquisition or receivable by assignment. Correct. You know, assignment of receivable in favor of the factor must be filed with central registry under SARFAC. Correct. So all ABC are correct. Option number 3 is correct. Right. So remember the 3C. So whenever you see this term factor, just remember this keyword: fast cash from future payment. So payment that you will receive in future, and you are getting fast cash. That is how you can remember it. Fast cash from future payment. Right. So remember the 3 C's. Three C is like 3C. 3C means cash now. Cash now means sell the receivable. Right. Then second C stands for compliance. Compliance means register assignment. And the third C stands for certified factor only, which can be bank or NBFC. Right. So factoring means you sell invoice to factor at discount, factor collected, governed by Factoring Regulation Act 2011. Only RBI registered factors are allowed, and assignment must be filled with central registry. All are correct. Now let's look at the next question. This is regarding the PCFC, that is packing pre-shipment credit in foreign currency. So the question is regarding PCFC. Which of the following statement is correct? Option number A: PCFC is a short-term export finance facility normally granted for up to 180 days from the date of the advance. Option B: subject to export order validity, PCFC can be extended beyond 180 days up to 270 days with higher interest and regional office approval. C: in exceptional case, a further extension is permitted up to a maximum of 360 days. Beyond this, if unadjusted, the advance is repriced as a regular domestic loan. So very good question about PCFC. So what is the big picture here? You know that exporter need money before shipping goods. Why they need money? So they obviously exporter need money, you know, to buy goods, right? They want to buy raw material. They want for possession, right? For processing. They need money for processing, for packing. Right. So for all these things, you know, the exporter need money. Right. A bank, and you know, what bank do? Bank gives short-term loan. Right. Bank gives short-term loan, and this short-term loan is given in foreign currency, and that is called PCFC. Right. Packing credit foreign currency. That's the full form. See what is happening here, that you know, before shipping the document, exporter need money for raw material, for processing, for packing, and bank finance this. Bank gives short loan. For that is called foreign currency, that is called, you know, PCFC. Now let's look at the normal tenor. So what is the normal tenor? You know, yes, it is usually given for up to 180 days, right? But this matches the exporter production and shipment cycle. And if needed, bank can extend PCFC up to 270 days. but this come from higher interest rate and regional office approval. Correct. So we can see that option A is correct and option B is also correct. What about C? Yes, in certain cases it can go up to 360 days. Beyond 360 days, if the export has not happened, the loan is converted into a regular domestic loan, right, at the normal rate. So all these three are correct. The correct answer is A, B and C. So this way you can remember. So PCFC initially 180, then 270 and finally 360. And beyond the 360, and this 360 is exceptional case. And beyond 360, it is just regular domestic loan. I hope this makes sense. Now friends, the next question pertains to DLG. That is called default loss guarantee. Default loss guarantee. Which of the statement is correct under the RBI guideline? So option they have given is DLG is a contractual agreement where a third party agree to reimburse a regulated lender for loan losses up to a pre-agreed percentage. B says RBI cap the total DLG cover at not more than 5% of the outstanding loan portfolio and the guarantee must be portfolio level. Option C say DLG cover can only be provided in permitted form such as cash deposit, fixed deposit, bank guarantee in favor of the regulated entity. So what is the big picture here? The big picture is the DLG. DLG stands for sometimes this is also called FLDG. In the context of digital lending, if you see in the context of digital lending we call it FLDG, but it's called DLG, right? So it is a way for the third party, often a fintech partner, to share some credit risk with the bank or NBFC. So using this technique, what happened, some fintech partner, right, what they do, they share some credit risk. What is credit risk? I think you know it. So credit risk sharing is done by the fintech partner. With whom? With either the bank or NBFC. So using the DLG technique, fintech partner can share their credit risk with the bank or NBFC. In short, we can say that if the borrower don't pay, the third party cover part of the loss. So option number A, if you look at, option number A is correct. Yes, obviously it is a contractual agreement where a third party promised to reimburse loan loss up to a pre-agreed percentage of the defined loan portfolio. Option number A is correct. What about B? So bank gets some kinds of protection, right? So it is a contractual agreement where the third party promised to reimburse loan loss upon up to a pre-agreed percentage. What about regulatory cap? Yes, RBI say that DLG cover cannot exceed 5% of the outstanding loan portfolio. So cover cannot exceed 5%. Second point, it must be portfolio level, not loan by loan. Third point, there must be explicit legally enforceable contract. Correct. Option number B is also correct. What about option C? Permitted form and timeline. So DLG can only be given at the cash deposit, fixed deposit or bank guarantee in favor of the regulated entity. So DLG, this guarantee can be given as cash deposit, fixed deposit or bank guarantee in the favor of regulated entity. Suppose a loan get overdue, the guarantee must be invoked within 120 days. Once used, the amount cannot be reinstated. So option number A, B and C all are correct. So you can think of the DLG like this. You can think of, just wait a minute. Whenever you see this word DLG, just remember this word. Don't lose guarantee. Don't lose guarantee, right? So, and remember the three key numbers and word. The first is the 5% cap. Second is the portfolio level. Third is the 120 days to invoke. It takes 120 days to invoke. So remember, DLG is a third party cover first loss risk for a loan portfolio. Cap is 5% of the portfolio, must be backed by enforceable contract. Form can be cash, FD or bank guarantee, invoked within 120 days. I hope that makes sense. Now, have a look at one more question that is related to ultimate Z score, right? So regarding ultimate Z score, they have given X1, X2, X3, X4, X5. You know it very well, right? And this they have given you value of X1, X2, X3, X4, X5, and also so friends, how to compute it? So option they have given. These are the options they have given. You have to compute the Z score, and then you have to classify the borrower accordingly, right? So how to compute the Z score? Let me explain it here. So here, there is X1, X2, X1, X2, X3, X4, X5. X1 is what? Net working capital upon total asset. X2 is what? Retained earning upon total asset, right? X3 is what? X3 is EBIT upon total asset. X4 is what? X4 is market value of equity upon long-term debt. X5 is sales upon total asset. Right? These are X1, X2, X3, X4, X5. Now, what value they have given, as you can see, they have given 0.10, 0.08, 0.12, 0.50, 1.20. Just put into the formula. What is the formula? Let me write down the formula. Z is equal to, the formula is Z is equal to 1.2 times X1, 1.4 times X2, 3.3 times X3, 0.6 times X4, 1.0 times X5. That is the formula. You just have to substitute the value, right? So that would be how much? 1.2 multiplied by 0.10, 1.4 multiplied by 0.08, 3.3 multiplied by 0.12, 0.6 multiplied by 0.5 plus 1.0 multiplied by 1.20. After computation, you will get 2.13, right? And one more thing I want to tell you, that what is the physical significance of this Z? So if the Z value is less than 1.81, it means risk is very high. And if it is larger than 2.99, then it is a safe zone. And between 1.81 to 2.99, it is called gray zone. The next question is, they have asked you that under RBI prudential norm for implementation of a viable resolution plan, that is called RP, what additional provisioning is required if the RP is not implemented within the prescribed timeline? Option A say that that if RP is not implemented within 180 days from the end of the review period, bank must make additional provisioning of 20% on the total outstanding. B say that if the RP is still not implemented within 365 days from the commencement of the review period, bank must make additional provisioning of 15%. Option C say that these provisions are over and above the existing provision held for the account. So what do you think? Option they have given A and C, B and C, A, B and C, A and C. So what do you think about the correct answer? What resolution plan under RBI, what additional provisioning is required? That's the question. Now friends, the big picture is that whenever the borrower is in trouble, bank prepare a resolution plan to revive the account, right? So what does whenever a borrower is in trouble, right? What happen? Bank prepare a resolution plan. The main purpose is to revive the account. RBI say that don't wait, don't delay, right? If you do, you pay extra provision. If you delay, you will pay extra provision. Why? To push bank for timely action. That's why extra provisioning has to be maintained as per RBI. So the first deadline is 180 days. If the RP is not implemented within 180 days from the end of the review period, so suppose the review period ended here. From the end of the review period 180 days, if the RP is not implemented, bank must make additional provisioning of 20% of the total outstanding. The provisioning to be done is 20%. Furthermore, if the RP is still not implemented within 365 days from the review period, right, the bank must make another 15% provisioning, that is 35% provisioning. So these extra provisioning are over and above the existing one, right? So now let's look at the option. Option A says that RP is not implemented within 180 days. The provisioning 20%. Correct. Yes, it is correct. What about B? If RP is still not implemented within 365 days, yes, 35%. Correct. What about C? These provisioning are over and above the existing provision held for the account. Correct. So the correct answer is A, B, and C. All are correct. So memory trick, I can tell you 180 degree, 20%. 365 degree, add 15%. Right. Total is how much? Total is 35%. Delay will cost you first 20 and then 15 more. This way you can remember it. Now friends, let's look at the next question. This question is regarding the pre-packaged insolvency resolution process. Which statement about PIRP for stressed MSME is correct? That is what they are asking you. Right. Option they have given that PIRP apply to MSME with default value up to 1 crore. And beyond this, IBC or other resolution mechanism apply. B says that PIRP follow the debtor in possession model, where the MSME approach creditor with a base resolution plan. Option C says that entire PIRP must be completed within 130 days of commencement and the resolution plan must be submitted. So which option do you think is correct? A and B, B and C, A, B and C, A and C. So basically, if we talk about the PIRP, it is a fast track insolvency process, right? So basically, that it is a fast track insolvency process, right, designed for MSME. It is quicker, it is less disruptive than the regular CIRP, right, less disruptive than the CIRP. Think of it like, MSME stays in control but work with creditor to resolve the stress. Now let's break down it. Option number A is all about, applicability. Yes, correct. It applied to MSME with default value up to 1 crore, correct. If the default is more than 1 crore, regular IBC or other resolution method will apply. So option number A is perfect. It is correct. What about B? Yes, B is also correct. It uses debtor in position model, right? MSME itself approach creditor with a base resolution plan, right? This is MSME, and it is approaching the creditor, and they approach the creditor with the base resolution plan. And this is different from CIRP, which is creditor in control model. What about third? Yes, timeline. Entire PIRP must be completed within 120 days, right, of the commencement, and resolution plan must be submitted to NCLT within 90 days after COC approval, right? Within 90 days after COC approval, resolution plan must be submitted. Please remember it. So yes, it is a time-bound process. So obviously we can see here also A, B, and C all are correct. Option number 3 is correct. So just remember this word. PIRP is equal to 1 crore cap, right? MSME in control and 120-day clock, right? 1 crore MSME score, 120 day to close the door. I hope this makes sense. But listen first. 1 crore MSME score and 120 days to close the door, right? This time you can remember it. Quick rhyme. Now friends, one numerical question let's do. Company detailed financial have been given. Like you can see, basically EBIT they have given 150 lakh. Interest expense they have given 60 lakh. And you have to compute the ISCR, that is interest service coverage ratio. And you have to classify the risk level. So have you heard this word ISCR? It may sound technical. So what is the big picture here? This ISCR tells us how easily company can pay its interest from its operating profit. Right, this ISCR tells us how easily a particular company can pay interest, right, can pay interest from its operating profit, or we can call it EBIT. How quickly it can pay interest from EBIT. One more thing you may remember, that higher ISCR means more comfortable position. Lower ISCR means risky position. So what is the formula for ISCR? It is very simple. ISCR, let me write it down. So under numerator you write EBIT, whatever earning it is doing, and denominator you write the interest expense. Interest expense, right? Interest expense. That is the formula for ISCR. Now in this case, as you can see, EBIT they have given is 150 lakh. Interest expense they have given 60 lakh. So 150 upon 60 is 2.5, right? So ISCR is 2.5. And one thing you must remember, that EBIT upon interest expense, obviously the company might have borrowed, so it might have to pay interest, right? So whether EBIT is sufficient to pay the interest, that is what this ratio tells us. And you must know that, if ISCR is more than 2, it's
affected its capital structure, right? And here is the financial data we are working with. The first is long-term debt, $5 lakh. The next is current liability, $2 lakh. Shareholder equity, $4 lakh. Net income, $50,000, and total asset, $12 lakh. Now the question asks us to calculate the debt equity ratio, that is called DER. And options have been given. There are 4 options. Okay, so now which one is it? So first let's define what we are calculating. We are calculating the debt equity ratio, that is called DER. So this ratio shows the relationship between the company debt and net equity. 2 things are there. Now, the first thing is company debt, and the second thing is equity. So in simpler terms, it tells us how much debt the company has for every dollar of equity. Now to calculate this ratio, we only considered long-term debt. So we are not including current liability in our calculation, just the long-term debt. Right to understand, this is very important. We are including only long-term debt, right? So we will modify our formula like this. DER is equal to long-term debt. Earlier I wrote debt, but now I am writing long-term debt divided by shareholders equity. So now in this case, can you tell me what is the long-term debt? Let me move to the previous slide, and you can see it here. Long-term debt is how much? $5 lakh. So our numerator will be how much? Our numerator will be $5 lakh. And what about the shareholder equity? It is nothing but $4 lakh. So if we divide both of them, what you will get? You will get debt equity ratio which is equal to 1.25. If you divide both of them, you will get 1.25. So the correct answer is option number A, that is 1.25. So now the question is, what does this 1.25 really means? Well, it tells us that XYZ Limited has 1.25 of long term debt for every dollar of equity. यानी $1 इक्विटी के लिए, $1 इक्विटी के लिए, यानी ₹1 इक्विटी के लिए कंपनी एक्स के पास जो XYZ के पास टोटल $1.25 जो है डेप्ट है. तो you can see it clearly that ratio is greater than 1. That means DER is greater than 1. So a ratio D greater than 1 indicates that company is using more debt than equity. Obviously ये ratio क्या indicate कर रहा है? ये company जो है debt ज़्यादा यूज कर रही है as compared to equity to finance its operation. ऐसे केस में क्या होगा कि एक्सपेंशन प्रोजेक्ट लाइकली इंक्रीज द कंपनी रिलायंस ऑन डेप्ट. तो ऑब्वियसली बात है, इन सच केस द एक्सपेंशन project is likely increase the company reliance on debt, which is reflected in the debt equity ratio. तो दोस्तों ये डेप्ट इक्विटी रेशियो को समझना बहुत जरूरी है, क्योंकि ये इन्वेस्टर को और स्टेक होल्डर को एक इंसाइट प्रोवाइड करता है कि कितना रिस्की कंपनी का फाइनेंशियल स्ट्रक्चर हो सकता है. यदि ये रेशियो ज़्यादा है मतलब कि रिस्क ज़्यादा है, खासकर यदि कंपनी स्ट्रगल कर रही है अपने डेप्ट ऑब्लिगेशन को मीट करने के लिए. सो रिमेंबर, हायर रेशियो कुड मीन्स मोर रिस्क, स्पेशली इफ द कंपनी स्ट्रगल टू मीट द डेप्ट ऑब्लिगेशन. So this was about the question number 1. The correct answer is 1.25. Now let's move on to the question number 2. So in this question we are going to interpret the debt equity ratio we calculated the earlier for one XYZ Limited. Okay, so first question is what does the debt equity ratio is of 1.25 indicates about XYZ Limited financial structure? Earlier we have about this answer 1.25. Now it asks to interpretation. Options are: the company is heavily reliant on equity financing, the company is using more debt related to equity, the company has an optimal capital structure, the company has no debt. Equity ratio है यानी DER is 1.25. What does it mean? It clearly means that for every dollar of for every one unit of equity, so it means for every 1 unit of equity the company has 1.25 unit of debt. That is means सिंपल सा मतलब है कि 1 यूनिट इक्विटी के लिए कंपनी के पास 1.25 यूनिट है डेप्ट का. इन सिंपलर टर्म्स, XYZ लिमिटेड इज यूजिंग मोर डेप्ट देन इक्विटी टू फाइनेंस इट ऑपरेशन. दिस इज द की इंडिकेटर दैट कंपनी इज रिलाइंग हैवीली ऑन बोरोड फंड. इसका मतलब यही ना हुआ कि कंपनी जो है हैवीली रिलाई कर रही है किस पे? बोरोड फंड पे रिलाई कर रही है ताकि अपने बिजनेस एक्टिविटी को फिल करें. चलिए ऑप्शन वाइज चलते हैं. पहला ऑप्शन कह रहा है कि कंपनी इज हेवली रिलायंट ऑन इक्विटी फाइनेंसिंग. तो ये सही तब होता जब रेशियो 1 से कम होता, ठीक है, तब ये सही होता. लेकिन इस केस में रेशियो 1.25 है, तो ये ऑप्शन गलत है. ऑप्शन बी कह रहा है कि द कंपनी इज यूजिंग मोर डेप्ट रिलेटिव टू इट्स इक्विटी. ये बिल्कुल सही है. 1.25 रेशियो यही इंडिकेट कर रहा है. ऑप्शन सी कर रहा है कि कंपनी हैज एन ऑप्टिमल कैपिटल स्ट्रक्चर. देखिए रेशियो यदि 1 के आसपास हो ना, तब फिर वाइल रेशियो अराउंड 1 कुड बी कंसिडर्ड बैलेंस. वेदर इट इज ऑप्टिमल डिपेंड्स ऑन इंडस्ट्री, कंपनी गोल्स एंड अदर फैक्टर. ऑप्टिमल है या नहीं ये कंपनी गोल पे डिपेंड करता है, दूसरे फैक्टर्स पे डिपेंड करता है. लेकिन इस कंटेक्स्ट में हम सिंपली इंटरप्रेट कर सकते हैं कि ये रेशियो बेस्ट फिट नहीं है. ऑप्शन डी कर रहा है कंपनी हैज नो डेप्ट. ये तो ऑब्वियसली गलत है. द कंपनी हैज नो डेप्ट ऑब्वियसली विद अ रेशियो ऑफ 1.25. द कंपनी डज हैव अ डेप्ट एंड दिस ऑप्शन इज इनकरेक्ट. So what we can see that this ratio 1.25 suggests that the company is somewhat leveraged. So we can say that this ratio 1.25 suggests that company is somewhat leveraged, meaning it has taken on significant debt relative to its equity. A stakeholder will need to monitor this to ensure that company does not overextend itself and end up in financial trouble, right? So you can see understanding the DER help us in assessing a company financial structure and potential risk. A ratio above 1 indicates a high reliant on debt, which could either be a strategic move or a potential risk depending on the situation. So hopefully this concept is clear now. चलिए आगे बढ़ते हैं हम लोग. क्वेश्चन नंबर 3 पे आते हैं. देखिए ये एक सीरीज था, केस स्टडी था डेप्ट इक्विटी रेशियो पे. इस प्रकार के सवाल आए थे. सवाल क्वेश्चन ये आपसे पूछा जा रहा है कि when a company reduces its debt is specifically how that affect the debt equity ratio. Now suppose the company reduces the debt, so how DER will be affected? So here is the scenario. If XYZ Limited अपने लॉन्ग टर्म डेप्ट को $1,00,000 से कम करना चाहते हैं और शेयर होल्डर के इक्विटी को कांस्टेंट रखना चाहते हैं, तो नया DER क्या होगा? तो सबसे पहले आपको याद रखिए, रिमाइंड कीजिए अपने आप को. फर्स्ट ऑफ ऑल लेट अस रिमाइंड आवरसेल्फ ऑफ द ओरिजिनल DER विच वाज 1.25. वी हैव जस्ट कैलकुलेटेड. सो ओरिजिनली जो हमारा लॉन्ग टर्म डेप्ट था, ठीक है, लॉन्ग टर्म डेप्ट जो था ओरिजिनल, यहाँ पे मैं ओरिजिनल लिखता हूँ. सो ओरिजिनल जो लॉन्ग टर्म डेप्ट था दैट वाज हाउ मच? दैट वाज $5,00,000, राइट. एंड नाउ ओरिजिनल शेयर होल्डर इक्विटी, ओरिजिनल इक्विटी, शेयर होल्डर का इक्विटी जो ओरिजिनल था हमारे पास वो था 4 लाख, राइट. तो ये तो ओरिजिनल वाली बात हो गई. अब क्या हुआ कि इसने डेप्ट को 1 लाख से कम कर लिया, तो जो फाइनल डेप्ट है इट हैज़ रिड्यूस्ड बाय 1 लाख विच हैज़ बिकम $4,00,000, right. It has become $4,00,000 because it has been decreased by 1 lakh. You can see reduces long term debt by 1 lakh. So the shareholder equity remain constant. It is almost 4 lakh only, right. So now can you tell me what is the new DER? So new DER will be how much? This long term debt divided by shareholder equity, which is nothing but 1, right. So the correct answer is 1. Option number A is correct. That is what is the new DER, which is nothing but 1. So this new DER, what does it tells us? Well, now that the debt and equity are equal, XYZ has a balanced capital structure where every 1 unit of equity is matched with 1 unit of debt. This might be more comfortable position for the company as it reduces its financial risk by lowering the amount of debt. Reducing debt can be a smart move for a company if it want to decrease its financial risk, and it definitely affect key financial ratio like the DER. In the XYZ case, bringing the ratio down to 1 suggests a more balanced and potentially safer financial structure. Hopefully this concept is clear now. Now let's come to the next question. Next question is why might a company with a high debt equity ratio be considered a disadvantage? So very good question कि किसी कंपनी का हाई DER है तो वो डिसएडवांटेज क्यों है? Let's go through the option. First option से because it means the company is using more equity financing. This is actually wrong. Actually high DER suggests the opposite. It means company is using more debt, not equity. So option A is incorrect. Option B says because it indicates high dependency on debt which could affect its ability to service the debt in the event of low profitability. So this is the right answer. When we talk about high DER, if we talk about high debt equity ratio, it indicates that the company rely heavily on borrowed fund. What does it indicate? That company rely heavily on borrowed fund. Company is relying heavily on borrowed fund. If the company profit fall, it might struggle to make interest payment and repay the principal, putting it in a risky financial position, right. So high DER, what does it mean? It indicates company rely heavily on borrowed fund, and in such case if profit fall, it might struggle to make interest payment and repay the principal. So this is how this high DER is not considered an advantage, it is considered a disadvantage, right. So this is the correct answer which could have, and suppose the company profit fall, low profit is there, then how company could manage its principal and interest payment, right? It could not manage. So option C says because it suggests the company is not investing enough in the capital intensive project. So while a high ratio could limit a company's ability to invest in project, this is not the direct reason a high debt equity ratio is disadvantage. So this is not the best answer. And option D says because it means the company is highly profitable. So high DER does not directly indicate profitability. In fact, it could be the sign of financial strain if the company is unable to generate enough profit to service its debt. So option number B is the correct one. Right, a high DER shows the company is heavily reliant on debt to finance its operation. While debt can be cheaper source of funding than equity, especially when interest rates are low, it also comes with obligation like regular interest payment and eventually repaying the principal. If the company profit falls, it might struggle to meet these obligations, leading to financial distress or even bankruptcy in several situations. That's why a high DER can be risky, and why company with this kind of ratio might be at disadvantage compared to those with a low ratio. So in summary, while debt can be an effective way to fuel growth, too much of it can put a company at risk, especially if the profit is not stable. So always keep an eye on company debt equity ratio while analyzing its financial strength. So that's the point which we are covered in this particular slide. Let's move on to the next question. The next question says that why the debt equity ratio might not be the best tool for comparing company in different industry. Very good question. So there are 4 options are given. Option A says because different industry have different level of capital intensity. So what do you think? This is the correct answer. Industries like manufacturing. Let's talk about some industry like manufacturing and utilities, which are capital intensive industry. So these industry manufacturing are capital intensive. So they tend to have high DER. They have high debt equity ratio. They tends to have high DER due to large investment in long term asset. Why they have high DER? Because they have large investment in the long term asset. On the other hand, industry like technology industry, or suppose consulting industry. So these industry which are less capital intensive. These industry are less capital intensive. They might have a lower DER, right? They might have lower DER. Why? Because this difference makes direct comparison between companies in different industry less meaningful, right? So option A is the correct one. Option B says because the ratio does not account for market condition. So while it is true that debt equity ratio does not reflect the market condition, this is not the reason it is not applicable for cross industry comparison. Option C says because companies in different industry uses different accounting practices. So different accounting practices can affect financial ratio, but this is not the primary reason that debt equity ratio might not be comparable across industry, right? Option C says because companies in different industry uses different accounting practices. Different accounting practices can affect financial ratio, but this is not the primary reason. Option D says because it can only consider short-term liabilities. Actually, the debt equity ratio focus on long-term debt, not short-term liability. So this option is also incorrect. What is the correct option? The correct option is option number A. So the debt equity ratio reflect how much a debt company is using to finance its operation as compared to equity. However, the amount of debt a company need can vary significantly depending on industry. For example, some industry that requires heavy investment in physical asset like manufacturing, they have typically high DER. This is because they often finance the large investment with debt. On the other hand, service-based industry or technology company might have lower DER. Come on to the next case study that we have, which is related to the PEP, right? Break even point. So let's see the question. The question is like this. ABC Limited manufactures and sell custom made widget, and they want to determine their break even point in units. So here are the financial details given, like selling price per unit is given $10, variable cost per unit is given $6, fixed cost is given $2,000, and the question is asking you to calculate how many that is a break even point you have to calculate. And what is break even point? You know what is this break even point? So this break even point means what? How many unit does ABC Limited need to sell to break even? Friends, if you are preparing for CCP examination, that is IIBF certification course CCP, and if you are looking for any study material, a perfect study material which caters to your need, either in the form of PDF, videos, quizzes, previous year questions, then you can contact me on this particular number. We have a course available for the CCP examination, and this will help you to achieve a good marks in the examination with lower effort. With low effort, you can get the maximum output. So if you are interested in this, kindly WhatsApp me on the number shown on the screen, and in the description section also I have provided the link of the courses. Now let's come back to this particular question. So we have to calculate the break even point in units. So you know what is what is break even point? So see, first of all we will go through the formula, that is fixed cost divided by selling price per unit minus variable cost per unit. right? So this is how we calculate the break even point. So this is by using the formula, right? But I am telling you a best way to solve such type of problem. No, not using the formula, because sometimes if you wrongly wrongly remember the formula, everything will be wrong. So let me give you an insight into this thing. See, try to understand what I'm saying, that suppose you have to draw this type of pie chart. Okay, so this is a circle. Okay, and this complete circle has two parts, right? So there is a selling price per unit, and there is a variable cost per unit, and there is a fixed cost per unit, right? So the total cost will comprise of two things. What is the meaning of this fixed cost? Fixed costs are the costs that do not change no matter how many units you produce. So this will not change, this will remain constant. What is the selling price? This is the amount that ABC Limited charges for each widget. And what is the variable cost? It is the cost to make each widget. See, let me make you understand using this particular circle. So this entire circle represents the selling price, and you know the basic formula, that selling price is equal to cost price plus profit, or it may be loss minus loss, right? This is the thing. Okay, so what you do, you divide this particular circle into two parts. Okay, so this part represents the variable cost. Okay, and if you subtract this selling price minus variable cost, this will give you contribution margin per unit. This will give you contribution margin per unit, or you may represent it by small c. You may represent it by small c. So this portion which I am showing by suppose I take this color. Okay, so this portion is what our called contribution margin. This is called contribution margin. Now if we talk about this contribution margin, let me move on to the next slide. Yeah, so let's come to this slide. Let me erase this thing. Hopefully you have understood what is contribution margin. And see, if we talk about this contribution margin is make up of two things. See, let me draw it again. I think it is not drawn perfectly. Yeah, try to understand this concept. This is very important concept. Once you understand this concept, you can solve any type of break even point question easily. See, this is our contribution margin. This contribution margin is comprises of two things. The first thing, it comprises of fixed cost, and the second thing, it comprises of the profit, right? So two things are there in the contribution margin, that is fixed cost and profit. So what I do, I have just exaggerated this particular portion in the form here, and suppose I draw this is the center, this is the point, and I said this particular point, I said this particular region. Okay, and I also said this particular region. So this portion, suppose it represent our fixed cost, and this portion suppose it represent our profit, right? So you can see this contribution margin, this entire portion contribution margin, it comprises of fixed cost and profit, right? So what is the meaning of break even point? Break even point means a point at which profit is zero. A point at which profit is zero. Now you can see, if the profit is zero, then this shaded region will become zero. Or we can say it quite easily, that this entire fixed cost will become equal to our contribution margin, right? Am I clear what I'm saying? That what is the meaning of break even point? Break even point means this profit is zero, and when profit is zero, this fixed cost will be equal to contribution margin, right? So this is how we will calculate it. So now let's go back to this particular question, and let's dive into how to calculate using this particular thing which we have discussed just now. So see, this entire circle is how much? $10. Okay, and this portion which is variable cost is $6. So this portion will be $4. This is $4, right? Now this $4 is our contribution margin per unit. Okay, and we know at break even point, contribution margin is equal to our fixed cost, and this contribution margin can be written like contribution margin per unit into number of unit is equal to fixed cost. Now you know what is contribution margin per unit, which is nothing but $4. Number of unit we want to know, suppose n is the number of unit, and fixed cost we also know, fixed cost is how much? $2,000. So you can simply calculate n is equal to 2000 divided by 4, which is nothing but 500 units. So this 500 units is our what? This is a 500 units is our break even point. That means, what does it mean? That means ABC Limited need to sell 500 widget to cover all its fixed and variable cost. There will be no profit, but it will be able to cover its fixed and variable cost. At this point, company is not making any profit, but it is not losing money also. It is breaking even. Any sales beyond 500 unit will start generating profit for the company. So understanding break even point is crucial for any business. It helps to set sales target and make informed decision about pricing and cost. Right. Now let's come to the next part of this particular question. Now suppose the next question is, what is the break even point in terms of sales revenue for ABC Limited? Try to understand. Earlier it was asking break even point in units, and we got the answer 500 units. But now the question is in terms of sales revenue. Very good question. So in terms of sales revenue, how can you calculate? It's quite simple. See, you know how many units you require to break even, and you simply multiply the number of units with selling price per unit, right? You will get break even point in terms of sales. How many units are there? 500 units are there. And what is the selling price per unit? Tell me, what is the selling price per unit? It is nothing but $10, right? It is nothing but $10. So the break even point in terms of sales revenue is how much? $5,000. So what does this $5,000 represent? So it is the total amount of revenue that ABC Limited needs to generate to cover both its fixed and variable cost. In other words, if ABC Limited brings in $5,000 from selling its widget, it won't make a profit, but it won't incur a loss either. It will just break even. Right. So earlier we calculated break even point in terms of unit, and now we calculated the break even point in terms of sales revenue. Now let's come to the third part of this particular question. The third part is, what is the margin? What does the margin of safety measure? See, first of all, question is asking what does margin of safety measure, and the next part is what is the margin of safety? That's the point. See, margin of safety, what are the options? The difference between actual sales and break even sale. So this is the correct answer. Margin of safety tells you how much your current sale exceeds the break even point, right? How much this is your current sale. Suppose this is your current sale level and this is your break even point level, right? So essentially it measures how much sale can drop before the business start incurring loss. Option B say the total fixed cost covered by the sale. This is wrong. This sound close, but it's actually not what the margin of safety is. Option C says the profit earned beyond the break even point, while this sound close, but it's actually not margin of safety measure. Option D say variable cost and fixed cost difference. This is not margin of safety, right? So the correct answer is option number A. Let's talk about why margin of safety is important. Imagine your business is doing well and you are selling more than the break even amount. The margin of safety tells you by how much. This is crucial because it shows how much sale can drop before you start losing money. For instance, let me give you an example to make it more clear. For instance, suppose your margin of safety is high. So in that case, you have a larger cushion. You have a larger cushion, right? Which means you can withstand a decline in sale without worrying too much about dipping into loss. On the other hand, a low margin of safety indicates that even a small drop in sale could put you in business at risk. So understanding the margin of safety helps you gauge the financial health of your business. It is a great way to assess risk and make informed decision. So next time you are looking at your sales figure, don't forget to calculate this important matrix, that is margin of safety, right? Hopefully why option A is correct is clear now. Now, why it is important for a company to calculate this break even point? Very good question. So options are to determine the maximum profit that can be achieved. No, this is wrong, because break even point does not tells you about your profit. It is actually covering cost. Option B says to understand the level of sales needed to cover all costs and avoid losses. See, now this is correct answer. The break even point is all about finding out the minimum sales volume required. The break even point is finding the minimum sales volume required to ensure that all the cost, both the fixed and variable, are covered. It is a point where your business is not making a profit, but it is also not incurring any loss, right? Option C says to calculate the amount of debt that can be handled. See, while debt is important consideration for any business, it does not directly relate to the break even point. Option D say to decide the selling price of the product. So setting the selling price involve many factors, but the break-even point is specifically help in understanding the sales volume. So why it is knowing your break-even point so important? It is simply the foundation of financial planning. If you don't know the minimum amount of sale you need to avoid any losing money, you are flying blind. Understanding your break-even point help you set realistic sales target, manage your expense. For example, you know you need to sell 500 units just to break even. You can strategize around that target, whether it is adjusting your marketing effort, cutting cost, or even reevaluating your pricing. So calculating break-even point is not just a good practice, it is must for any business that want to stay afloat and grow. It gives you a clear picture of where you stand and what you need to do to succeed. Now let's see the last part of this particular question. If ABC Limited want to achieve a profit of $1,000, how many units must it sell? Very good question. So how many units it must sell to achieve a profit of $1,000? So how to calculate this? So earlier I have told you to do this particular diagram. So see, what is the selling price per unit? Selling price per unit is 10 rupees. What is the variable cost? It was 6 rupees. So this area is how much? 4 unit, which is called contribution margin per unit, right? And in this case, if we exaggerate this particular area, it has been given that profit is $1,000. So this area is profit and this area is fixed cost, right? And fixed cost is given how much? $2,000. I think you remember it. $2,000, right? So you know contribution margin is 4, contribution margin per unit is 4. So we can say contribution margin per unit multiplied by number of unit, this would be equal to how much? 2000 plus 1000, which is equal to 3000, right? And what is the contribution margin per unit? It is nothing but 4. So 4 multiplied by n is equal to 3000, right? So n is equal to how much? 3000 divided by 4, which is equal to 750 units. Is it clear now how to calculate it? No need to remember any formula. Just remember this particular circle. Again I am repeating this question. See what you have to do. The selling price is given 10. The variable cost is given 6. So your contribution margin per unit, which is noted by small c, is equal to 4. And this contribution margin comprises of the two part. The first part is fixed cost and the second part is what? Your profit. Right. So this contribution margin capital C is equal to fixed cost plus profit. What is fixed cost? $2,000. What is profit? $1,000, which is nothing but 3,000. Your contribution margin is 3,000, and contribution margin is represented by contribution margin per unit multiplied by number of unit, which is small c. It is a small c, right? So c into n barabar 3,000. So n is equal to how much? 3,000 divided by small c. And what is a small c? The small c is 4. So it is nothing but 750. Is it clear now? So this way you have to solve such type of problem. You no need to remember any formula. Bankruptcy code. Which of the following is not a key component or authority involved in the resolution process? So you have been asked which is not a key component or authority involved in the resolution process. Let's go through the option. The first option say resolution professional. So let me give you a brief idea. So it is a central to IBC process. If we talk about this in short, we call it RP. So RP is the central to the IBC process. They manage the insolvency process. Not only manage, they coordinate between creditors and oversee the preparation of the resolution plan. So think of them as a project manager. You can think of them like a project manager, ensuring that all stakeholders are on the same page to resolve financial issue. Right, so they ensure that all the stakeholders are on the same page to resolve financial issue. That is called resolution professional. Second option we say information utility. Yes, correct. So the information utilities, you can think of them like a database, that store and authenticate financial information of debtor. So that stores and authenticate financial information of debtor that help in faster decision making. Right, so imagine a digital library that gives verified financial data instantly. You can imagine them like a digital library which gives verified financial data instantly. So this helps creditor and professional act swiftly. The third option say executive authority. So see, executive authority, if we talk about, so you know what NCLT? NCLT is National Company Law Tribunal. And you know about this DRT. Debt Recovery Tribunal. So this NCLT and DRT act as the adjudicating authority. They approve or reject insolvency application and ensure fair proceeding. They are like judges in the courtroom deciding whether a case qualifies for the resolution process or not. And the option D says interim resolution professional. So this is the incorrect option. This is the incorrect option. There is no concept of interim resolution project in the IBC. Instead, the correct term is interim resolution professional. I think this no project, right? So this the correct answer is IRP, interim resolution. We can call it interim resolution professional who temporarily manage the insolvency process until the resolution professional is appointed. So the correct answer is option number D. So what is the key takeaway from this particular question? First of all, we have seen the RP, which is the main person managing the insolvency resolution process. We have seen the information utility, a trusted source of financial data for quick decision. Then we have seen the adjudicating authority, the body that oversees and approve the resolution process, right? So this thing. Now let's move on to the next question. Let's see what type of question are being asked in the examination. So question number 2, which of the following is appropriate in the project appraisal? Friends, if you are preparing for CCP, obviously you are preparing for CCP, then you can join our Telegram channel where you can find such type of questions. The link of Telegram channel is provided in the description section. So you will get exposure to what types of more questions are being asked in the examination. Okay, there are almost 500 people who have already joined the Telegram session, so you can take help of their experience also. Now let's see the next question. Which of the following is inappropriate in the project appraisal? So the question is in which of the following is inappropriate in the project appraisal? The first is checking the borrower background. Option 2 says that verifying transaction check on a regular basis. Option 3, assessing the borrower's payment capacity, and option 4, evaluating cash flow for the project. So which is inappropriate? So let's see the first option, that is checking the borrower background. So this is the standard part of project appraisal. Lender need to assess the borrower credibility and past financial behavior to minimize the risk. So imagine you are lending money to a friend. Would not you want to ensure that they are trustworthy and have repaid debt in the past? So that is what this is a part of the project appraisal. Verifying transaction check on a regular basis. So this VTC, it is also called VTC, that is verifying transaction check on regular basis. See, this is inappropriate for project appraisal. While monitoring transaction is essential during project implementation, it is not part of the initial appraisal process. The focus of the appraisal is on feasibility. The focus on the appraisal is on feasibility, not day-to-day transaction. This is the main focus, not day-to-day transaction. Think of this as trying to monitor a project daily cash flow even before deciding to fund it. It does not make sense, right? The third option says assessing the borrower payment capacity, right? So what do you think about this? This is the crucial part. Understanding if the borrower can repay the loan ensures the lender's money is used wisely, right? Obviously borrower payment capacity plays a crucial role. And let's see the fourth option. So I can give you example to make option 3 more clear. It's like checking if someone can afford a loan before approving it. And option 4 says evaluating cash flow for the project. So this is the key part of project appraisal. Lender need to ensure that project can generate sufficient cash flow to repay the loan and sustain itself. It's like ensuring a business plan is profitable before investing it. So what is the correct answer? The correct answer is option number 2. So this is the correct answer, verifying transaction check on a regular basis, right? So what is the key takeaway from this particular question? So we have seen that checking the borrower background and payment capacity is essential to minimize lending risk. Evaluating cash flow ensure the project financial feasibility. And third thing we have seen, verifying transaction check is not a part of appraisal stage. It is relevant during the project implementation phase. Now let's move on to the next question. So let's see what is the next question that we have. As on now, how many core investment, I think CIC, credit investment company, this is not the correct full form. I think it is credit information company, right? CIC means credit information company. So let me correct it. How many credit information company have been declared by RBI at the domestic level? So at the domestic level, at the domestic level and at the international level, there are different types of CICs. So you have been asked to find how many CICs are there at the domestic level. So now
The correct answer is 4. There are 4 CIC. Okay, let me name them. Let me provide you the name of them also. So you can see these are Credit Information Bureau Limited, that is called Civil. We call it Civil. Civil full form is Credit Information Bureau India Limited. And then after we have Equifax, right? Equifax. So Equifax Credit Information Service Private Limited. This is the second one. Equifax Credit Information Service Private Limited. First is Civil. The third is Experian Credit Information Company of India Private Limited, and the fourth is CRIF Highmark. So these are the 4 CICs in India, right? Credit Information Company. Now let's see the next question. Is ROC, you know what is ROC? ROC is Registrar of Company. Is ROC filing compulsory for LLP, that is Limited Liability Partnership? So the question is whether ROC filing, every partnership has to registered with ROC. So whether it is compulsory for LLP also or not. So let's see the option. The first option say no for unregistered LLP, it is not mandatory. See, this is wrong. There is no concept of unregistered LLP, because an LLP must be registered under the Limited Liability Partnership Act 2008. You must remember it. This registration is mandatory. It's like saying you are part of a club without officially signing up. That does not work. Now, sir, option 2 says that only bank consider ROC for LLP. This is also incorrect. While bank may check ROC filing for verifying an LLP compliance, registration with ROC is a statutory requirement under the LLP Act, not just for bank. Registration with ROC is compulsory for LLP. This is the correct one, right? See, filing with ROC is mandatory for LLP. It ensures legal recognition and compliance with regulation, such as filing annual returns and financial statement. Imagine you are starting a business as an LLP. Without registering with ROC, your LLP cannot legally exist or operate. Option 4 says filing with ROC is optional for LLP. This is incorrect. Filing with ROC is not optional. It is a legal requirement for LLP to maintain their status and avoid penalty. So what is the correct answer? Option number 3 is the correct answer. So let me just summarize the key fact which we have covered just now. That registration with the registrar of company, that is ROC, is mandatory for all LLP under the Limited Liability Partnership Act 2008. Filing with ROC ensure that LLP is legally recognized and remain compliant with a statutory requirement like filing annual returns. Non-compliance can lead to penalties and legal issues for the LLP. Right. So this is about ROC and LLP condition. Now let's see the next question. A company has the following financial ratio. So this is a good question based on numerical part which have been asked in the examination. So you have been provided the financial ratios like current ratio given 1.5, quick ratio is given 1.2, inventory turnover ratio is given 6, current liability is given 1 lakh. You have to find the COGS. What is COGS? Cost of goods sold. So now let's first calculate step by step. So you know the current ratio. What is the formula of current ratio? It is nothing but current asset upon current liability. Okay, now see, it is given 1.5. So 1.5 will be how much? Current asset upon current liability, and current liability is 1 lakh. So you can say current asset will be how much? 1.5 times CL, or you can say 1.5 times 1 lakh. So this will be how much? 1,50,000. So this will be our current asset. Okay, now we know the current asset. Now let's move on to the quick ratio. Let's take help of this quick ratio. What is the formula of quick ratio? Let me write down here. That is nothing but quick asset upon current liability, and this is given 1.2. So 1.2 is equal to quick asset upon, and current liability is 1 lakh, right? So how much will be the quick asset? So the QA will be 1.2 times 1 lakh. So this will be how much? 1,20,000. So quick asset is given 1,20,000, current asset is given 1,50,000. Okay, now what is the difference between the quick asset and the current asset? See, quick under current asset also includes inventory. So you can say current asset is equal to inventory plus quick asset. Okay, so the difference is inventory. So can you tell me what will be the inventory value here? You can say inventory is equal to current asset minus quick asset. What is the current asset here? That is 1.5 lakh. And what is the quick asset here? 1.2 lakh. If we subtract, this will give you 30,000. So 30,000 will be the inventory. Now we know the inventory. Okay, and one ratio is also given, inventory turnover ratio. Let me erase it up. I think there is no space, so let me erase it and I will do the further calculation here. So what is inventory turnover ratio? Tell me, what is inventory turnover ratio? You know the formula. let me remind you. I think you know the formula. Inventory turnover ratio, ITR, is equal to COGS upon inventory. This is simple formula, right? So we know ITR, inventory turnover ratio, is given to us 6. So in the place of ITR we will write 6. COGS we have to calculate, that is cost of goods sold, and we know the value of inventory, which is 30,000. So let me write here 30,000. So what is the COGS? So COGS is nothing but 30,000 multiplied by 6, which is 1,80,000. So I think there is no option here, but suppose there is a fifth option, that suppose there is a fifth option here, that is 1,80,000. So that would be the correct answer, right? 1,80,000. Okay, so hopefully you have understood this particular concept. Okay, inventory turnover ratio, how to calculate this COGS, this is how you have to go do it. Okay, now let's see the next part. What is the maximum period for which packing credit in Indian rupees can be extended to exporter as per RBI guideline? Friends, before going to the option, let me tell you that if you are looking for study material for CCP, in our app, that is JIV and CIV Made Simple app, you will find an exhaustive study material for CCP, in which we provide unit-wise theory, unit-wise MCQs, as well as previous year questions. All these things are available in the form of PDF, which is completely downloadable, and you can take print for offline reading also. So in the link beside in the description section, I have provided you the course link. You can directly go to the course, and you can get each and every unit's theory portion, concise notes, complete MCQs, which will help you revise the concept. For more detail, you can WhatsApp me on this particular number also. Now let's see the next question. Question is, what is the maximum period for which PCIR, that is packing credit in Indian rupees, can be extended to exporter as per RBI guideline? Tell me, what is the maximum number of days? So PCIR can be extended to the exporter as per RBI guideline. What is the maximum number of maximum period? So options are 120, 180, 360 and 90. See, first of all, let's understand what is PCIR. Packing credit in Indian rupees. PCIR is a short-term pre-shipment credit. It is a type of pre-shipment credit. It is a type of pre-shipment credit provided to the exporter. It helps exporter finance activities like purchasing, processing, manufacturing or packing goods meant for export. If we talk about the duration, so RBI allowed packing credit for a maximum period of 180 days. For the maximum period of 180 days, this is allowed. Okay, from the date of disbursement. Date of disbursement to 180 days. Okay, if additional time is needed, bank can consider extension in exceptional case, but these may require RBI approval, compliance with the specific guideline. So the common duration is 180 days. Okay, now the second question is, why duration is capped at 180 days? This time frame ensures that exporter have sufficient time to process good and ship them, right? It also aligns with typical export cycle, ensuring liquidity without overstanding credit. So extension beyond 180 days, there are some exception also. It's not hard and fast that only 180 days. Yeah, exception also there. Extension beyond 180 days are rare and subject to a strict regulation. Exporter must demonstrate valid reason. Like, let me give you an example to make this concept more clear. Imagine you are an exporter of textile. Okay, you are an exporter of textile. You take PCIR from the bank. You avail the packing credit exposure from the bank to purchase raw material and prepare the shipment. As per the rule, you need to complete your shipment process within 180 days to repay the loan. And if there is an unforeseen delay, you will need to apply for an extension through your bank, which will then follow RBI approval process. So what are the key takeaway from this particular question? We have seen what is the purpose of PCIR, that a short-term credit to help exporter with pre-shipment activity like purchasing and packing goods. And we have seen the maximum duration, which is 180 days from disbursement, and we have seen extension is also possible, right? So that is everything you need to know about PCIR. If you really find this explanation useful, give this video a like, share it with your fellow learners and subscribe to the channel for more such insight. Let's continue to the next question. So let's see what is the next question here. The next question is, as per the Tandon committee recommendation, which method gives the highest MPVF? You know MPVF, maximum permissible bank finance. So there are some certain method, first method, second method, third method and fourth method. Okay, so which will give you the highest MPVF? So first of all, what is the Tandon Committee? Let me give you a glimpse. The Tandon Committee was set up to suggest way to regulate working capital financing by a bank. So main key factor is working capital financing by a bank. Okay, its main goal was to ensure that company use fund efficiently while reducing over dependence on bank credit. So that is about the Tandon Committee. The second thing is MPBF. What is this MPBF? MPBF refers to the maximum amount bank can lend to business for its working capital need. The maximum amount that bank can lend to the business for working capital need is called MPBF. This committee suggested three methods to calculate MPBF. So what is the first method? What does the first method says? Okay, you will get answer if you know these four methods. If you know what these four methods are, you will clearly get the answer. The first method says that bank finance 75% of the working capital gaps. WCG. What is WCG? This is the difference between the current asset and current liability, or the CLO BB say, which is nothing but current liability other than bank borrowing, right? So this is what, so 75% of the WCG will be provided by the bank and 25% will be provided by the it will be provided by the borrower, which is called borrower contribution, which is also called margin. So this is more restrictive because the borrower contribution is higher. What is the question asking? Question asking you to find which method give the highest MPBF. In which method bank will give the highest permissible finance. So it is not the correct answer. It is restrictive because borrower contribution is higher. Let's see the second method. In the second method, you know that borrower contribute 25% of the current asset and the bank finance the balance. So 25% of what? 25% of current asset. Since the borrower margin is fixed at 25%, the bank share increases. So that is why, as compared to the first method, in the second method we have higher MPBF, right? In this method we have higher MPBF. If we talk about the third method, so borrower contribute 25% of the core current asset, 25% of the CCA, core current asset. What is CCA? Maximum current asset required to operate a business. What is CCA? This is the maximum current asset required to operate the business. This is called CCA. Okay, so and the bank finance the remaining. This method is stricter as it focus on core asset only. So option D says all methods give the same MPF. This is incorrect. Now the correct answer is option number B. So the question is why the second method gives the highest MPBF? See, we have fixed the borrower contribution to the 25% of total current asset. We have just fixed it in the second method. So the bank share increase. In this case, bank share will increase. Okay, and it allows for a larger loan compared as to the other method. So let me give you an example to explain it. Let's suppose company needs 1 lakh. Company needs 1 lakh for working capital. According to the first method, bank finance 75%, which is 75,000, and the borrower will finance the rest 25,000. Okay. According to the second method, borrower contribute only 25,000 and bank finance the remaining. Right. So in terms of margin and flexibility, second method result in higher MPBF. Okay, so that's the point. Now the next question is here it is. It has explanation is also there. In this way you will find explanation for each and every question. MCQ is also. Now the question is, who can initiate the CIRP? What is CIRP? Corporate Insolvency Resolution Process under the IBC Insolvency and Bankruptcy Code 2016. Who can initiate this CIRP under the IBC? Tell me. Options are only principal creditor, financial creditor and operational creditor, only operational creditor, all of the above. So first of all, what is CIRP? Okay, because we are dealing with CIRP, what is CIRP? So CIRP stands for Corporate Insolvency Resolution Professional Process. It is a mechanism under the IBC to resolve case of corporate solvency. If we have to resolve cases of corporate solvency, corporate insolvency, in that case CIRP is used. So it is a legal process initiated where a company is unable to pay its debt and it aims to revive the company or liquidate its asset to repay the creditor. Okay, so this is about the CIRP. It is a legal process when the company is unable to pay its debt and its aim to revive the company or liquidate its asset to repay the creditor. Okay, so question is, who can initiate CIRP? Under the IBC 2016, the following entities can initiate CIRP. The first is FC. FC means financial creditor, a creditor who has provided a financial loan or credit to the corporate debtor. Okay, So for example, bank or financial institution who have provided loan to the to this particular debtor. Okay, so company is not able to paying its debt, and it aims to revive the company or liquidated its asset to repay creditor. Now the first, financial creditor. Second is operational creditor can also initiate CIRP. What is operational creditor? A creditor owed money for operational activity like unpaid supplies, vendor, service provider. For example, a logistic company unpaid for its service. This is example of operational creditor. And the third is corporate debtor. So the corporate debtor can also initiate the CIRP. Corporate debtor. So the company or debtor itself can voluntarily initiate CIRP if it is unable to pay its debt under the voluntary insolvency provision. This is typically done to seek legal protection and work toward resolution. So what about the principal debtor? The principal debtor cannot initiate CIRP on its own unless it is filing as a corporate debtor under voluntary insolvency provision. So let's suppose, let me give an example. Suppose there is a company named ABC Limited. It owes 5 crore to a bank. Okay, so this bank will be what? This bank will be financial creditor. Suppose it owes 50 lakh to a supplier. Okay, it owes 50 lakh to a supplier, so this supplier will be operational creditor. Suppose in this, let's consider the first scenario. The bank can initiate CIRP as the financial creditor due to unpaid loan. Scenario 2, this particular supplier can also initiate CIRP as an operational creditor due to non-payment of the dues. So this is OC, this is FC, both of them can initiate CIRP, and this corporate debtor can also initiate the CIRP, right? But the principal debtor cannot initiate CIRP unless filing as a corporate debtor. So this process ensures transparency and fairness for all stakeholders involved. Now, so hopefully you have understood this particular concept. Now let's move on to the next question. The next question is, as you can see, yeah, this is a very good question. A company has sales of 24 lakh. I think, yeah, 24 lakh at 200 rupees per unit. The break even point is 50% of the sale and the profit volume ratio is 25%. You have to find the fixed cost. Okay, sales is given, break even point is given, profit volume ratio is given, and you have to find the fixed cost. So here you should know what is the formula for the profit volume ratio. Its question is quite simple. You just have to substitute the value, right? You will get the answer. So what is given? Break even point is 50% of the sale. And how much is the sale? Sale is given 24 lakh. So can you tell me what will be the BEP? So BEP will be 50% of 24 lakh, isn't it? It's 50% of 24 lakh. What will be the 50% 24 lakh? 12 lakh. So BEP will be 12 lakh. Okay, and now PYV ratio is given how much? PYV ratio is given 25%, or we can say 0.25, either 25% or 0.25. Now first of all, you should know the basic formula to compute it. The formula is quite simple, that BEP, break even point, is equal to fixed cost upon PYV ratio. Okay, BEP is equal to fixed cost upon PYV ratio. So what is BEP? You know, let me give you how this formula came. Let me just remind you. So suppose this is our sales. One part of the sales is variable cost, you know very well, and the other part of the sales, this is called contribution, right? This is called contribution, right? And contribution, inside contribution you will get what? You will get two parts. One is the profit and other is the fixed cost. So at BEP, no profit is there, so contribution will be equal to fixed cost. You know it very well, right? At BEP, the point at which BEP held, there is no contribution, sorry, there is no profit. Okay, so our entire contribution will be borne by the fixed cost. So if we multiply this BEP with PYV ratio, this will give you contribution. That's how this formula came, right? Instead of this contribution, you can write BEP times PYV ratio. BEP is what? Number of units. It is nothing else but number of units. And PYV ratio means profit volume ratio. Okay, so this is how this formula came, and now you just have to substitute the value. Okay, you have to, so you can see here in this particular formula, you can see, you can write, just let me erase it. Okay, we have got BEP 12 lakh. Let me erase it and I will do the calculation, risk calculation here. So you have to find the FC, right? So FC, you can say it is nothing but BEP multiplied by PYV ratio, isn't it? So what is BEP here? BEP here is 12 lakh, and what is the PYV ratio? It is nothing but 0.25. So you can say 1/4. So what is the 1/4 of 12 lakh, right? So
here it is 1/4, or you can say 1/4, I think it is 3 lakh, right? 1/4 is 3 lakh. So the correct answer is 3 lakh. So fixed cost is 3 lakh. Let me see the option which correspond to 3 lakh. So I think no option is given, but let's suppose option number E is there, 3 lakh. So 3 lakh is the correct answer. So let me again summarize the fact which we have learned in this particular question. Break even point is the level of sales at which there is no profit or loss. PYV show the contribution margin as a percentage of the sale. I already told you, it shows you the contribution margin, right? Contribution margin as a percentage of the sale. So that's why PYV, if you multiply with BEP, this will give you the contribution. And fixed cost calculation, use the BEP and PYV ratio, right, to find fixed cost when sales details are provided. So this is how you have to calculate this. Now let's see the next question that we have. The next question is, the limited liability partnership is established under which statute? So very good question. LLP, the question is regarding the LLP. So LLP is established under which statute? Options are Companies Act 2013. Yeah, this is wrong. See, first of all, if you know about limited liability partnership, so this is a unique business structure that combines the advantage of both a corporate structure and well as partnership. You know about it? It combines the advantage of both corporate structure as well as partnership, right? This is a unique feature of this LLP. So it offer limited liability to its partner, meaning their personal assets are protected. That is called limited liability. Okay, unlike in traditional partnership where the partners have unlimited liability. In traditional partnership, you know, the partners have unlimited liability, while in the case of limited liability partnership, their assets are protected. The LLP Act 2008 governed the establishment, management and operation of the LLP in India. So the correct answer will be option number C. The next question is, why other options are incorrect? First option say Companies Act 2013. See, this act governed the incorporation and regulation and dissolution of company, not LLP. So Indian Partnership Act, this act deals with general partnership which does not provide a limited liability feature. And last is Society Registration Act. So this act pertains to the registration of society. So what is the key takeaway from this particular question? We have seen that LLP are governed by the Limited Liability Partnership Act 2008. It combined limited liability with the flexibility of a partnership structure. It is distinct from a company and traditional partnership. Hope that things clear up. Now let's see the next question. What is the green clause LC? Okay, the next question was asked, what is the green clause letter of credit? You have been provided with the four option. Okay. First option say, first of all, let me provide you explanation. A green clause LC is a specific type of LC that allows the exporter to receive advance payment for certain goods, certain cost before the shipment of the goods. Okay, so you will receive the advance payment means exporter. You will not, exporter will receive the advance payment for certain goods. Okay, and the advance payment is specifically for storage and processing of goods. You will receive advance payment, but what it is for? It is for the storage plus processing of goods. Right, ensuring that exporter has necessary fund to take care of the goods before they are shipped in. This is particularly useful in scenarios where goods need to be stored or processed for significant time before shipment. It happens that in some product we have to store the goods, we have to process the goods for a significant time before shipping them, and for such cases this green clause LC is a superior, plays a fruitful role. Now let's see what are the other option. First option A say that LC that allow advance payment for storage and processing of goods, correct. An LC that restrict parcel shipment, this is wrong, because this describe the red clause LC. You know about red clause LC which can restrict parcel shipment, not the green clause. An LC that mandate payment only after the final inspection of goods, so this is more aligned with the site letter of credit. Okay, and last option says an LC used exclusively for agriculture purpose. I think green clause LC not restricted to agriculture purpose. So what we have learned in this particular question, that the green clause letter of credit helps the exporter by providing advance payment for storing and processing goods. It reduces the financial risk for exporter, and this type of LC is highly beneficial in cases where goods require extra time for handling before delivery, right? So this is a key fact about the green clause letter of credit. Now let's see the next question. Which of the following best describe an English mortgage? So you know options are given. You can see four option is there. Option A says that the mortgagor transferred the property conditionally without any personal liability to repay the loan.
Option B says that mortgager bind himself personally to repay the mortgage money on a specific date, and the property is absolutely transferred to the mortgagee with a condition for reconveyance upon repayment. The mortgager retained full ownership of the property but provide the mortgagee with a lien until repayment. Option D said that mortgagee has right to sell the property without transferring ownership during the loan term. So tell me, which statement best describe English mortgage? So first thing, English mortgage is one of the traditional form of mortgage. It is unique in the fact that the first is mortgager, right? So mortgager means borrower. So borrower bind himself personally to repay the loan. Borrower binds personally to repay the loan, and the property is absolutely transferred to the mortgagee. Property is transferred to the mortgagee. Who is mortgagee? Mortgagee is lender. Property is transferred to the lender with a condition that property will be reconveyed to the mortgager once the loan is repaid, and it involves full ownership transfer to the lender, but upon repayment the mortgager get the property back. Right. Now why are the other option incorrect? So let us go to the option. Option A said that the mortgager transferred the property conditionally without any personal liability to repay the loan. So this describe a conditional sale. It describe a conditional sale, not an English mortgage. In an English mortgage, the mortgager bind himself personally to repay the loan. Right. Option B says that the mortgager bind himself personally to repay the loan. Correct. On specified date, and the property is absolutely transferred to the mortgagee with the condition for reconveyance upon repayment. Yes, correct. This is exactly what English mortgage is all about. Option C says that the mortgager retained full ownership of the property but provide the mortgagee with lien until repayment. What do you think? See, this is refers to the simple mortgage. See, it is quite essential to see each and every option because other option provide you a concept. So this is the concept of simple mortgage. So suppose question is what is simple mortgage? So this option will be correct. The mortgager retain the full ownership of the property but provide a mortgagee with lien until repayment. Yes, correct. So in the English mortgage, the mortgager transfer full ownership to the mortgagee, unlike in simple mortgage where only lien is provided. And last option say mortgagee has a right to sell the property without transferring ownership during the loan terms. So tell me whether it is English mortgage? No. This describes the power of sale clause. It describes the power of sale clause which is typically found in mortgage like the English mortgage, but does not accurately describe the essence of the English mortgage. So the key feature is transfer of property with the condition of reconveyance. So let us quickly revise what we have learned in this particular question, that in English mortgage, the mortgager transferred the property to the mortgagee and bind themselves personally to repay the loan. Right, and upon repayment, the mortgager can have the property reconveyed to them. The mortgagee has absolute ownership of the property until the debt is clear. Right. So friends,
so a bank financial shows the following figure. So bank credit in India is 12,000. I think all the data are in crore, right? All the data are in crore. So 12,000 crore. Then we have bill discounted 1,200 crore. Outstanding deposit under RIDF, NABARD, NHB, SIDBI and Mudra 1,500 crore. Outstanding PSLC 500 crore. Exemptions on long-term bond for infra and affordable housing. It is 1,800 crore. Investment in recapitalization bond, right? Investment in recapitalization bond, it is 400 crore. Advance against incremental FCNRB or NRD deposit 700 crore. Please take a screenshot of this slide because the data we will be using to solving the numerical. This thing will be provided in the examination. Then the next thing is given that investment in securitized asset, as you can see, is 300 crore. Then we have face value of STM security under TLTRO and SLMF, it is 1,000 crore, and bond debenture in non-SLR category under STM category 600 crore. Now let's see the question. So this data have been given. I request you to please take a screenshot of it. What is the ANBC of the bank? Right, 4 option has been given. What is the adjusted net bank credit from the bank? So let us calculate each and every step by step. How do you go about calculating it? Right. So friends, let us calculate it step by step. So these data have been given. Right. So first of all, you must know that what is the formula for calculating net bank credit. Do you know the formula for calculating net bank credit? So let me write it down. So the formula for calculating net bank credit, NBC is called net bank credit, is equal to bank credit in India
bank credit in India minus bill discounted, right? Minus bill discounted. Minus bill discounted. Now please tell me what is the bank credit in India? It is 12,000. So just write 12,000. And what is the bill discounted? It is 1200. So just subtract it, 1200. So this will give you how much? This will give you 1800 crore. Right, 1800 crore. Now think of this is called NBC, net bank credit. Think of this as the bank net lending after excluding the credit it has already sold or rediscounted with other financial institution. Means the bank net lending, you can think of them as the bank net lending after excluding the credit it has already sold or rediscounted with other financial institution. Then what you do, you add the RIDF, deposit and PSLC, you add these two. Right. So what is RIDF deposit? 1500 crore. What is PSLC? 500 crore. So total will be how much? Total will be 1500 plus 500. So this will give you how much? 2000 crore. Right. So now the new total is how much? New total is 1800 crore plus 2000 crore. So this will be how much? 12,800 crore. Right. Now this is the step number 2. So in step number 2, what we did, we add the RIDF deposit and we add the PSLC. So these two have been added and this has been subtracted. Now after step number 3, that we add exemptions for long-term bond. So bank get exemptions for issuing long-term bond meant for infrastructure and affordable housing. So we will add this. So 12,800 plus how much? Plus 500, right? So no, it is 1800, right? So this is the exemption. So 12,800 plus 1800, so this will give us how much? 14,600 crore, right? Now then what we will do, then the next point we have is to subtract exemptions and investments, right? So now you can see advance against incremental FCNR and RD deposit. So these are the kind of exemptions which is given. It is how much? 700 crore, right? And this investment in recapitalization bond, this is also kind of investment. So this is 400 crore. And investment in securitized asset is also 300 crore. So if you add all of them, it will amount to 700 plus 300 plus 400. So this will give you how much? It will give you 1400. It will give you 1400. So this you have to deduct. So total deduction is 1400 crore, right? So the new total will be how much? The new total I am writing here 14,600 minus 1400. So this will give us 13,200 crore. So these things have to be subtracted, right? Now HTM security has to be added because which is the face value of held to maturity under TLTRO SLMF. So you have to add these two, right? So you have to add these two. So you can see the 1000 crore has to be added. So just add 1000 crore, it will become 14,200 crore. Now the final thing is that you have to subtract bond in non-SLR category under STM. So which is how much? 600 crore. So you subtract 600 crore. The final answer is how much? 13,600 crore. Right. So this is how you calculate the A and B, C. Now let's analyze each and every option. So first of all, you must know what has to be added, what has to be subtracted. Please take a screenshot of this slide. This will help you know that this thing have to be subtracted and this thing have to be added in order to compute A and B, C. And this question is most frequently asked in every CCP examination. Right. So let's go through the option. Option number C is the correct answer. Right. So the correct answer is option number C. So let me summarize before we wrap up. Here are the key points to remember, right? So there is a formula to calculate A and B, C. And what is the formula? Let me show you the formula, right? So let me write down the formula of A and B, C. What to add, what to subtract. So first of all, you calculate the NBC. First of all, you add the NBC. You add it RIDF or PSLC. Then you add the exemptions. Then you subtract the deduction. Then you add the STM security. Add the STM security, and then you subtract the non-SLR bond. Right. So this way you have to compute A and B, C. Right. So this is the formula for A and B, C. So the key components here are RIDF and PSLC. These are added. Remember, RIDF and PSLC are added. Long-term bond for infra and affordable housing are added at exemptions. So this exemption includes long-term bond which is given for infrastructure and affordable housing, and deduction include advance against FC and RB. So whatever advance has been given against FC and RB and whatever advance has been given against NRE deposit, recap bond, this has to be deducted, right? So carefully consider addition and deduction. Missing even one component can lead to incorrect answer. So this is how you have to compute the A and BC. Please remember the formula. This will help you compute it. Now let's see the next question. The question number 2 is on your screen. I request you to please try to solve this question yourself. This question is based on diversion of the fund. Very important question it is. So let's go through each and every option and understand which option is correct one. So friends, let me see you the question. A bank earmarked 100 crore exclusively for priority sector agriculture lending as per the regulatory guideline. During the year, the bank disbursed only 75 crore, right? Only 75 crore was disbursed for agriculture lending, while the remaining 25 crore, was allocated to corporate non-priority lending. Now we are asked, what is the amount representing the diversion of fund? 0 crore, 25 crore, 75 crore, 100 crore. So first of all, what you must understand, what is the meaning of this term earmarking, right? So first let's clarify what is the meaning of earmarking of fund. The bank set aside 100 crore specifically for priority sector lending in agriculture. Think of it like allocating a monthly budget of rupees 10,000 for grocery. You expect to expend the entire amount only on food item. Now, however, the bank only lent rupees 75 crore to the agriculture, meaning rupees 25 crore is not used for the intended purpose. Instead, this 25 crore is diverted to non-priority lending, which is a corporate lending, which is a non-priority sector. It's like you plan rupees 10,000 for grocery, but only 7,500 on food, but only spend 7,500 on food and remaining 2,500 for online shopping. So can you tell me what is the diversion? So obviously the diversion which has been asked to you is how much? So diversion is equal to 100 crore which was earmarked and minus 75 crore. Minus 75 crore. What is 75 crore? Because this 75 crore is the actual disbursement. So this was the earmarked amount. This is the actual disbursement. The answer is 25 crore. Right. So let's go through each and every option. So option number B is the correct answer. Right. So what we learned from this discussion? That earmarking of fund. Whenever bank reserve money for a specific purpose, it should be used only for that purpose. Right. And diversion formula is quite simple. What you have to do? You have to subtract earmarked fund and actual disbursement. This will give you the diversion. Right. So that is our answer. Very easy question it was. Right. Friends, if you are preparing for CCP and if you are looking for study material for the same, so let me show you a study material on my app JIB and CIB Made Simple. I have made a course in which you can see that I have added 3 previous year questions, right? So you can see this is how the course look like. And offer module wise, module A, module B, module C, module D and module E. If you open a single module, like suppose I open module A, so there are different unit in module A, like unit 1 principle of lending, unit 2 credit policy, and inside each every unit you will get separate theory PDF and separate MCQs PDF. Like suppose I open module unit 1, so you will get separate theory PDF and MCQ PDF. So friends, this way it has been arranged. So if you want to get access to such kind of material, you can WhatsApp me on this particular number I am writing on the screen, right? And you can also join our Telegram channel in which different candidates have already joined and they pose the memory based question. The description of the Telegram channel is provided in the description section of this particular video, right? Now let's see the next question. The next question is on your screen. As you can see, this is a very important question. Let's go through it. So friends, the question asks that an exporter has received a PCFC facility. You know PCFC? That is called pre-shipment credit in foreign currency. Exporter has received a PCFC facility from a bank with the following condition. The facility offer competitive rate linked to LIBOR, Euro LIBOR or Euro LIBOR. Exporter can choose to avail of PC in rupees or directly in foreign currency, right? Cross currency PCFC is allowed, right? Cross currency PCFC is allowed, and the PCFC is carved out of the normal PC limit. So let's see the question directly. No need to go through each and every option. Which of the following statements regarding this PCFC facility is not correct? Right. Option number A. Exporter can avail of PCFC in one convertible currency for an export order invoice in other convertible currency, although the risk of cross currency transaction is borne by exporter. Option number B. The PCFC facility is subjected to separate limit apart from the normal PC limit sanctioned by the bank. The option number C. The rate of interest on the PCFC should not exceed 350 basis point over the applicable LIBOR. And option number D. For non-standard credit period, the applicable rate of interest is determined by using the rate for the next or upper standard period. So friends, these are the 4 options and which is not correct had been asked. So let's go through each and every option. So friends, you know what is PCFC? So basically, let me explain a little bit about the option. So first of all, let's understand what is PCFC basically. So PCFC stands for pre-shipment credit in foreign currency, right? It is a loan facility given to exporter so it is a loan facility given to whom? To exporter, right? It is loan which is given to exporter to finance their working capital need, right? To finance their working capital need, like buying raw material, processing, packaging before shipping the goods. So instead of taking a loan in rupees, exporter can avail in foreign currency, right? So that is why FC word is written there, foreign currency like dollar, euro, Great Britain pound. Why? Because foreign currency loan have a lower interest rate, making them cheaper for exporter. And interest rate are linked to LIBOR, which is London Interbank Offer Rate or EURIBOR. Now let's analyze each and every option one by one. So first of all, let's go through option number B. It says that PCFC facility is subjected to separate limit apart from the normal PC limit. Under the PCFC scheme, there are no separate limits. So this option is wrong. This facility is carved out of the bank existing PC limit sanctioned to the exporter. It's like having a single wallet for shopping, whether you pay in cash or you pay in card. You are spending from the same wallet. Similarly, PCFC is not an additional limit. It comes out of the already approved pre-shipment credit limit. Hence, this is incorrect option. Right. Option number A. Exporter can avail of PCFC in one convertible currency for an export order. Yes, correct. Because in cross currency PCFC, there is a kind of called cross currency PCFC. So in cross currency PCFC, exporter can borrow in one currency, let's say dollar, even if the export order is invoiced in other currency, let's say euro. However, exporter bear the currency risk, which means if the exchange rate fluctuates unfavorably, the exporter may incur a loss. So let me give you an example to make it more clear. For example, suppose you take PCFC loan in dollar, right, for an export order which is invoiced this export order is invoiced in suppose euro, right? So if the USD is strengthened against dollar, suppose US dollar strengthened against euro, right? So by the time you receive the export proceed, you will end up receiving fewer dollar when converted, reducing your earning. So this option A is correct. Option C says the rate of interest should not exceed 350 basis point over the applicable LIBOR. Yes, this is also correct. Because under PCFC scheme, the maximum interest rate that bank can charge is 350 basis point above LIBOR. So what is the meaning of basis point? So 1 BPS, 1 BPS is equal to 0.01%. So here 350 BPS means 3.5%. Right, so option C is correct. So A is correct, C is correct, B is wrong. And option number D says that for non-standardized credit period, the applicable rate of interest is determined by using rate for the next. Yes, this is also correct. Bank offer PCFC loan for a standard tenor. There is something called a standard tenor. 1 month, 2 month, 3 month, 6 month or 12 month. These are the standard tenor. For non-standard period, let's say 4 month. Suppose 4 months. So this 4 months is not a standard period. For non-standard period, the interest rate of the next higher standard period is charged. So let me give you an example to make option D more clear. Let's say that you have availed PCFC for 4 months, right? So the bank will apply the interest rate for 6 months, which is the next higher period. Understood? So option D is correct. So the correct option to this question is option number B. Not correct have been asked. Right. So what we learned from the discussion is that the key learning from this discussion is that PCFC, first thing is that PCFC is a pre-shipment credit, first thing, right, for exporter. So for first point you must make it clear that this is the kind of pre-shipment credit, right, and it is offered in foreign currency and it is linked to the LIBOR or EURIBOR. Second point, cross currency PCFC is allowed, but the exporter bear the exchange rate risk. Interest rate on PCFC cannot exceed 350 basis point and no separate limit are required for PCFC. It is carved out of the normal pre-shipment credit limit, and for non-standard tenor, bank apply the interest rate for the next higher standard period. If you find this concept helpful, if they find the video helpful till now, please hit the like button, right? This will motivate me to make more such and such content, right? So now option B is correct to this particular question. Now let's see the next question on gold card scheme. This question is most frequently asked, right? So let's go through the question. So some statement has been provided to you, right? So friends, the gold card scheme, option number A says that it was introduced by RBI, right? So so some statements are there. Statement number 1, eligibility. Only exporter with a minimum track record of 3 years who have continuously maintained a standard performance with no irregularity are eligible for gold card. Statement number 2, gold card holder are given preference by bank for granting packing credit in foreign currency and may also be considered for term loan in foreign currency using FCNR fund. Statement number 3, the in principle credit limit is sanctioned for a period of 3 years and is automatically renewable provided the exporter comply with the loan term. Statement number 4, Processing charge on loan for gold card holder are lower than those for other exporter, and a flat service charge of 0.1% is applied on interbank foreign currency borrowing. And statement number 5, that a standby limit of not less than 20% of the assets limit is available for urgent credit need. Right. So these are the 5 statements. Now which combination of statement is correct? So in this question we will able to cover every part of gold card scheme. So which statement is correct? A statement option number A, 1, 2, 3 and 5, 4 is incorrect. 1, 2, 3 and 5. So I think yes, so it's easy. 1, 2, 3 and 5 are correct, 4 is incorrect. 1, 2, 3, 5 are incorrect, 4 is correct. Right. And only 1 and 2 are correct. All statements are correct. So these are the 4 options which is given. So now let's go through each and every statement. So friends, gold card scheme is an RBI initiative, first thing, right? And it is a priority financing and lower charge to the exporter. It offers priority financing and the lower charge to the exporter, right? And it is faster loan processing and longer credit validity. So you can think of like a VIP membership for exporter, where they get faster service, better rate. Now let's analyze each statement. So first statement says that only exporter with minimum track record of 3 years, right? This statement is correct. Right, to be eligible for gold card, you must know that it should have a clean track record. It should have a clean track record of 3 years, right? At least 3 years, and there should be no default, no irregularity. So exporter who are blacklisted by ECGC, right, or on the RBI defaulter list, or incurring loss for 3 consecutive years are not eligible. Very good, it is correct. For example, imagine you run an export business and have been regularly repaying loan on time for past 3 years. So you qualify for gold card. But if you have defaulted or made losses in the last 3 years, then you won't be eligible. So this is the point. Now let's look at statement number 2, credit preference and flexibility. So this statement is also correct, because the gold card holder get preferential treatment from bank, meaning they are given priority for packing credit in foreign currency PCFC. Yes, they get priority, right? They get priority in PCFC, and also bank may grant them term loan in FC, right, using FCNR fund, and the loan limit is based on their expected export turnover, making it more flexible. So if you are a gold card holder and you apply for foreign currency loan, the bank will prioritize your application of a non-gold card holder. So this is also correct. Now statement 3. So under the gold card scheme, the bank sanctioned a credit limit for 3 years. This is correct, right? And if the exporter follow the loan terms, the limit is automatically renewed. The limit is automatically renewed without the need for reapproval. So suppose, let me give you an example. Suppose you are an exporter with gold card and sanction limit of 10 crore, right, for 3 years. So if you repay on time, if you repay the amount on time and follow the rule, the bank will automatically extend the limit without additional paperwork. So this is also correct. Till now we have seen 1, 2, 3 are correct. What about option number, statement number 4? So this is also correct. It says that gold card scheme offer a standby limit of at least 20% of the access limit for urgent card need. Yes, correct. So loan processing is faster for gold card. 25 days for new loan proposal, 15 days for renewal, and 7 days for ad hoc treatment. So if you need urgent loan of 50 lakh, the bank will process your application within 7 days instead of the usual timeline. So this is also correct. Now let's look at the statement number 4. This charges is incorrect. This statement is a charge is incorrect. Why? Because while it is true that gold card holder enjoy a low processing charge, the 0.1% flat service charge is incorrect. Right? There is no specific 0.1% flat charge. Right? So the correct answer is 1, 2, 3 and 5 are correct, and 4 is incorrect. So option number A is correct here. Right? So friends, what we learned from this discussion is that eligibility. So let me summarize the fact regarding this gold card scheme. Let me summarize. So friends, first of all, what we come to know, that eligibility. So for eligibility, the requirement is that 3-year track record, right, of clean performance. Defaulter and loss maker are not allowed. Then we talked about the credit benefit. Yes, there is a priority processing for loan, faster approval and automatic renewal of limit. And then we talked about the standby credit. So at least 20% of the limit, remember, at least 20% of the assets limit is kept aside for urgent need. Then we talked about faster processing. So I talked about, right, 25 days for new proposal, 15 days for renewal, and 7 days for ad hoc limit. So friends, if you find this explanation helpful, please hit that like button, right? So I will prepare more such kind of videos. Now let's look at the MSME scheme. This question is most frequently asked, right? Let's try to understand the question. So friends, as per the revised definition of MSME under the Atmanirbhar Bharat Abhiyan, which of the following correctly represent the classification criteria for medium enterprise? Option A, investment in plant and machinery less than 1 crore, turnover less than 5 crore. B, less than 10 crore, investment, turnover less than 50 crore. C, investment less than 50 crore, turnover less than 250 crore. And D, investment less than 20 crore, turnover less than 100 crore. So friends, MSME is classified based on two categories, investment and turnover. So when I say investment, what it means? Investment means, in plant, machinery or equipment. Turnover means the annual revenue of the enterprise. So let me tell you the revised criteria. So basically, I will tell you the revised criteria of MSME. So what I do, I will prepare these two timeline, right? So this is investment and this is turnover, right? So first of all, micro, small, medium, right? So for micro enterprise, it is 1 crore. Just write here 1 crore, right? Just write here 10 crore, and just write here 50 crore. This is the way to remember it, and just multiply it by 5. So this is how much? 5 crore. Just multiply it by 5. This is how much? 50 crore. Just multiply it by 5. This is how much? 250. So 1, 10, 50 and then multiplied by 5. So this region is for micro. This region is for small. And this region is for medium. Now you can easily remember it. No need to memorize anything. Right? So basically for micro enterprise, investment limit is 1 crore. Turnover limit is 5 crore. For a small enterprise, investment limit is 1 to 10 crore and turnover limit is 5 to 50 crore. And for medium enterprise, for medium enterprise, it is the investment limit is 10 to 50 crore and turnover limit is 52 to 50 crore. Right? So let's go through each and every option. Right? So which option is correct? Can you tell me? Yes, option B is correct. 10 for medium we are talking about, right? No, it is not correct. I think option C is correct. Right? Yes, option not B. Option C is correct. Because investment less than 50 crore and turnover less than 250 crore. This is the correct answer. So imagine that you run an IT company with investment in server, equipment, infrastructure. Suppose your investment is 45 crore and your annual turnover is suppose 200 crore. So your company will be classified as medium enterprise, right? So that is the correct answer. So friends, I hope that makes sense to you. So remember this limit. This is quite easy to remember. Just remember this word: 1 crore, 10 crore, 50 crore. 1, 10, 50, 1, 10, 50. Write it down many times. You will be able to remember it. And just multiply it by 5. The lower limit will also be clear to you. Right? So 1, 10, 50. Just you have to remember it. Now let's see the next question. The next question we have. This is a very good question. This asks you to calculate the cash accrual. Right? This question is asked in the examination, which is asked in 8 March examination, which I recently conducted. So a company financial for the year shows the following detail. Some detail has been provided to you. As you can see, net profit after tax 50 lakh, depreciation 10 lakh, amortization of intangible asset 5 lakh, interest on long term loan 8 lakh, provision for tax 7 lakh, dividend payout is 4 lakh. What will be the cash accrual? So before we jump into the solution, let's first understand what is the meaning of cash accrual. Cash accrual, it means net cash inflow generated by the company from its operation. It shows how much cash the business actually generate, excluding non-cash item. So cash accrual, the formula is the formula for cash accrual is NPAT, net profit after tax. Then you add non-cash expense. Let me write down the formula first. Then you add what? Non-cash expense. Right. So NPAT plus non-cash expense plus plus interest on long-term loan. Plus interest on long-term loan, right? So this is how we use. So now non-cash expense. So here you will see a term called non-cash expense. So what is the meaning of non-cash expense? So non-cash expense include depreciation. So depreciation is a kind of non-cash expense. Why? Because because it reduces the profit on paper but does not involve actual cash outflow. Does depreciation involve actual cash outflow? No. Yes, but it reduces the profit on the paper. Another kind of non-cash outflow, non-cash expense, is called amortization. Right? What is amortization? Same as depreciation, but for intangible asset like patent or trademark, this is called amortization. Right? So remember, tax provision and dividend are not included in the cash accrual. Remember this thing, very very important. Tax payment and this dividend, right? They are not included in cash accrual. Why? Why they are not included? Because tax provision are estimated future liability, right? Not actual cash outflow. So tax provision, they are estimated future liability, not cash outflow, and dividend payout represent a distribution of profit, not an operational expense. So that is why these two things are not included in the cash outflow. Remember it, depreciation will be included as non-cash expense. Yes, it is a kind of non-cash expense. And amortization on intangible asset, this is also kind of non-cash expense. and interest, obviously since you have taken long term loan, so this is a kind of net cash outflow, right? So this is cash accrual. So friends, now let's do a step by step calculation. So here we have, you know, NPAT is how much? NPAT is just let me erase the some area, just wait a minute. So let me erase it. Now let's apply the formula here. So NPAT is how much? NPAT is 50 lakh plus depreciation is how much? 10 lakh plus amortization is how much? 5 lakh plus interest on LTL is how much? 8 lakh. So after adding these two, this will give you 73 lakh. So this is the net cash accrual, right? What are the options? 68 lakh, 80 lakh, 75 lakh, and I think 73 will be correct answer, right? So which option do you think is correct here? So the correct answer will be, you know, 73 lakh. Yes, so I think let us say instead of the 75, let's say this is 73. So this is the correct answer, 73 lakh, right? So remember, what we have to remember is that cash accrual, the formula is NPAT plus depreciation plus amortization plus interest on long term loan, right? What to include? Non-cash expense and interest on long term loan to include, and what to exclude? You know what to exclude here. So to exclude, we have provision for tax and dividend payout, right? So this is how you should remember it. Now let's see the next question. So I hope that makes sense to you. Now let's see the next question that we have. The next question is, PMEGP, that is called Prime Minister Employment Generation Program. Very, very important concept. So friends, let's talk about this particular concept. So which of the following statement regarding PMEGP is correct? Option number A. Option number A says that it is a kind of a central sector scheme, right? So it says that it is a kind of central sector scheme administered by the MSME and implemented at the state level by the KVIC in rural area and DIC in the urban area. Option number B, the maximum project cost allowed under PMEGP is 50 lakh for the manufacturing sector and 25 lakh for the service sector. Option C, PMEGP allow funding for both new and existing project, including retail, trading and business across all region, right? And option D, generation program. It is a central sector scheme introduced by Ministry of MSME, and the objective of this scheme is to generate self-employment and to promote micro enterprise in the rural and urban area, right? So it provides subsidy based loan for new project. It focuses on manufacturing and service sector, and it offers a special benefit for northeast region, left wing extremist affected district and Andaman and Nicobar Island. So option number A suggests that it is a central sector scheme. Yes, it is correct, because it is indeed a central sector scheme and it is introduced by Ministry of MSME, right? At state level, it is implementation is done by the in rural area KVIC and KVIB. Sometimes KVIB is also there, which is a state Khadi and village industry, or DICs, right? And DICs in the urban area. In urban area, only DICs. So for example, imagine a person in rural village want to start a handloom weaving business under PMEGP. So they will apply through KVIC or KVIB for financial support. Whereas in urban area, someone starting a small cafe will apply through the DIC. Option A is correct. Option B suggests that the maximum project cost under PMEGP is 50 lakh. So this is wrong, because the under PMEGP the maximum project cost is actually 25 lakh. It is 25 lakh for manufacturing sector and 10 lakh for the service sector. So suppose you plan to start a small garment manufacturing unit, so you can get funding up to 25 lakh under PMEGP. If you want to open a service business like a saloon, the maximum funding is 10 lakh. Now option number C, PMEGP allow funding for both new and existing project. This is also incorrect. PMEGP only fund new project. It does not fund the existing project. So retail trading is not allowed nationwide. It is only permitted to a special. You can see including retail trading. No, retail trading is not allowed nationwide. It is only permitted to a special region like northeast region, or suppose LWE, left west extremist affected region, and Andaman and Nicobar Island. So in other region, retail outlet are allowed only if they are backed by manufacturing or service facility. Let's say you want to open a stationery shop. If you are in northeast region or LWE region, you may be eligible. However, in regular city, you won't qualify unless your business involves both trading and manufacturing service activity. So that's why option number C is incorrect. Now, next option is, under PMEGP, capital expenditure is not mandatory. This is also wrong, because capital expenditure is mandatory. You must invest in asset like equipment, machinery to avail of the loan. Trading activities are not involved, right? So you can see trading activities are permitted. No, this is wrong. Trading activity are not permitted. Remember it. Right, so they are restricted to NER LWE district. So suppose you are in NER region and you can avail of PMEGP funding if you want to open a grocery store. But if you are in metro city like Delhi and Mumbai, you won't qualify unless you are also have a manufacturing service unit alongside the trading activity. So the correct answer to this question is option number A. Right, option number A is the correct answer. Just now we have seen it. Yes, this is the correct answer. So what we have learned from this question regarding the PMEGP, that it is, first thing is that it is a central sector scheme. First point. Second point is that administered by MSME. Third point is that implemented in state level by KVIC and KVIB, and in urban area by DICs, and maximum project costing for manufacturing sector is 25 lakh, and for service sector is 10 lakh, right? And retail trading is restricted to a specific region, and capital expenditure is mandatory to avail the loan. So if your concept is clear, please hit the like button. Right, so I have explained each and every point regarding the PMEGP. This question is most frequently asked. Right, now let's shift our focus. Right, so remember, the key way to remember, the trick to remember is that this PMEGP, Pradhan Mantri Employment Guarantee Program, is restricted to new project only. Right, it is restricted to new project, and capital expenditure, capex, is mandatory, and trading is allowed in restricted region. Trading is allowed in restricted region. That is a point. So it is for new project, capex is allowed, and trading is allowed in the restricted region. The 3 point you must remember it. Right, now let's look at the consortium advance. This is a very good question. So friends, the question is, which of the following statement regarding consortium advance is correct? Option A, consortium financing is required when the loan amount is large and beyond the prudential exposure norm. Option B, a company with multiple division or multi-product operation is always treated as separate unit by different bank. Option C, under a consortium arrangement, only one bank participates in financing the borrower, right, while the other financing institution act like guarantor. Option D, in consortium, each participating bank provide finance to the borrower independently without coordinating with other bank involved. So what do you think regarding consortium arrangement is correct? So consortium banking is when two or more bank or financial institution come together to jointly provide a loan to a borrower. When this is done, so whenever borrower need a large loan, right, then they can go for consortium, and such a loan exceeding the lending limit of a single bank. If it exceeds the lending limit, there are limit which is placed by RBI. So if such loan, if it exceeds the lending limit of a bank, then it is done. So this reduces the exposure for each individual bank. So the borrower deals with only one lead bank. There is a concept of lead bank here, and all the bank involved share the risk. So now let's go through each and every step by step option. So option number A says that required when loan amount. This statement is correct because this prudential exposure norm are guidelines set by RBI to limit the maximum loan amount a bank can give to a single borrower. So if a company require a loan larger than this limit, no single bank can fund it alone. So therefore multiple banks form a consortium to jointly lend the required amount. Right. So for example, suppose company ABC need a loan of 500 crore. Right. He need a loan of 500 crore to expand its business. So bank X has a lending limit of only 200 crore. Right. So instead of rejecting the loan, bank X form a consortium with bank Y and bank Z. Right. Together they jointly provide the 500 crore loan. So that's why option number A is correct. Option B, this statement is incorrect because a company with multiple division or or product or multi-product is generally treated as one single unit if it has only one published balance sheet. Right. It is treated as a single unit. So bank cannot treat different division as separate entity unless they have separate financial statement. So without separate balance sheet, bank must form a consortium for a large loan. Let me give you an example to make it more clear. For example, let's say XYZ Limited, this is a company. It has 3 divisions. The first division, let's say the textile division. The second division, let's say the electronic division. The third division, let's say the pharma division. It has the 3 divisions. Okay. Now, however, XYZ Limited publish one combined balance sheet, right? It just published one balance sheet. One balance sheet is published by it. Even if different bank want to finance separate division, they cannot treat them as separate entity. So therefore, they must form a consortium to jointly provide the loan. That is why this option is incorrect, right? Now let's see the option number C. Option number C says that under a consortium arrangement, only one bank participate in financing the borrower. This is also incorrect because consortium financing, what happened? All bank involved contribute fund proportionally. No bank acts like a guarantor. Every participating bank lend money to the borrower. So no bank act like a guarantor. Remember it. There is no concept of guarantor here. So that is why this option is incorrect. So let me give you an example to make it more clear. For example, suppose 3 banks are there, A, B, C. They form a consortium to provide a 300 crore loan. right? So bank A might contribute 100 crore, bank B provides 120 crore, or bank C provide 80 crore, right? So all the three bank lend money rather than acting like guarantor. So this is also incorrect. And what about option number D? We will understand each and every option. So option number D says that in consortium, each participant bank provide finance to the borrower independently without coordinating. This is also incorrect, because bank don't lend independently. They work together under joint agreement, sharing the loan amount proportionally. And the borrower deals with a lead bank, right? So there is a concept of so-called lead bank. So the borrower deals with the lead bank, right? For example, suppose this company ABC, they takes a 500 crore loan, right? So three bank, X bank, Y bank and Z bank, the three bank participate. So bank X can act like a lead bank. So this bank X can act like a lead bank, and they will manage the overall process. So I hope the concept of consortium is correct. Now the correct answer to this particular question is, option number A is the correct answer. So I have explained each and every option. So if you want such kind of PDF, you can go for our CCP online course, which is available. Many candidates have already passed the examination, reading through the material. You can also join it. The link is provided in the description section. Now let's see a very important question regarding calculation of net cash flow from operating activity using the indirect method. This is a very good question. So friends, let me show you the question. So XYZ Corporation, right, provide the following financial detail: net income $1 lakh, depreciation expense $10,000, increase in account receivable $5,000, decrease in account payable $3,000. You need to calculate the net cash flow from operating activity using the indirect method. So friends, before we dive into the calculation, let me quickly explain what is the meaning of this indirect method. The indirect method is used to calculate cash flow from operating activity by starting with net income. So you start with the net income, right, and adjust for non-cash expense. I think you are familiar with this term non-cash expense. We have already talked about it in the previous question. And then also you adjust for change in working capital, change in WC. So let's calculate the non-cash expense for the net cash flow from operating activity using the detail provided. So you start with the net income, which is how much? 1 lakh. Now you add the non-cash expense. So depreciation is a kind of non-cash expense, so you add it. So it will become 10 plus 10,000. And then depreciation is a non-cash expense, which means it reduces the net income for accounting purpose, but does not involve an actual cash outflow. Does it involve actual cash outflow? No, but it reduces the net income for accounting purpose. So that is why we add it back to the cash flow, right? Try to understand what I am telling you. This is a kind of non-cash expense, because this depreciation, it reduces net income. The net income get reduced because of depreciation, right, for accounting purpose, but does not involve. So there is a no cash outflow. Since there is a no cash outflow, so that is why we add it, right? Accounting purpose it reduce it, but is not a kind of cash outflow. That is why we add it, and we adjust for change in the working capital. Now see, there are two things. Account receivable is increasing, account payable is decreasing. So whenever account receivable increase, it means the company has made sale but has not yet collected the cash. That is the meaning of account receivable. So therefore it reduces. Try to understand what will be the impact of the increase in account receivable. Try to understand what will be the impact of increase in account receivable. What is the meaning of account receivable? That means company has made the sale but has not collected the payment yet, right? It has made the sale but had not collected the payment yet, right? So that is the account receivable. That is the meaning of account receivable. So it reduces the cash flow. This account receivable, it reduces the cash flow. Why? Because the company has made the sale but has not collected the cash, right? So till now what we have this 1 lakh. From that we added this 10,000. Why we have added the 10,000? Because we have added the 10,000 since this depreciation expense is a kind of non-cash expense, right? So it reduces our net income for accounting purpose, but does not involve an actual cash outflow. That is why we add it back to the cash flow. And so if we talk about the increase in account receivable, it means the company had made the sale but has not collected the cash. So ultimately what it does, it reduces the cash flow. So that is why we have subtracted this 5,000. It reduces the cash flow. Now what about the decrease in account payable? So when account payable decrease, it means the company has paid off some of its liability. So this results in cash outflow, reducing the cash flow, right? So ultimately this will also be subtracted, right? So that is the point. So ultimately after doing the calculation, you will get how much? 1,02,000, right? So that is why option number C is the correct answer. So that is why option number C is the correct answer. So what we learned from this discussion is that cash flow from operating activity involves starting with net income, adding back non-cash expense like depreciation and amortization, right, and adjusting for change in the working capital. like increase in receivable, it will reduce your screen. Let me skip this question and let's see this particular question. This is a very good question regarding this letter of credit. Yes, let's try this question. Right. So the question is saying that let's try to solve this particular question. This is regarding LC limit. This question is most frequently asked and very important from examination point of view. So friends, let me show you the question. A company has the following detail: annual raw material consumption. So you can see annual raw material consumption is how much? 6 crore, right? Economic order quantity is 1 crore, right? Lead time for delivery is 10 days, transit time is 20 days, Ujans period is 6 months. So question is, what will be the LC limit for the company? So before solving the question, let me explain the limit. What is the meaning of LC limit? This is the maximum amount of credit the bank allow for company to open LC for import. So suppose some company want to open LC for import. What is the maximum amount of credit that bank can allow? And the second thing we have is the economic order quantity. So this is the optimal quantity of company order to minimize total inventory cost. In this case, EOQ is 1 crore. What is the meaning of Ujans period? You know what is the meaning of Ujans period? So it simply means the credit period the supplier grant before payment is due. So here it is 6 months. So this is the credit period that supplier grant before the payment is due. And the lead time, lead time is the time it takes the supplier to process and dispatch the order, which is 10 days. And transit time is, that this is the time for goods to arrive at the company location. Now, first we need to find out. So let's go step by step. We have to calculate the LC limit. So the options have been given. So let me show you the options. So these are the four options: 1 crore, 3 crore, 4 crore, 7 crore. So let's solve this step by step. First we need to find out how long an LC remain active from the time of order until payment. So this is the time of order, right? And this is the time of payment. So question is, how long LC remain active? So calculating the duration LC remain outstanding. So how to find it? So it is, you have to just add the time. You take LT, you add transit, and finally you add the Ujans period. So add all of them. So how much it is? 10 plus 20 plus 6 months, or plus 180, which is how much? 210 days. So this 210 days is approximately 7 months. So basically this means LC remain outstanding for 210 days. This is the step number 1. You have to find how much time LC remain outstanding. Second thing what you have to do is to determine the LC frequency. Second thing, you have to find the LC frequency. How to go about finding the LC frequency? So friends, LC frequency is very easy to understand. So let's determine how frequently the company open LC. So you can see annual raw material consumption is how much? Is 6 crore. Economic order quantity is how much? 1 crore. So number of LC per year, try to understand. Number of LC per year is how much? It is nothing but 6 upon 1, which means 6 LC annually. 6 LC is open annually. So since the company uses 6 LC in a year, the frequency, what will be the frequency of opening LC? So frequency will be how much? It will be 12 months divided by 6. This will be how much? 2 months per LC. 2 months per LC is the frequency. This means company open a new LC after every 2 months. Now, so this is the step number 3 that we have calculated. Right. So friends, till now we have seen 3 steps. Right. In step number 1, we calculate the number of period for which LC remain outstanding. In step number 2, we calculate the duration. Then we calculate the LC frequency, which is how much? 2 months per LC. Now then we determine the number of LC outstanding at any time. How many LC will remain outstanding at any particular time? So total LC outstanding period is how much? Total LC outstanding period is 210 days, right? And the company open a new LC every 2 months. So the number of LC outstanding at any time will be 7 months divided by 2 months per LC, which is approximately 3.5, or we can say 4 LC by rounding it off. So therefore company will have 4 LC outstanding at any time. And final step we have to calculate the LC limit. Finally we will calculate the LC limit. How we calculate the LC limit? So now we know that there will be 4 LC outstanding at a particular time. So LC limit, the formula for calculating the LC limit is very easy. That you find number of LC outstanding multiplied by LC amount per order. Multiplied by LC amount per order. Right. So how many number of LC outstanding? 4 LC outstanding. What is the LC amount per order? 1 crore. So it will be how much? 4 crore. So the company need LC limit of 4 crore. So answer will be 4 crore. Right. So how to go about finding the answer to this question? Let me explain once more. First thing to do is to find LC outstanding period. In this case, this is 7 months. Second step, you have to find number of LC per year. Number of LC per year. In this case, how to find it? You take the annual consumption, you divide it by EOQ. This will give you number LC per year. In this case, it is 6 LC. Then you have to find the frequency of LC, right? Then you have to find frequency. You divide 12 by number of LC. So friends, how to find frequency? Divide 12 by number of LC opened, right? Number of LC per year, this will give you frequency. After finding frequency, you have to find number of outstanding LC. How to find number of outstanding LC? Just divide this outstanding LC outstanding period. LC outstanding period.
So now let's get started. Let's see the type of question that have been asked in the examination. So the first question is on your screen, and it asks you that a company has total current asset of 380 lakh, right, and total current liabilities which exclude bank borrowing of 110 lakh. If the projected net working capital is 30 lakh, what will be its MPBF? Under method number 2, clearly written method number 2, what will be the maximum permissible bank finance? So this is also called, Tandon committee method, method number 2, which says that Tandon committee method number 2, which says that first of all we have to calculate the working capital gap. So these are the options. You pause the video, try to solve it on your own, and then see the explanation. Now let me explain. I hope you have done that. Now friends, the correct answer is option number C. Let me explain how to go about solving this problem. First of all, we calculate the working capital gap. What is working capital gap? It is the difference between total current asset and total current liability other than bank borrowing. In this case, we have 380. We have 380 lakh as the current asset, and current liability excluding bank borrowing is 110 lakh. So 380 minus 110, how much it will be? 270, right? So you can think of it like this. Suppose the company need 380 rupees worth of raw material stock, but it already owe 110 to supplier. So the actual gap or the actual shortfall is 270 lakh. So suppose the company need 380 lakh worth of raw material, stock, etc., but it already owe 110 to supplier. That is the meaning of current liability, right? So that is a kind of liability. Asset is 380, it needs use of fund, source of fund, right? So the gap is actually 270 lakh. That is where the bank steps in to help, because this total current liability indicates that what are the liability that it has to pay. So like suppose it owes some amount to someone like 110, right? So so to fulfill this gap of 270 lakh, the bank will step in. The second step after calculating the working capital gap is to deduct the borrower contribution. So what is the borrower contribution? So under method number 2, it says that borrower is required to bring some of their own money, either 25% of their current asset or projected net working capital, whichever is higher. So what is the 25% of the current asset? So total current asset is 380 lakh. 1/4 of 380 lakh is 95 lakh, and projected net working capital is only 30 lakh. So which is higher? 95 lakh is higher. As you can see the calculation, 25% of CA 95 lakh, projected NWC is 30 lakh. So which is higher? 95 lakh is higher. So we will take 95 lakh. This is the amount that borrower has to contribute from their long-term fund, right? Now third step is to calculate the MPBF. So see, bank will say I have to fulfill this gap of 270 lakh, right? Out of which 95 lakh will be contributed by you. The rest amount I will contribute. So 270 minus 95, which is equal to how much? 175 lakh. So 175 lakh will be contributed by the borrower. Now let's see the option that we have. The first option say 270 lakh. No, this is wrong. Option number B say basically 270 lakh. Why it is wrong? Because that is the WCG, but the bank won't finance the entire gap. Borrower must bring some margin, right? What about 185 lakh? It is close but incorrect. This might confuse you if you use projected NWC. In the case if you use projected NWC, then you will get this answer, but this is wrong, right? Then the correct answer is 185 lakh. Yes, this is correct. So let's summarize the fact which we learned from this question is that first of all we will calculate the WCG. WCG means current asset minus current liability, and current liability should not include the bank borrowing. And under method 2, bank give MPBF is equal to WCG minus higher of 25% of CA, right? So that is the point. I hope it is clear now. Now let's see the question number 2. So question number 2 is, which of the following is considered the foremost principle of lending that the banker must prioritize before disbursing loan? Very, very important. Principle of lending question it is. Foremost. So let's understand the correct answer first. First of all, try it yourself. The correct answer is option number C, that is called safety.
This is the most important principle in lending. Why? Because the bank is lending public money, that is your deposit, my deposit. So the first responsibility of a banker is to ensure that money will come back safely. Think of it like this. If you lend money to a friend, what do you care about first? Not how much interest he will pay, but whether he will return your money safely, right? Same logic apply to the bank. Now let's understand why other options are not the foremost. Option A, liquidity. Yes, liquidity is very important. It is also one of the principles of lending. It means the banks would be able to get back the money quickly in case of urgent need. But for example, giving short-term loan or loan backed by asset that can be sold quickly. But safety come first. If a loan is a liquid but risky, it is still not good. What about profitability? See, bank is a business. They need to make profit, but profit should not come at the cost of losing the loan amount. First safety, then liquidity, then profitability. That is the order. And lastly, diversification. That means not putting all egg in one basket, like lending to different industry or different people. It is a way to reduce the risk, but again, it is a supporting strategy. Even diversified loan must be safe first. So to summarize the fact, safety is the first principle in lending. Banker must ensure that borrower is trustworthy and can repay the loan. Liquidity, profitability, diversification, these are also important, but they come after safety, right? So remember, a loan is only useful if it comes back. Friends, if you are looking for such kind of previous year question, theory, unit wise theory bullet points and MCQs based on each and every unit as prescribed by the IIBF, then we have a course on CCP available on our app. App name is JIB and CIB Made Simple. The link of app is provided in the description section of the video, or you can WhatsApp me on the number shown in the description. You will get the entire content, and many people have passed the examination using the content. Now friends, have a look at the next question. The next question is, what is the maximum default amount for an MSME to be eligible for PIRP? That is called prepacked. So PIRP is made for a smaller business, MSME. It only apply when the default amount is up to 1 crore. Right, option C. If the default is more than 1 crore, MSME have to go through a longer process, and that longer process is called CIRP. CIRP means Corporate Insolvency Resolution Process, which happen under IBC, Insolvency and Bankruptcy Code. You can think of it like this. If you owe 90 lakh, you can use the faster PIRP. But if you owe 1.5 crore, you have to go for CIRP. And CIRP takes more time and is more complex. Let's check other option. 10 lakh, 50 lakh, 10 crore. This is wrong. So what we learned from this question is that PIRP is only for MSME and default is less than 1 crore. For more than 1 crore, use CIRP. So PIRP advantage is it is faster, simpler and cost effective. Now the question is, in PIRP, who primarily initiate the resolution process and file the application? So who initiate PIRP? This is the question. Option A, debtor only. Option B, financial creditor with at least 66% voting. Option C, adjudicating authority. Option D, insolvency professional. So let's you know it very well that PIRP is a debtor in possession model. It means the MSME keeps control of the business, but the actual process starts only if the financial creditor approve it. So it is a debtor in possession model, which means the MSME keep control of the business, but the actual process will start only if the financial creditor approve it. So financial creditor must have at least 66% voting right in the favor of starting an PIRP. Let me give you one example. Suppose the MSME want to use PIRP, so it must first talk to its financial creditor. Let's say 3 banks gave loan, but if the bank holding 66% or more of the total loan amount say yes, then the MSME can file PIRP. So again I am repeating that if an MSME want to use PIRP, it must first talk to the financial creditor. Let's say it was funded by 3 banks, and if one bank fund more than 66% of the loan, right, then if that particular bank say yes, you can go for it, right, you can go for PIRP, then MSME can file the PIRP. So remember, who can initiate the primarily it is initiated by financial creditor with 66% voting. But if no financial creditor are there, the company can pass a special resolution with 75% approval. What about other option? Option number A say debtor only. So debtor can't alone, they need creditor support. Adjudicating authority only approve the plan, they don't start it. The question is regarding who initiate. Initiate means who start. Option D says insolvency professional or IP. So IP handles the process after it is initiated, not before. So IP handles the entire process after the PIRP is initiated, they don't handle it before. So this is also wrong. So correct answer is option B. So what we learned from this question is that PIRP is initiated by financial creditor with 66% voting right. MSME proposes, but creditor must approve it first. If no creditor are there, MSME can use 75% shareholder vote. Now have a look at the third question. You know this PIRP, last time 5 marks case study was asked based on PIRP. Have a look at the third question. What is the maximum time limit to complete the entire PIRP for MSME? Very good question. What is the time frame within which the entire PIRP for MSME must be completed? 90 days, 120 days, 180 days, 365 days. What is the answer? Please tell me. Maximum time limit. So, you know the whole PIRP must be finished within 120 days from the date it starts, from the date of initiation. That is option number B is correct. Also, the resolution plan must be submitted within 90 days. If it is not submitted or approved in time, the PIRP is terminated. So let me give you one example to make it more clear. Let's say day number 1, PIRP start. By day 90, resolution plan must be ready. By day 120, it must be approved. If not done, the PIRP closes, no more chance. So answer is 120 days. Had the question been when plan must be submitted, it should be in 90 days. Right. So remember the key point that PIRP must be finished within 120 days. Plan must be submitted within 90 days. It should be approved by 120 days. If you miss the deadline, process end automatically. This is very, very important. Now, full recap. Let's recap the three questions which we have done just now. First of all, PIRP limit maximum default 1 crore. That is the limit. Above 1 crore, PIRP is not there and it is applicable only for MSME. Second point, initiation. So to initiate PIRP, you need 66% vote of the financial creditor. Although it is a debtor in possession model, but it needs 66% vote of the financial creditor. Third point, time limit. It should be completed in 120 days and planned within 90 days. If you really like this easy explanation, don't forget to give a thumbs up. Now friends, have a look at the next question. Which of the following ratio is classified as solvency or leverage ratio? Very good question it is. Right, options are stock turnover ratio, debtor velocity ratio, debt equity ratio, creditor velocity ratio. So what is solvency ratio? A solvency ratio tells us if a business can pay back its long-term loan or not. Suppose a business has taken the loan. If it is able to pay back the long-term loan, that is what solvency ratio tells us. Right, it shows the financial health of the company in the long run. Remember, because the name itself says long-term loan, so obviously it shows the financial health of a business in the long term. In the long term, if you look at the debt equity ratio, which is the correct answer here. So debt equity ratio, what is the definition? What is the formula? In the numerator we write the total borrowed fund. In the denominator we write the equity, which means owner investment. So that is our leverage ratio. That is the solvency ratio. For example, let's say a company has 50 lakh in debt. It has taken 50 lakh. It has borrowed 50 lakh from the bank and rupees 20 lakh in equity. So debt equity ratio will be 50 upon 20, which is 2:1. That means company is using 2 rupee of debt for every 1 rupee of its own money. Remember, higher the solvency ratio, higher the leverage ratio, higher the risk, because more borrowed money means more pressure to repay. Let's see the other option. What about a stock turnover ratio? This is called activity ratio, not a solvency ratio. This stock turnover ratio tells us how quickly a stock is sold and replaced. For example, if a shop restock every item 5 times in a year, suppose if a shop restock item 5 times in a year, so the stock turnover ratio is 5. This shows inventory efficiency, not loan repayment ability. Here we are more focused on loan repayment ability. What about debtor velocity ratio? Debtor velocity ratio also called activity ratio. So stock turnover ratio also called activity ratio. So debtor velocity ratio shows how fast customer pay their dues to the company. For example, if customer takes 60 days to pay, so the debtor velocity is 60. Useful for managing working capital, but not about long-term loan. What about creditor velocity ratio? It measures how quickly the company paid supplier, the company paid its creditor. Right, if the company pay creditor in 45 days, so the creditor velocity is 45 days. Again, this is related to the daily operation, not solvency. So let's summarize the key fact what we have learned here. Remember, debt equity ratio is a kind of solvency ratio. It tells how much debt versus owner money is being used. It shows company long-term financial risk. Whereas stock turnover ratio, debtor velocity ratio, creditor velocity ratio, these are all kinds of activity ratio. They show efficiency, they don't show the solvency. Now have a look at the next question. Okay, this question is based on LC, how many LC to be open? Lead time 10 days, transit time 20 days, usance period 6 months, monthly consumption of 1 crore, right? EOD, end of day stock of 1 crore. How many LC needs to be open for the year? So first of all, what you do, you add the lead time, you add the transit time, you add the usance period. This will give you the total time it takes for one LC to complete. So it will be almost 6 plus 1 month, 7 months. So it takes 7 months for one LC to be complete. Okay. Now EOQ, I think a monthly consumption they have given 1 crore, right? So total consumption upon EOD, that is 6 LC to be opened.
Now what is the frequency of LC to be open? The frequency of LC is 12 upon 6, which is 2 months. LC limit, how to calculate the LC limit? Total time, frequency of opening LC, how many outstanding LC at a particular time. So total time it takes 7 months. After every 2 months one LC is getting opened, right? Because we have just calculated the frequency, and once we know the frequency, just divide the total number or total time it takes to the frequency. That will give us 3.5, which is almost equal to 4. So that is the 4 LC, right? 4 LC at one particular time. And what is the outstanding LC? What is the monthly consumption? Monthly consumption is 1 crore. So 4 crore is the limit, right? Now have a look at this particular question regarding ECB, external commercial borrowing. So question is, which of the following statement is not correct as per the ECB guideline? Option A, ECB can be raised up to USD 750 million per financial year under the automatic route by all eligible borrower except a startup, which are capped at USD 3 million. Option B says ECB liability equity ratio of 7:1 is applicable if the foreign currency ECB is raised from a direct foreign equity holder under the automatic route. Option C say ECB proceed can be freely used for issuance of guarantee by Indian Bank and NBFC. Option D says that currency of ECB can be changed freely between freely convertible currency, freely convertible foreign currency, or even into INR. So these are the 4 options. Please go through it. Pause the video. Tell me which one is correct, which one is not true. That means 3 options are correct, 1 is not true. Now let's go through each and every option. First of all, let's look at option number A. So first of all, let me explain. Most eligible company can borrow up to 750 million US dollar every year from abroad under the automatic route. But under automatic route, no special RBI approval is required. But a startup has a much lower limit. That is only 3 million US dollar. So yes, this option A is true. Option A is saying the same thing, that $750 million ECB can be raised and a startup $3 million. Bilkul, absolutely correct. What about option B? See, option B says that ECB liability equity ratio of 7:1 apply if ECB is raised from foreign equity holder. This means if a foreign investor owns share in an Indian company and also give it a loan, that is ECB, then the total loan amount can be only 7 times the equity they hold. For example, if the foreign equity holder has invested 10 crore in equity, so they can only give loan up to 70 crore in ECB, not more than that. That is called liability equity ratio. Liability means how much loan they can give. Equity means how much equity they have invested. So this ratio protects the company from being overburdened with loan. So this statement is also correct. What about option C? Option C is not correct. Why? Because it states that ECB proceed can be freely used for issuance of guarantee. No, this is not allowed. You cannot use ECB fund for giving guarantee through Indian Bank or NBFC. RBI has clearly restricted this. So this is the wrong statement, and therefore this is the correct answer to our question. What about option D? Currency of ECB can be changed freely between freely convertible foreign currency or even into INR. Yes, this is correct. If a company raise ECB in, say, suppose US dollar, suppose a company raise external commercial borrowing in US dollar, right? So they can later convert into euro, yen, or even Indian rupee, as long as currencies are freely convertible. So as long as the currency are freely convertible, the currency in which ECB was raised earlier, it can be easily be converted into other. So this RBI allow this kind of flexibility. So what we learned from this question, option number A, yes, it is correct. Up to 7, general cap is to $750 million US dollar, and for a startup it is $3 million US dollar. Option B, yes, it is correct. 7:1 ratio between ECB and equity, loan and equity for foreign equity holder. C is not true. ECB cannot be used to issue guarantee, and D is true. ECB currency can be converted into INR or any other freely convertible currency. So this is the complete breakdown of this tricky ECB MCQ. So remember, ECB question is also most frequently asked in the examination. Have a look at the next one. Right, very good question it is. Have a look at it. So the question asks which of the following correctly match the risk parameter with the description. So there are 3 risk parameter: PD, LED, LGD, EAD. So which is not which correctly match? Option A, PD, it measures how much exposure is lost when a borrower default. LGD, it refers to the likelihood of a borrower failing to meet obligation. EAD, exposure at default, it refers to the gross loan exposure at the time of default. And option number D, PD, probability of default, it measures the amount recovered after the default occur. Again, I am showing you all the 4 options. So these are the 4 options you can see. Please try the question on your own. Now let's start with the first option. So option number A, it says that PD measures how much exposure is lost This is incorrect because PD stands for probability of default. It tells us how likely the borrower is to default. Simple example. Suppose a borrower has 2% PD. That means 2% chance is that they might not repay the loan. But this option wrongly say that PD is about how much it is lost. No. How much it is lost is about LGD, not PD. What about LGD, loss given default? So LGD means loss given default. It tells us how much of the money we won't be able to recover if the borrower fail. Yes, we know that borrower has failed. So how much money we will not be able to recover. That is called the loss. For example, suppose LGD is 40% and it means that we will lose 40% of the amount if the default happen. So what PD was telling? PD was telling the probability of default. What is the chance that borrower might not repay the loan? And what is LGD? We know that borrower will default. How much loss we will incur, right? But this question is talking about the probability, which is PD, not LGD. So both options are wrong. What about C, EAD? So EAD means exposure at default. It tells us how much money the bank has at risk at an exact time if the borrower default. Yes, that is called EAD. For example, if a borrower has 10 lakh loan and 2 lakh credit line is used, so EAD is 12 lakh. So this definition is exactly accurate. What about option D? PD measures amount recover after default. So this is a confusion, right? PD is not about how much we can recover. It's all about how likely we will default, right? Recovery always come from LGD, not PD. So let's quickly recap the point which we have just covered. PD means likelihood that borrower will not be able to repay. LGD, which means how much we lose if default happen. EAD, which means exposure at default, means total loan amount exposed at the time of default. So remember PD, LGD and EAD. So easy way to remember is PD means probability of default, LGD means loss after default, EAD means exposure at the time of default. P means probability, L means loss and EAD means exposure. Just remember it. That's it. Now have a look at this particular question, right? Have a look at it. So the question says that a project costing 20 lakh, right? A project cost 20 lakh and earn 3 lakh profit per year after charging 10% depreciation before tax at the rate 50%. What is the payback period of this project? This kind of question is asked in the examination. Options are 4.25 year, 5 year, 5.71 year and 6.50 year. Let's understand this step by step. So first of all, project cost is given 20 lakh, profit is given 3 lakh per year, right, after depreciation but before tax. Depreciation is given 10% of 3 lakh, sorry, 10% of the costing, that is 20 lakh, that is 2 lakh per year. Tax rate they have given 50%. Now first of all, what we will do, we will calculate PAT, profit after tax. How to do that? See, we are told that profit before tax is 3 lakh, right, and tax is how much? 50% of 3 lakh, which is how much? 1.5 lakh. So PAT means profit after tax will be 1.5 lakh, isn't it? So let me show you the calculation, right? So PBT is 3 lakh, tax is 50,000, tax is 1,50,000, so PAT is 1,50,000. Now add back the depreciation to get the cash inflow. Remember, this is a very crucial step that we need to add back the depreciation. And what is depreciation? 10% of 20 lakh, which is 2 lakh. So 2 lakh we add back to PAT. So this will give us how much? This will give us 3.5 lakh. Now, what is the payback period? Payback period means initial investment upon annual cash flow. So annual cash flow we have is 3.5 lakh and the initial investment was 20 lakh. So if we divide both of them, we will get 5.71 year. So let's see the option that we have. Yes, 5.71 year is the correct answer. So remember, payback period tells us how much time it takes to recover the initial investment that we made. That's why we divide the initial investment with respect to the cash inflow. That means cash inflow is the yearly cash that we are getting, right? And we have invested some amount. So how much time it will take for all the cash inflow to generate equal amount to get equal to the total investment? It will take 5.71 year. So remember, what we learned from this discussion is that depreciation. So one question you may ask me, why we have added the depreciation to the PAT? Remember, the rule is that depreciation is a kind of non-cash expense. We will add it back while calculating the cash flow. And you must remember the payback period formula, total investment upon divided by annual cash flow. Always calculate PAT, then add depreciation to find the real cash flow. Remember it. Don't take PBT, right? Now have a look at the next question. So the next question is regarding large exposure framework, LEF. Under RBI LEF, which of the following entity is not subject to LEF norm? So options are a scheduled commercial bank, urban cooperative bank, and foreign bank and NBFC. Actually, this question is partially wrong because NBFC with respect to the earlier syllabus, NBFC was the correct answer. But with respect to the recent amendment which is done by RBI, NBFC upper layer has also been included under the larger exposure framework.
So completely we can't say that D is the correct answer. So let's skip this particular question. Now have a look at the next one. Yes, margin of safety calculation, very important calculation. How to go about calculating the margin of safety? Selling price per unit rupees 10, variable cost per unit rupees 6, fixed cost 40,000, actual sale 80,000. What is the margin of safety? So before calculating the margin of safety, you need to calculate the break-even point. And how to calculate the break-even point? I think we have discussed. What we need to do? We need to divide the fixed cost with respect to the contribution per unit. And what is contribution per unit? Selling price minus variable cost. So selling price is 10 rupees, variable cost is 6 rupees. So contribution will be 4 rupees per unit. And what is the fixed cost? That is 40,000. 40,000 divided by 4 rupees, that will give you 10,000, isn't it? So 10,000 is the break-even point. 10,000 unit is the break-even point. And what is the actual sale? Just wait a minute, let me show you the calculation. Right, so sorry, break even, yes, 10,000. And in terms of unit, if we do, in terms of 10,000 units, in terms of value, if we do, so one item cost how much? One item cost how much? You know, selling price is 10 per rupees. Sorry, 6 rupees. 6 rupees is the cost price, I think, variable cost, right? So just multiply this 10,000 with 10, that will give you, I think there is a mistake here, calculation mistake here. Right, there is a calculation mistake. Please, let's correct it. 10,000 multiplied by 10 will be 1 lakh. And margin of safety is the actual sale minus break-even sale. Right, which will be how much? I think actual sale is 80,000 and break-even sale is 1 lakh. So 20,000. I think there is a mistake here. So you know, margin of safety indicate how much sale can drop before the firm reaches break-even. A higher margin means a strong cushion against the loss. Now, which of the following statement is not regarding the DDA is not true? Diamond dollar account is not true. That is the question. Option A, firm dealing in cut and polished diamond can operate through DDA. Option B, a firm must have a minimum 1 year track record in diamond trade to open an DDA. Option C, minimum average annual turnover of 5 crore is required over the last 3 licensing year. Option D, Antwerp is known as the diamond capital of the world and is located in Belgium, which is not correct. That is the question. Let's understand what DDA is. You know, DDA stands for Diamond Dollar Account. It is a special type of account in foreign currency. It is mainly for firms that import, that export diamond and diamond studded jewelry. It helps this business avoid currency conversion loss and make international trade easier. Let's check each option one by one. First of all, option number A, firm dealing in cut and polished diamond can operate through DDA. Yes, it is true. In fact, not only cut and polished diamond, even firm dealing in rough diamond or diamond studded jewelry, they are also eligible. For example, if your company export diamond ring to the US, you can use a DDA to handle payment in dollar. What about option B? Option B says a firm must have minimum 1 year track record. No, that is why this is the correct answer. This is the wrong answer, and this is the correct answer as per this question, because not true is asked. The rule is if a firm have at least 3 years of experience in importing and exporting diamond, then only you can open DDA account. So if you have been in the diamond business for just 1 year, you are not eligible. What about option C, minimum average turnover? So this is true. To qualify for DDA, your diamond trading business must have an average turnover of 5 crore or more, and this amount only serious and established player get access. What about option D, Antwerp? Antwerp is known as the diamond capital of the world. So Antwerp, you know, it is a globally very famous. So yes, it is the correct answer. It is very famous for diamond trading market. It is called the Dalal Street of the diamond world. So let's summarize the key point which we have just discussed now. First of all, firm dealing in diamond or diamond jewelry can open DDA. Minimum 5 crore turnover over the last 3 years is needed. And Antwerp is a Belgium. In Belgium is the world diamond hub. Just remember it. Now, which of the following is a key characteristics of the commercial paper in India? Commercial paper key characteristics. Option A, CP is always backed by collateral to ensure repayment. Option B, only company with a net worth of at least 5 crore and a strong dividend payment record can issue CP. Option C, the minimum size of a single CP issue is 10 lakh. Option D, CP must always be issued at face value with no discounting allowed. Tell me, which one is the key characteristics? Very good question it is. So before diving into the question, let's understand the basic. So first of all, option A, that CP is always backed by collateral. No, this is wrong, because CP is an unsecured money market instrument. That means no collateral is needed, and it depends on the credit worthiness of the company. You can think of it like the top rated company saying, I today, trust me, I will repay in few months without offering security. Option B say that this is based on Vagul committee. Remember the name of committee, Vagul committee recommendation. And the Vagul committee recommendation says that to issue an CP, a company minimum net worth is 5 crore. Option B, that it should have a good dividend income, record business. And finally, for example, a reputed manufacturing firm with 10 crores net worth and 3 year of regular dividend payout can issue commercial paper. What about option C? Minimum size of single CP issue is 10 lakh. So commercial paper, tell me, what are the condition must a company meet to issue commercial paper in India? Option A, it must have a debt ratio exceeding 1.5 and current ratio below 1. Option B, the company must be listed on a stock exchange and maintain a minimum net worth of 5 crore. Option C, the company must provide bank guarantee to back the CP issuance. Option D, the CP must be issued only in physical form with a stamp duty applied. Chaliye, let's go through each and every option. Option number A, यहाँ पे in option number A you can see debt ratio should not exceed 1.05, but here it is written 1.5, so this is wrong, right? Or current ratio should be at least 1.33, right? So both our options are wrong. So financial statement should be strong. If your debt are too high or liquidity is too low, you are not allowed to issue CP. Second point, option number B. So it says that company must be listed on stock exchange. So it must be listed on a stock exchange and it must have a minimum net worth of 5 crore. So yes, this is the correct answer. So this ensures only a stable company can issue CP in the market. Option number C, the company must provide bank guarantee to back the CP issuance. This is incorrect. CP is not backed by bank guarantee. It is unsecured, no guarantee, no security, only a strong reputation. Option D, CP must be issued only in physical form with a stamp duty applied. This is wrong, because CP is mostly issued in demat form, just like share. And the good news is that it is exempted from stamp duty, so no extra cost here. So let's quickly recap the key points. First of all, commercial paper is an unsecured short-term instrument. It is for company with 5 crore plus net worth and good financial record. Minimum A3 rating. It is issued at discount or with interest. Minimum size is 1 crore. Issued in demat form, no collateral, no stamp duty. So that was everything you need to know about commercial paper, made easy for exam and interviews. Now have a look at this small and marginal farmer. So the question is, which of the following category is included under the definition of a small and marginal farmer for priority sector lending sub-target? So definition of SMF, that is what have been asked. Option A, farmer with land holding above 2 hectare but below 5 hectare. Option B, tenant farmer and sharecropper with land holding share within 1 hectare or 1 to 2 hectare for small, 1 hectare for marginal, 1 to 2 hectare for small. Agriculture corporation with more than 50% non-farmer shareholder. Option D, loan exceeding 5 lakh to individual engaged in allied activity without land holding criteria. So tell me, which of the following categories is included under the definition of a small and marginal farmer? So let's look at the option number A. So this is the common confusion. Farmer with land above 2 hectare are not SMF, right? So a small and is marginal, is marginal means up to 1 hectare. Small means more than 1 hectare up to 2 hectare. So anyone with more than 2 hectare fall outside this category. Small means less than up to 1 hectare. Up to 1 hectare, marginal. Small means 1 hectare to 2 hectare. That is called small. Right. What about option B? Option B, tenant farmer. Yes, even if someone is not the landowner, for example a tenant farmer or a sharecropper, as long as they cultivate land within the SMF limit up to 2 hectare, they are included under SMF for lending purpose. For example, a landless farmer working on 0.8 hectare as tenant, they are considered marginal farmer. A sharecropper managing 1.5 hectare, they are considered a small farmer. Now option C, agriculture corporation with more than 50% non-farmer shareholding. So agriculture corporation, or company with majority of non-farm shareholder do not qualify. SMF is meant for individual or small group directly involved in farming or allied activity, not big commercial entity. So this is the case of big commercial entity. No, SMF is not given to them, right? So agriculture corporation or company with majority of non-farming shareholder do not qualify. What about option D? Loan exceeding 5 lakh.
to individual engaged in allied activity. So loan for allied activity like dairy, poultry or fisheries can be included, but only if the loan is up to 2 lakh and the borrower fit into the small and marginal category, right? So loan is up to 2 lakh only, but here the loan is given 5 lakh. So they are not land, and there is no land holding check. So that will not be considered as SMF. So remember, quick recap, what is SMF? Let's quickly recap it. First of all, marginal farmer is one who owns or work up to 1 hectare. A small farmer is one who owns or work up to 1 to 2 hectare. It includes tenant farmer, sharecropper, landless labor. It help bank meet priority sector lending sub target. And what it exclude? It exclude farmer with more than 2 hectare. It exclude corporate or large firm. It exclude high ticket loan like over 5 lakh without proper land holding. So understanding who qualified as a small and marginal farmer is very, very important for CCP examination. Last time question was asked. Now have a look at this particular question. So the question is asking you, which of the following statement best describe the significant and limitation of RAROC? You know what is RAROC? Risk adjusted return on capital. So which describe the significance and limitation of RAROC? Option A, RAROC eliminate the need for other financial metric like ROE. Option B, RAROC help institution allocate capital efficiently but depend on assumptions and data, right? And option C, that RAROC is mostly used for non-financial firm. Option D, RAROC is simple and does not require much data or modeling. So RAROC stands for risk adjusted return on capital. First of all, let's look at option A. So this says that RAROC replaces metric like ROE. Yes, this is not true, right? RAROC is not a replacement but a complementary tool. You can think of it like this. ROE tells you how much return you get on shareholder equity, that is called return on equity. But RAROC tells you that how much return you are getting compared to the risk taken. You need both to make a smart financial decision. What about option B? Option B is also correct, because RAROC is used by bank or financial institution to compare profit with the risk involved in lending and investment. It helps in capital allocation, meaning where should the bank invest in money to get maximum return with minimum risk. But here is the catch. It is only as good as the data and the risk model used. If your assumptions are wrong, RAROC will give misleading result. For example, a bank is deciding between two loan proposal. One is very high risk or with high return, and the other is low risk with moderate return. So RAROC helps them choose which one is worth the risk. What about option C? Option C says that RAROC is used by non-financial firm. This is wrong, because RAROC is mainly used by bank, investment firm and other financial institution because they deal with credit risk, market risk and operational risk. What about option D? So RAROC is simple and does not need much data. That is a myth. RAROC is actually complex. It needs accurate measurement of expected loss, capital at risk, risk weighted, right, market and credit data. So a small firm without access to good data might find it hard to use RAROC effectively. So let's quickly summarize what we learned. RAROC stands for risk adjusted return on capital. It compares return versus risk. Why it is useful? Because it helps bank decide where to invest money. It supports capital allocation. It adds a risk perspective to profitability. And the limitation is that they need good data. They rely on accurate risk model, and they should be used with other metric like ROE. So the next time you hear about a bank choosing between investment, remember, it is not just about return. It's about return with risk. That is what RAROC helps them measure. So friends, that is all we need to learn from this particular chapter. That is all from which we are asked. We have more questions set. If you want me to explain more, just write yes in the comment section. I will bring the part 2 lecture of this particular video, right? So these are all recollected questions which has been given by the students who have appeared in the examination. If you also appear in the examination and want to share question, please see the WhatsApp number below and you can directly WhatsApp me on this particular number of the question.
Question is, a company sell a product at 8 rupees per unit. The variable cost per unit is rupees 5 and the fixed cost are rupees 180. What is the break-even point in terms of units? Options are 22.5 unit, 30 units, 60 units, 90 units, etc. So friends, what does break-even point means? So basically it is the number of unit a company need to sell to cover all cost. So to cover all cost, what are the basically number of unit that needs to be So to cover all the cost, the number of units that the company need to sell, that is called, break-even point. So at the break-even point, no profit, neither any profit, nor any loss, right? Let's find the correct answer. So I think you know the formula for calculating the break-even point. What is the formula? It is nothing but fixed cost. In the numerator we write the fixed cost. In the denominator we write selling price minus variable cost. Right. So now in this particular case, as you can see, what is our variable cost? VC is how much? VC is 5 rupees. Right. What is our fixed cost? FC is how much? Rupees 180. And finally, the selling price is SP is how much? 8 rupees. Right. So friends, just first of all find the contribution per unit. First of all find the contribution per unit. What will be the contribution per unit? It will be nothing but selling price minus variable cost. What is selling price? 8 rupees. What is variable cost? 5 rupees. So 3 rupees is your contribution per unit. Now what we need to do? We need to divide the fixed cost by the contribution. So fixed cost is to be divided by contribution. So fixed cost is 180 rupees. Right. Fixed cost is 180 rupees and contribution is 3 rupees. So if we divide both of them, we will get 60 units. So the company need to sell 60 units to break even. Now let's analyze each and every option. Option A says 22.5 unit. So if mistakenly someone divide fixed cost by selling price, he will get 22.5 unit. But this is the wrong, because we have ignored the variable cost. You can't ignore cost, right? What about 30 unit? 30 unit is also wrong, right? And the correct answer is 60 unit. Option number C is the correct one, right? So for example, suppose you run a lemonade stand. Selling price is 8 rupees per glass. Cost per glass is rupees 5. Fixed cost is rupees 180. So basically you are earning 3 rupees per glass. To recover rupees 180 as rent, how many glass you have to sell? So that is nothing but 180 divided by 3, which means 60 glass. That is your break even. So remember, what we learned from this question is that, first point is that at the point of break even, at the point of break even, no profit, no loss. Just remember, no profit, no loss. What is the formula? The formula is, fixed cost divided by selling price minus variable cost. That is the formula. And as per this question, the correct answer is option number C, which is 60 units. Now friends, let's have a question on calculation of profitability index. This is the most frequently asked question in the CCP examination. Let's have a look at it. So friends, this is the most useful tool to check if the investment is worth it. So we will go through the each and every option, understand why some are wrong and find the correct answer. So the question are the 3 projects having the following discounted cash inflow. So discounted cash inflow has been given in one column. Initial investment has been given in the another column, right? So 3 projects with cash inflow they have given you. And discounted cash inflow for project A is 8,40,000 and initial investment is 7 lakh. For B it is 2,10,000. Initial investment is 1,90,000. For C it is 5 lakh. Initial investment is 5,20,000. Now the option, so question is which project are profitable based on PI and what is the PI for project A? So option A says that both A and B are profitable and PI for project A is 1.20. Option B says that both A and C are profitable and PI for project A is 0.83. Option C says both A and B are profitable, PI for project A is 0.83. And option D say all projects are profitable and PI for project A is 1.20. So first of all, let's understand what is the profitability index. What is the meaning of this PI? So basically, it is a ratio that tells us how much profit we get for every rupee invested. Simply it tells you how much profit you get for every 1 rupee that you invest. For every 1 rupee that you invest, how much profit you get. That is what is told by the profitability index. Now the formula for PI is very simple. Formula for PI is very simple. We write discounted cash inflow in the numerator. Discounted cash inflow in the numerator, and in the denominator we write our initial investment. Because we have to know that how much profit, how much profit we are getting for every rupee invested. So now 2 things can happen. PI can be less than 1 or PI can be greater than 1. If PI is less than 1, it means project is not profitable. PI is less than 1 means project is not profitable. And if PI exceed 1, it simply means project is profitable, right? So means project is not profitable means what? Earning more than the cost. Project is profitable means what? Sorry, profitable means earning more than cost. Not profitable means, cost more than earning. Now let's calculate the PI for each and every project. So first of all, let's see for project A. For project A, what is the discounted cash inflow? 8,40,000. What is the investment? 7 lakh. So 8,40,000 divided by 7 lakh. So this will give you 1.20. This is the PI for project A. Now let's move to the project number B. For project number B, 2,10,000 is your discounted cash flow and initial investment is 1,90,000. So if you divide both of them, you will get how much? You will get 1.11. So for project B, PI is 1.11. For project C, cash inflow is 5 lakh, right? And initial investment is 5,20,000. So if you divide both of them, you will get 0.96. So friends, if we can say that for project C it is 0.96, since it is less than 1, so it is not profitable. Now let's analyze each and every option. Option A say project A and B are profitable and PI for project A is 1.20. Yes, correct. It matches our calculation. Exactly, correct. B say project A and C are profitable and PI for project A is 0.83. That is wrong. C is not profitable because for C, we are clearly observing that PI is less than 1. And we know that PI is less than 1, it means not profitable. For option C, A and B are profitable and PI for project A is 0.83. That is also wrong. And option D, all projects are profitable. Right. PI for A is 1.20. That is also wrong. C is not profitable. Right. So let me give you a real life example to make it more clear. Imagine you are investing in 3 small business. So business A, you invest 7 lakh and earn back 8.4 lakh. So what is your PI? Your PI is 1.20. That is your business A. In business B, you invest 1.9 lakh and you earn 2.1 lakh. So what is your PI? Your PI is 1.11. So this 1.20 is great. This 1.11, it is good. Then look at the business number C. You invest 5.2 lakh and you get 5 lakh as return. So your PI is just 0.96. This is a loss, right? So the moral is that always check PI before investing. So remember what we just learned from this particular question. This formula you need to remember. That is sum of the discounted cash inflow upon initial investment. This gives us the PI. And 2 things are there. If PI is greater than 1, it means project is profitable. If PI is less than 1, it means project is not profitable, right? So that is the point. Friends, if you are looking for such kind of previous year memory based question, unit-wise theory, unit-wise MCQs as per the syllabus prescribed by IIBF, you can enroll in our CCP course, which only costs rupees 200 for the entire content. And many aspirants have cleared the examination successfully since this particular February examination. I will provide you some testimonial. So if you want to get access to such kind of premium material, you can WhatsApp me on this particular number, or you can check the course description section. In the description section of the video, I provided you the link of the course. So you can do either of them to get access to our premium material on the certified credit professional examination. Now friends, let's see the question number 3. Again a very good question which was asked in the June 28th examination based on payback method. So this is also a numerical based question. That's why I told you should have a pen and paper with you. Now let's see what this question is all about. So basically ABC Limited is evaluating a project with the following annual cash inflow. So as you can see, year 1 annual cash inflow cumulative. So cumulative, how to calculate? Just put this 80,000 here. Year 2 cash inflow is 60,000. So add 80 plus 60, this will give you 1,40,000. Then year 3 it is 60,000. Add 140 to 60, this will give you 2 lakh. Then year 4 it is 20,000. Add 2 lakh to 20,000, this will give you 2,20,000. So we have a table in which on one column we have the year, on second column we have the annual cash inflow, on the third column we have the cumulative cash inflow. Now the question is, if the initial cash outlay is 2,07,500, what is the payback period? Very good question. And 4 options has been given. I request you to please pause the video here. First try the question yourself. Now first of all, let's understand what is the meaning of this payback period. So payback period simply means, the time it takes to recover your investment. How much time it will take to recover your investment? That is called payback period. Now the question is how to calculate this payback period. So basically what you need to do, you need to keep adding. You need to keep adding up the cash inflow. You need to keep adding up the cash inflow year by year. Right? You add up the cash inflow year by year until you reach the initial investment amount. If it does not recover fully in a whole year, we calculate what fraction of the next year cash flow is needed to fully recover the amount. So let me give you one example. Let's calculate it step by step. First of all, let's see the calculation of the cumulative cash inflow. So after we see this column will not be given in the question. They will just give you the annual cash inflow. That's it. Cumulative cash inflow you have to calculate. How to go about calculating cumulative cash inflow? So for year 1 it is just 80,000. For year 2 it is 80,000 plus 60,000. It is equal to 1,40,000. I am telling you now, cumulative cash inflow they will not provide you. Right? You have to calculate it yourself. Just now I am telling you how to do that. Now, if you want to calculate after year 3, so what will that be? 1,40,000 plus 60,000. This will be 2 lakh. That you can see here. And for after year 4, it will be 2 lakh plus 20,000, which will be 2,20,000. So our initial investment was how much? 2,07,500. By the end of year 3, you see, by the end of year 3, we recovered rupees 2 lakh. So we are still short by how much? Tell me. So by the end of year 3, we have recovered 2 lakh rupees and we are still short by how much? 2,07,500 minus 2 lakh. So what would that be? That would be 7,500. So we are short by this much amount, 7,500. Now let's calculate the fractional year, right? So let's calculate here the fractional year. Let me do the calculation for you. Fractional year. So basically in the year 4, how much profit we get? In the year 4, the cash inflow is 20,000. But we only need 7,500 more to fully recover our investment. So what portion of year 4 do we need to get that 7,500? See, it is very simple. Quite simple. You can easily understand it. See, in 1 year, tell me, right? So basically we are interested to know what portion of the year 4 do we need to get that 7,500. So just write in the numerator amount left. In the numerator, you write the amount left, and in the denominator, you write the year 4 cash inflow. Year 4 cash inflow. That's it. So what is the amount left? That is 7,500. And what is the year 4 cash inflow? Which is 20,000. Just divide both of them. You will get 0.375 year. So the correct, so this 0.375 year. So the total payback, we have to calculate the total payback, right? The total payback will be how much? 3 years plus 0.375 year, which is equal to 3.375 year. Right? That is our answer. So let's see the option that we particular question. The first point that we learned is that, first of all, what is the meaning of payback period? I told you, payback period just means that what is the time taken to recover the initial investment. The time taken to recover the initial investment is called the payback period. So remember, whenever payback period calculation is asked, what you need to do? You need to calculate the cumulative cash flow. Right? You need to calculate the cumulative cash flow year by year. Right? And also you need to add fractional year. Yes. You need to add fractional year if needed. Yes. You need to add fractional year if needed. So here the closest answer is 3.38 year. Now friends, let's come to the next question, and this question is based on net present value calculation. Very important from examination point of view. Let's have a look at it. So the question says that a project requires initial investment of 1 lakh. As you can see, initial investment is 1 lakh rupees. The expected net cash flow for our 3 year hours. What are the net cash inflow for 3 year? As you can see, 55,000, 80,000 and 15,000 respectively. And the company cost of capital is 10%. Present value interest factor for year 1, year 2, year 3 are 10%. At 10% rate are 0.909, 0.826 and 0.751 respectively. What is the net present value of the project? See, the PVIF, what is the meaning of PVIF? Let me explain. So basically, there is a formula that is called 1 by 1 plus r whole to the power n. See, if you put n is equal to 1 and r is equal to 10%, which is 0.1. So you will get 1 by 1.01, right? 1 by 1.1, right? So the value of 1 by 1.1 will be how much? 0.909. Similarly, 1 by 1.1 ka square, the value will be 0.826. Similarly, 1 by 1.1 ka cube, the value will be 0.751. So that is the meaning of it, right? So friends, what we have just discussed is that, so this is how we calculate the present value interest factor. Okay. So the company cost of capital they have given 10%, and cash inflow they have given over 3 years, right? Present value interest factor for 3 years they have given. Now the question is, what is the net present value of the project? Very good question. So first of all, let's understand what is the meaning of this net present value. See, net present value tells us whether a project will make money after considering the time value of money. Yes, whether it will make money, whether the project will make money after considering the time value of money, that is called TVM, right? So meaning rupees 100 today is worth more than rupees 100 next year. Obviously, if you have 100 rupees today, after 1 year, that 100 rupees is not that much worth. Now the question is how to calculate net present value. So the steps are here. What we need to do? We need to discount future cash inflow, right? We need to discount future cash inflow to their present value, right? And we need to subtract the initial investment. We need to subtract the initial investment, right? So that is what we need to do. Now, two things are possible. First of all, we will discount the future cash inflow to calculate their present value, and we need to subtract the initial investment. Now, two things can be possible. So NPV is greater than 0. It means project is profitable. NPV is less than 0. It means project is not worth it. Right. Now let's calculate the present value of the cash inflow. So 3 cash inflow have been given to us. Let's calculate their present value. So first of all, year 1. Basically the best way to calculate is using the table, but let's calculate it randomly. So year 1. So what is the year 1? 55,000 is the future cash inflow. And to calculate the present value, what we need to do? We need to multiply the future value with the PVIF, which is the present value interest factor. So for year 1, the present value will be future value, which is 55,000 multiplied by PVIF for year 1. What is PVIF for year 1? 0.909. Just multiply it. So 0.909. This will give us 49,995. It means you can think of rupees 55,000 next year is worth rupees 49,995 rupees today. Then let's go to year 2. So for year 2, if we calculate the present value, so what is the cash inflow we have? 80,000. And what is PVIF for year 2? 0.826. So the present value will be 80,000 multiplied by 0.826. So this will give us, 66,080. So that means, 80,000 in 2 years is worth rupees 66,080 rupees today. Now do the similar calculation for year 3. For year 3, the cash inflow we have is 50,000 rupees and PVIF is 0.751. So to calculate the present value, we need to multiply 15,000 with 0.751. So this will give us, 11,265. Right. Now we have calculated the present value for all the 3 years. As you can see, for first year it is 49,995. For second year it is 63,080. For third year it is 11,265. Now we need to add all of these. So let's add all of these. 49,995 plus 66,080 rupees plus 11,265. After addition, this will give us 1,27,340. So that is the present value of the future cash inflow. This is the present value. Now we have to calculate the NPV. What I told you, after calculating the future cash inflow, we have to subtract the initial investment, right? So what is the initial investment here? So the initial investment is 1 lakh. Initial investment is how much? 1 lakh. So just subtract 1,27,340 minus 1 lakh. How much will that would be? That will be 27,340, right? So 27,340 is our correct answer. That is the net present value of the project. And since it is positive, it means our project is profitable. It is worth taking. So option number A is the correct answer, right? So imagine you are investing in a small business. You invest 1 lakh today. Over 3 years, you earn 55,000, 88,000, 80,000 and 15,000. But because of inflation, future money is worthless. So the net present value help you see the real profit in today's money. Here you are actually gaining 27,340 rupees, right, in today's value. So it is a good deal, right? So common mistake that you need to avoid while calculating NPV. Remember, first of all, first thing is that forgetting to discount future cash flow. This is the first mistake. Second mistake is using wrong discount factor. And the third mistake is ignoring the initial investment. So let's summarize what we have just covered. So I told you NPV is simply, remember this formula. Sum of this is no summation. Sum of discounted cash inflow minus initial investment. Then we talk about, discount factor, right? So what is the meaning of discount factor? It adjusts, discount factor, what they do, they adjust future money to the present value. And then I told you, if the NPV is positive, it means, project is good. Positive NPV means, project is good, right? So that is the point. Now friends, let's look at one more important question related to the letter of credit which were asked. Friends, if you really think that this particular video is worth knowledgeable, it helps you clear your concept, please hit that like button. This will encourage me to make more such and such content. Please let me know. If you want such kind of videos, please write yes in the comment section. I will provide you more such practical based questions for practice. Now friends, have a look at this particular question. So here is the scenario. There is a company that buy goods worth 6 crore, right? Basically the company buys 6 crore worth of good yearly. And they order in chunk. What is the chunk? They order in the chunk of rupees 1 crore each time. And that is called, economic order quantity, or we call it EOQ. Means per time, one time they order for 1 crore rupees. Now, delivery takes 10 days for lead time, plus 20 days for transit time, plus usance period, which is 6 months. Right? And sorry. So basically, if we talk about the delivery time, it includes the lead time, which is 10 days. It includes the transit time, which is 20 days. So total it is 30 days. So the delivery time is 30 days. Plus, usance period. What is the meaning of usance period? So that is called, 6 month credit. So usance period is 6 month credit. Supplier gives 6 month credit. So basically what we need to find? We need to find that how many LC are active at any time. First question. Second question is what total LC limit is needed. This is the most frequently asked question in the examination. So let's understand each and every part of it. First of all, let's understand the total LC duration. See, first of all, let's go step by step. First of all, let's calculate the total LC duration. So total LC duration is how much? Let's have a look. So as you can see, 1 month is the duration, which includes ordering plus shipping. As you can see, this 10 days is the lead time, which means it takes order to complete, and transit time is, shipping time. So total it is 1 month, and plus 6 months. 6 months, that is the credit period. That is the credit period. So totally we have 7 months. So 7 month total per LC. That is the total LC duration. Right? Very easy to understand. 10 day plus 20 day plus 6 months, which is equal to 7 months. That means, right? So now this is the step number 1. Step number 1 is to compute that total LC remain outstanding. Total LC remain outstanding for 7 months. I hope that makes sense. Step number 2 is to calculate the order frequency. What is the meaning of order frequency? See, basically 6 crore rupees per year, as you can see here. Basically, they consume good worth rupees 6 crore per year. So try to understand. This is the very important concept. Try to understand it. What I'm telling you that 6 crore rupees per year. It means, 1 crore rupees per order. Right? Basically 6 crore rupees per year and divided by 1 crore rupees per order, because one order they are giving for 1 crore and total 6 crore rupees per year. So how many order have they given in a year? Obviously 6 order they have given. Very easy to understand. Total 6 crore rupees worth order they have given in a year, and per order 1 crore they are giving. So obviously they have given 6 order in that particular year. So obviously we can say that in 1 year they have given 6 order, isn't it? In 1 year they have given 6 order. Now we know that in 1 year they have given 6 order. Now we want to calculate the frequency, which means how often they are giving the order. Tell me, how many months are in their 1 year? Obviously 12 months. So 12 months, 6 order they give. So basically the frequency of giving order is every 2 months, isn't it? So that is what we are interested in, calculating the frequency. So frequency is how much? 2 months. That means 1 order every 2 months, right? 12 divided by 6. Now the third step is active LC at once time. How many LC were active? right? How many are active LC with outstanding LC? So, you know, each LC live for 7 months. Each LC live for 7 months and new one comes every 2 months. New one comes every 2 months. So 7 divided by 2, which is equal to 3.5. And if you round off, it will be 4 LC. Because 3.5 LC cannot be in fraction, right? So we need to round it off. So that is equal to 4 LC. So you can't have half an LC, right? That is why, we know 4 LC are active at a particular time. Now, LC limit. See, 4 active LCs are there. How many active LC are there? 4 active LC are there. And per LC, you know, 1 crore amount. So 4 crore is the limit. 4 crore is the limit. I hope that makes sense to you. Like 4 crore is the total limit. So 4 active LC are there and per LC, you know, 1 crore amount. EOQ, as you can see, economic order quantity means, you know, 1 LC they are ordering 1 crore rupee. So obviously 4 crore is the limit. So now let's see the option that we have. Option A suggests that 2 LC. No, it is wrong. Option B suggests 3 LC. Wrong. 6 LC. Wrong. 4 LC. Yes. Option C is the correct one. So you can think of it like this. I'm giving you a real life example to make it more clear. Imagine that your kirana store, you order 6 month stock yearly in monthly batch. Each order take 1 month to arrive and 3 month credit. So you have 2 to 3 order active at once. Same logic apply here. So what we learned from this particular question, let me just remind you. I told you now that first of all you calculate the LC duration. First thing is to do is to calculate the LC duration. Right. After calculating the LC duration, you need to calculate the order frequency. After calculating how to calculate the order frequency, see, it is very simple. Yearly demand. Divide the yearly demand by the EOQ. That will give you the order frequency. And how to calculate the total LC duration? Basically, order till payment. How much time it takes from order till payment? That is how we calculate LC duration. And after calculating LC duration, you need to calculate the order frequency. How to go about calculating it? Just divide the yearly demand with EOQ. And then divide duration. Divide duration by frequency. Right. Divide duration by frequency. That will be the number of LC outstanding. And just round it off. And multiply by the order amount to get total limit. So this is the step-by-step procedure. First of all, calculate the LC duration. How to calculate the LC duration? You see how much time it takes from an order till it payment. Then you calculate the order frequency. How to go about calculating frequency? Yearly demand by EOQ. And then you divide the duration with frequency. This will give you the number of LC outstanding at a particular time. Once you know the number of LC outstanding, just multiply it with the EOQ. That is the economic order quantity to get the LC limit. I hope that makes sense to you. Now friends, let's see one more question based on what we have discussed. So the question is, according to the RBI Master Circular on Guarantees and Co-Acceptance, what is the maximum tenure a bank guarantee should normally have? Unless the bank board specifically approve a longer duration. 5 year, 7 year, 10 year, no prescribed limit. See, bank guarantee are like, promissory note. They are like, P notes, where bank promise to pay if a borrower default. RBI set rule to keep this system safe. So first of all, what does RBI Master Circular say? Right. Normally, maximum tenure, for bank guarantee is 10 years. Right. But beyond 10 years, it is possible, but they require, board approval. Yes, beyond 10 years, it is possible, but for that, board approval is required. And then ALM check is also required. What is the ALM check? Asset liability management check. Right. Just like you would not lend your bike to a friend indefinitely. Similarly, bank need limits to manage the risk. So that's why option number C is the correct answer. So basically, no bank guarantee should normally have a maturity of more than 10 years. Friends, as you can see, we have more questions available in our this particular session. If you want me to continue, please write yes in the comment section. I will provide you the part 2 lecture of this session also. I hope this session was useful. Before ending of the lecture, let me summarize what we have gone through, what we have discussed. Just summary of the session. This is very, very useful for remembering till the long term. First question I told you, for calculating the break-even point, I told you, break-even point is a point at which neither profit nor loss. I told you what is the formula. Just divide the fixed cost with the selling price minus variable cost. Right. This is how we calculate the break-even point. In question number 2, what we did, we calculated the profitability index. I told you profitability index just means what, that basically there is a formula for calculating the profitability index. It is what? Discounted cash inflow divided by the initial investment. And if PI is greater than 1, it means profitable project. PI is less than 1, it means loss project. So always go for PI greater than 1 project. Then in the third question, we discuss payback period calculation. What I told you about payback period, let me remind you. So I told you, that payback period is what? What is payback period? So payback period means time taken to recover our initial investment. So how to go about calculating payback period? So prepare a table. First of all, compute this cumulative cash inflow, right? And then add fractional year if needed. And then after adding this cumulative cash inflow to the fractional year, you will get the entire payback period. In the question number 4, we talked about, calculating the net present value. How to go about calculating net present value? I told you there is a simple rule to go to calculate that. So what you need to do? First of all, NPV just means, sum of discounted cash flow. Whatever future cash inflow you have, you just discount it to the present value using the present value interest factor. After discounting, you add all of them and you subtract the initial investment from the discounted cash flow. Then you will get NPV. And remember, net present value should be greater than 1. Should be positive. So positive NPV indicates that our project is very good, right? Then in the next question, what we discussed about EOQ, right? That is called economic order quantity. What I told you about EOQ, just remember the step-by-step procedure that we have gone through, right? I told you, first of all, you calculate the total LC duration. How to go about calculating total LC duration? Basically, it is the time from the order till the payment. You add the transit time, you add the lead time, and you also add the usance period to get the total LC duration. Once you have the total LC duration, you calculate the order frequency. How to go about calculating order frequency? It is very simple. Just divide the yearly demand with the EOQ, right? How much yearly demand is there and how much is the economic order quantity? That will give you the order frequency, means how frequently we are ordering. Once you know the order frequency, divide duration by that. So you have calculated the duration, you have calculated the frequency, divide both of them, right? That will give you the number of LC outstanding at a particular time. Once you know the number of LC outstanding at a particular time, just multiply with that EOQ. That means, limit, right? Order amount. That will give you the LC limit. And the last question we discussed about, bank guarantee, maximum limit of time. So what I told you about, that imagine that you are building a highway. So you need a 15-year guarantee for contract payment. So bank can issue this guarantee only if their board approve it and they ensure fund will be available after 10 plus year. So remember, by default, maximum time for a bank guarantee is 10 years. For that, no approval is required. If it is beyond 10 years, then bank board must say yes, plus ALM check must be done. RBI rule is